Good morning. You're watching Power Breakfast here on CNBC TV18 in the Mumbai News Center. I am Hormuz Fatakia. Let's first take a look at how the Asian markets are faring this morning. It's a largely negative start across the Asia Pacific considering the mixed handover that we had from Wall Street. Hang Seng is leading the losses. Both Hang Seng and Taiwan, which were the outperformers of yesterday's trading session, are leading the losses today across the Asia Pacific. 0.8% lower for the Hang Seng. The Taiwanese index is down around 0.5%. The Japanese index too are trading with minor losses. The Nikkei is down 0.25%. The Topix, which is the broader market index though, is trading with a slightly positive bias, and that is the only index in the Asia Pacific that is trading with some sort of gains. The Shanghai Composite has also opened below the flat line, and the Kospi 2 in South Korea is trading with losses of around 0.5%. So a largely negative screen across the Asia Pacific. Pull up the GIFT Nifty as well, and that will tell you how the Indian markets are likely to open. It's likely to be a flat start is what the implied open is suggesting right now. A minor 11-point downtick. Remember, we have now gained for 8 days in a row. We'll talk more about this as the show goes on. But as of now, the handover from Wall Street has been a mixed one. The Asia Pacific screen is looking negative, and the GIFT Nifty is slightly pointing towards a slightly subdued start. When speaking of Wall Street, the Dow Jones was the one that made a new record closing high yesterday, ending 65 points higher. The S&P 500 though shed 0.3%. The Nasdaq also was the underperformer, and it slipped close to 1%. CNBC's Kate Rooney gets us a wrap of all the action on Wall Street.
U.S. markets were mixed across the major indexes on Monday as the Dow closed at a record high, but stocks across the S&P 500 were weighed down by tech. The Dow up 65 points, the S&P 500 down 18 points, and the tech-heavy Nasdaq down 152 points. The so-called Magnificent Seven and other major tech companies dragged down stocks today as other sectors rose on an apparent rotation out of the recent safety of tech names, a strategy which may be on the rise after last week's comments by Fed Chair Jerome Powell that interest rate cuts are coming soon. Megacap Nvidia, which reports earnings on Wednesday, led the decliners in big tech. And IKEA, meanwhile, is taking on the likes of eBay and Craigslist, launching a marketplace for customers to sell secondhand furniture. The company tells the Financial Times IKEA Pre-Owned will be tested in Spain and Norway with the aim of rolling that out globally. The new marketplace is part of an overhaul at IKEA as it moves towards a business of offering online sales and services such as assembly. That's what's happening here in the U.S. Back to you in Mumbai.
Okay, Tony, thanks a lot for that update. Now let's listen into some important opinion coming in from market experts on the recent commentary from the Federal Reserve Chair Jerome Powell and its impact on the overall U.S. markets.
He was very dovish. If you think of the three most quoted phrases of his speech, one is the time has come for policy adjustment. I think everybody agreed with that and agrees with that. Second was the direction of travel is clear. People agreed with that and still agree with that. The third one is what surprised people, is that we do not seek or welcome further cooling in labor market conditions. We enforce that with the perception that he declared victory over inflation. And the view in the marketplace is that this is a single mandate Fed, that the only thing the Fed is worried about is higher unemployment. And that's why you've had this very aggressive pricing of cuts validated. Certainly what they want is to shift from a single mandate that was focused on inflation being too high and we got to take it down, to a dual mandate that has risks on either side.
I think in Jay Powell's speech, he made clear they're going to move in September. He left his options open as to how much. He made clear that they're going to balance employment and inflation, and they don't want to let the job market get any worse. And I do think we're going to find out from the August jobs report, there's a reasonable chance that that may actually be better than people think. If that job report is weak, they'll go 50. If it's stronger than people are expecting, which is a possibility, then I think they'll go 25. And they'll do that in order to move more deliberately and be able to control the pace.
That's all the global market action that we have. But how will all of these overnight cues impact our own markets? We have our research team joining in with how the trade setup looks like, the stocks that are likely to be in the news, and of course the FNO side of things as well. Now, I'll tell you what you need to watch out for when it comes to the trade setup today. When it's been 8 days of gains now for the index, and the Nifty ending close to a record high yesterday. We crossed that mark of 25,000, almost came to a record closing high, but still remain around 70 points away from that all-time high of 25,078 that the Nifty needs to track in today's session as well. But the bigger part is the Nifty Bank, and that has been the key index that we've been laying a lot of emphasis on as well. You see, it's neither here nor there situation for the Nifty Bank. It closed above 51,000, but it could not sustain above that very important level of 51,250, which it needs to close above for a further up move. But it still continues to remain above the 20-day moving average, and that is a positive for the Nifty Bank. And the index will remain in focus today as well, because it's the financial services expiry today. So that will keep the Nifty Bank in focus as well. Now, yesterday, well, after the speech from Jerome Powell on Friday, it was expected that rate sensitives will do well, and so they did. The metals index was up. It was the top sectoral gainer yesterday. Real estate, IT, all of them contributing to the gains. The IT index continuing to build on after it hit a record high last week as well. And some commentary coming in on these IT stocks as well. So it'll be interesting to see if these continue to move higher as well. There were a lot of other factors that led to the metals rally yesterday. But then, of course, we'll keep an eye out on what happens in today's session. But there are some questions that needs to be asked as well. Now, are the bulls hesitant to take the Nifty past that record high ahead of the expiry session? Because there are a lot of other factors that are in focus as well. Can Reliance take Nifty past the record high, sans the banks ahead of its AGM? That is another important question. Nvidia's results come in tomorrow. How will that have a bearing on the markets as well? And does the Nifty Bank, of course, have enough legs to take it past 51,500? Some important things to watch out for today is the Premier Energy's IPO that opens today, whether block deals continue or not. A lot in focus in today's session. But moving across to Abhishek now, who will list out the stocks that you need to watch out for in today's trade. Abhishek, good morning. What's on your list?
Well, Homas, good morning to you too. Ultratech Cement, they have raised about 500 millions via, sustainability-linked financing. GPT Infra, they have launched a QIP. The price has been set at 183.83 per share. Now, they have an issue size which has a base deal size of 150 crore and a green shoe option of 25 crore. So, total fundraising would be around 175 crore. Medi-Assist, their arm Medi-Assist Insurance will acquire 100% in Paramount Health for a consideration of 311.8 crores. Mazgaon Dock, they have extended Sanjeev Singhal's additional charge as CMD by 5 months with effect from August 1st. Lemon Tree Hotels, they have signed an agreement for 80 rooms in Ayodhya. SCL Tech, they have extended their agreement with Xerox for driving innovative with reference to artificial intelligence and digital engineering. Bondada Engineering, they have won an order worth 576 crores. Paras Defense, they will hold a board meeting to mull consideration of fundraising via QIP. AGM today, Maruti, Indusind as well as UPL. Back to you.
Abhishek, thanks a lot for that update. And over to Sudarshan now, who joins in with cues from the FNO space. Sudarshan, good morning. What's the setup looking like there?
Morning, Harma. So it was a good day of trade yesterday. We saw Nifty reclaiming the level of 25,000 for the first time since August 1. But at the end, it missed record close by a whisker, that is by 0.3 points. But for today, GIFT Nifty is indicating a start with minor cuts, tracking geopolitical tensions and rise in commodities. Now, shifting focus to institutional activities, we continue to see buying by both FIs and DIs. FIs bought shares of almost rupees 500 crore, while buy figure by DIs was almost rupees 1,900 crore. If you talk about this month so far, DI's buy figure is now almost 50,000 crore, and they have bought in 16 of total 17 sessions this month. In the index futures, total net buy was almost 3,100 crore, with buy figure in Nifty was 1,400 crore, and the same level was for Nifty Bank. And with this, long contract exposure has increased to 55%, which is highest in last 3 weeks. Coming to the options front, We saw major activities in 25,050 call and 25,100 call, and on the put side, major activities were seen in 25,000 and 24,900. With this, important levels for Nifty, support is now seen somewhere around 24,900, which is previous day's low, and resistance is seen above the record high, that is 25,078.3. Lastly, stocks in the focus, there are 8 stocks in the band as of now, but out of band there are 5 stocks: GNFC, Granules, Hind Copper, Nalco and Sun TV. And besides these stocks, keep a focus on some of the stocks that might react to geopolitical tensions or rise in commodities, and those might be ONGC, Vedanta and Britannia.
Staggering numbers there on the DII front. Sudarshan, thanks a lot for that update. Time for a short break. Up next, we get you cues from the commodities market. Stay tuned, back on the other side.
See that Chetak is now close to about 18% market share, or just above 18% market share. We are neck to neck with our able competitor TVS and their iQube. I think just a few hundred vehicles separate us. Having just launched a third product, there are more due later this year, within this financial year. We talked about it the last time we met a couple of months back. And I think post the festive season, and before March, certainly there will be more Chetaks in the marketplace. And I could reiterate what I shared with you the last time, that not only will there be more Chetaks in the market of the current platform, hopefully very sharply positioned, but there will also be a new Chetak platform.
Back with us here on Power Breakfast. On to some big geopolitical developments in the Russian-Ukraine conflict. Ukraine cities, including its capital Kyiv, were under attack after Russia launched a barrage of missiles and drones targeting key energy infrastructure, according to Ukraine's President Zelensky. More than 100 ballistic missiles and over 100 drones were launched by Russia, killing at least 7 people and injuring dozens. Authorities also claimed that multiple groups of Russian drones were seen moving in all directions. Many residents were left without power and water supplies. Ukraine's President Zelensky called on the US and European allies for more weapons to strike back at Russia, and also called for decisive action.
Every leader, every one of our partners know the decisive actions required to end this war justly. Ukraine cannot be constrained in its long-range capabilities when the terrorists face no such limitations. Our defenders cannot be restricted in their weapons when Russia deploys its entire arsenal, including Shahids and ballistic missiles from North Korea. America, Britain, France and our other partners have the power to help us stop this terror. We need decisions.
Meanwhile, days after returning from Kyiv, Prime Minister Narendra Modi phoned US President Joe Biden to brief him about his visit to the Ukraine. The Prime Minister took to X to detail his phone call, adding that they exchanged views on various regional and global issues. He also added that India showed full support for the early return of peace and stability in the Ukraine. Now on to updates from West Asia. The near-term risk of a broader war between Israel and Lebanon's Hezbollah has somewhat eased after the two sides exchanged fire without further escalation. However, Iran still poses a significant danger as it weighs a strike on Israel. Now remember, Iran's open threat to Israel comes after they vowed a severe response to the killing of the Hamas leader Ismail Haniyeh, which took place as he visited Tehran last month. Now Iran has blamed the assassination on Israel. However, Israel has neither neither confirmed nor denied its involvement in this killing. And Manisha Gupta now joins in with all the updates from the commodity space. Manisha, good morning. All of these geopolitical tensions seem to be boosting oil prices again.
Oh, absolutely, yes. We saw 3% of gains in the overnight markets after the Libya news came through. There is a bit of a correction in the Asian markets right now. Technical, you could call it, but we are still holding at $81 a barrel for the Brent prices there. The near total production stoppage in Libya is something that really is worrying the markets now. This is a direct impact on crude oil in sense of supplies, and political unrest within Libya has led to that. And as you were mentioning, yes, escalating tensions between Israel, Hezbollah, where is West Asia really headed in days and months to come is something that also seems to be adding premium to prices. Also, when you look at the overall inventories, they have continued to decline. The U.S. crude inventories have declined by 34 million barrels in the last 8 weeks, which is down by nearly 2% there, which is the lowest in 2 years, by the way. And the OECD data shows that the global crude inventories are 4% below 10-year average. So this only is to do with demand. Now, if the demand starts to pick up, then you are looking at very high crude prices going forward from here, because the supply risk is already started coming into the prices. In other news, you have gold prices still holding around $2,500 an ounce, very close to its all-time highs. Silver prices are trading at a 5-week high. Copper is now trading at 5-week highs as well. Prices are up by 4% in the month of August for copper. Iron ore prices are now trading above $100 a ton. China demand seems to be improving slightly. The PMI manufacturing data is expected in this week. If that number comes in positive, then you are looking at more buying continuing in case of metals. And with the US dollar index slightly on the weaker side, that's an added boost across commodities. So a very strong start to the day when it comes to Asia today.
Strong start to the day indeed. Manisha, thanks a lot for all of those updates on the commodities front. Time for a short break. Up next, when we get you all the updates on the Telegram CEO's arrest. Stay tuned, back on the other side. Welcome back. Now, Apple announced its product launch event, its Glow Time, and that will be held on the 9th of September. The new iPhone 16 and the other major products and updates are expected to be launched, while AI is also likely to be in focus. CNBC's Steve Kovac joins in with more details.
It is a day earlier than we expected, too, September 9th on a Monday. Usually they hold these events on Tuesdays. And the slogan here from Cupertino is "It's Glow Time," which I assume is a reference to that new design that Siri is going to get with all this AI stuff that's happening. So here's what we're expecting. We got new iPhones, of course, plus the other stuff you carry around with you, AirPods and the Apple Watch. And by the way, this is the 10th anniversary of the Apple Watch reveal. And, of course, that U2 album they stuffed on everyone's phones without asking us. But as far as the iPhone goes, the most important product, not expecting significant hardware updates here. They're going to look largely and feel largely like the models from last year. And of course, that's because this is all about artificial intelligence. To use those new AI features, you're going to need a 15 Pro or better, presumably the next line of phones we're going to see in a couple of weeks here. And by the way, most on the street think this is going to spur a huge upgrade cycle thanks to AI. But MoffettNathanson this week, although they did agree with that thesis, they said it's largely already baked into the stock. And by the way, this is going to be a really slow rollout, Scott. It's going to be in U.S. English at first, and the features are going to be rolling out over several months. So you're not going to get everything at day one. ChatGPT integration, for example, is going to come by the end of the year, and some more advancements in Siri and other things are going to happen next year. And after all that happens, it's still going to be a beta version. It's unclear when artificial intelligence on Apple devices is going to launch in China, the next most important market, due to regulations there. By the way, CEO Tim Cook told me a few weeks ago the company is working with officials to get artificial intelligence cleared, but expect a slow rollout for now there, Scott.
And some more news coming in from Apple. The company announced that it will replace current CFO Luca Maestri with the current Vice President of Financial Planning and Analysis, Kevin Parekh. Now, Parekh, who's been at Apple for over 11 years, will take over from the 1st of January of 2025. A messaging app Telegram has said that its CEO Pavel Durov has nothing to hide after French authorities arrested him for failure to stop criminal activities on the platform. Now, Moscow has also demanded consular access for the Russian billionaire and has claimed authorities in France are refusing to cooperate. Ashmit Kumar joins in with more details. Ashmit.
Well, let's begin by taking a look at the eccentric billionaire himself. Pavel Durov began his journey back in Russia. He started a social media platform by the name of VK, subsequently gave birth to Telegram in 2013. In 2014, the next year, he decided to leave Russia after facing pressure at the hands of the Kremlin. Since then, Telegram has grown from strength to strength, over 900 million active users. His personal net worth at $15.5 billion, one of the richest men in the world, now finds himself behind bars in France. He was arrested on Saturday, August 24th. The French authorities arrested him and are likely to keep him in custody for 96 hours. So that's 4 days. He's likely to be behind bars, after which we understand the French authorities will be beginning with the prosecution, will be beginning with pressing of charges. So why exactly is he behind bars? Well, the immediate concern that has been raised is on account of moderation as far as Telegram is concerned. Bear in mind, it's been used widely by people on both sides of the border of both Russia as well as Ukraine, used widely. The criticism has been that there's a lot of graphic content doing the rounds. The concern that has been raised by the French authorities is on account of child pornography, drug trafficking, promotion of terror and hateful content, not moderating them. That's the broad concern that the French authorities have. Now, what's important is that this has sparked a wave of reactions as far as social media, ironically, itself is concerned. We have sharp comments coming in, the likes of Elon Musk comparing moderation to censorship, Lex Friedman calling this a case of government overreach, Edward Snowden also chiming in on this conversation, saying that this is a case of French authorities taking a hostage to seek access to your private messages. So strong words there. The Russian embassy so far in Paris is seeking consular access, but is saying that the French authorities are not cooperating so far.
Ashmit, thanks a lot for that update. Now, moving on to some regional news. The IMD has issued a red alert for Gujarat after heavy rains battered the state, leading to waterlogging in multiple regions. Now, in anticipation of further rainfall, the government has also asked schools to remain shut today. Nearly 18,000 people across the state have been evacuated from low-lying areas as we speak. Moving on then, after withdrawing an initial list with 44 candidates, the BJP has released the first list for the Jammu and Kashmir polls with 15 candidates. Now, no candidates were announced for 9 seats in South Kashmir. The last date to file the nomination for the first phase is today. And that's all we have on this edition of Power Breakfast from me and the team that put this show together. Thank you so much for watching. Bazaar Morning Call takes the action forward.
It's 41 consecutive months of net inflows. coming into the market. If you look at the additions, last month alone, we added 2.3 million new registered investors. And that takes the absolute number to beyond 100 million. The reality is, if I were to generalize, the market is invariably still very expensive. And, whether you look at cement, whether you look at auto, whether you look at the metal space, everything's expensive. So it's very hard to actually generalize with respect to sectors. But if you dig deeper and find individual stocks that have been beaten up, now they could be beaten up for a variety of reasons. But like I said, if there's a turnaround happening in a specific sector or a stock, I think that's the time to focus on.
Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. Pandemic-related distortions to supply and demand, as well as severe shocks to energy and commodity markets, were important drivers of high inflation, and their reversal has been a key part of the story of its decline. The unwinding of these factors took much longer than expected, but ultimately played a large role in the subsequent disinflation. Our restrictive monetary policy contributed to a moderation in aggregate demand, which combined with improvements in aggregate supply to reduce inflationary pressures, while allowing growth to continue at a healthy pace. As labor demand also moderated, the historically high level of vacancies relative to unemployment has normalized primarily through a decline in vacancies, without sizable and disruptive layoffs, bringing the labor market to a state where it is no longer a source of inflationary pressures. An important takeaway from recent experience is that anchored inflation expectations, reinforced by vigorous central bank action.
India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. It's a Tuesday morning, and will today be the day when sometime during the course of the session we are basically back at the last all-time high. We're not very far away, I think 50-odd points, 60-odd points, and we are there. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, good morning. So I think we've got a lot going on. Geopolitics making all kind of headlines. Not too much change by way of yields or, overnight action in terms of fresh macro cues from the US. Yeah. But hey, we're 70 points off, just under 70 points off from that milestone. What do you say, Nigel?
Well, indeed, yesterday it gave you the sense maybe in the final 60 minutes we could see that flurry. It didn't take place, so maybe today's the day.
Yeah, the start is indicating a slightly lower, neither here nor there kind of a thing. But I mean, if the market is going to do what it has always done, which is
buy the dip
at some point, I mean, today could be the day. Well, the point is it's kind of it's not as if we're coming back to these highs after, 3 or 4 years. We were there practically recently, and you're just sort of reclaiming some of those levels. So that excitement is there, but you've got to have much higher levels for some real excitement to come back. But in any case, not a bad sign at all to look at the previous highs. It's sharply in focus, a point we've made for the last at least 5 or 6 trading sessions now. So let's just sort of begin with that. The Nifty is almost back at new all-time highs. In terms of a record close, we almost got to, I think, within 1 point of it. In terms of closing, all-time high, as we've been saying, 50-60 points higher. The high is 25,078. We left off at 25,010.11 yesterday. Now, overnight, you might look at the US session and say markets are down, and they are about 1/3% down on the S&P. Nasdaq is down about 0.8. But consider this: it was the lightest volume session in the US markets for all of 2024 last night. In light markets, it's very one should not make, or rather read too much into moves and big moves. This is not a big move, but I think, for example, the semiconductor index sold off yesterday. Nvidia was down 2.5%. We'll come to that in just a bit. But light markets, I don't think should be read into too much. That's essentially the point. I think look at this as just a bit of a drift and nothing more. Now, US 10-year yield was about 2 basis points higher. We're back at about 3.82. Nothing. The dollar index is close to about 101. A slight bump. You had basically Fed's daily who questioned labor market weakness last night. I mean, it was not as if it was a marked difference as compared to what we heard from Powell at Jackson Hole. But she did kind of make the point that she doesn't want to declare that the Fed is on the path to neutral rates just yet. That, they're most definitely on the path to easing. She doesn't see the labor market as being too troubled. And I think post these comments is when yields made a bit of a move and the dollar saw a bit of a bump. Now, of course, geopolitics is very much the name of the game, both in the Middle East and, of course, between Russia and Ukraine. And, both seeing sharp escalation on two different fronts over the last 24 and 48 hours. Oil prices, as a result, have moved up a little bit more. Last night, they went up almost 3%. We are back above $81 a barrel. I think from recent lows of about 76 and a half, we are back above 81. Now, tomorrow night, you get the NVIDIA results. And that's essentially the Pied Piper for the entire AI story. The AI story is not a one-way story now. There is, pull and push, and a lot of people kind of questioning the economic implications, at least in the near to medium term. Long term, no one disputes, but there is sort of pushback coming into this as well. And of course, NVIDIA has got its own issues with that Blackwell chip the launch getting delayed, etc., etc. And this could be material for US markets because so much of what the US has done is because of semiconductors and led by NVIDIA especially. Now, just to come back to the levels here, for the Nifty, of course, I mean, the all-time high is in view, and that'll be the first target in that sense. Above that, you look at a simple Fibonacci retracement level, which comes in at about 25,530. So that's a level after we cross and close above the previous all-time high. That's a very near term. We can sort of look at this in greater detail. Support for the Nifty comes in at 24,780, which is the hourly average, and then the 20-day moving average, which is far below at 24,550. Bank Nifty yesterday closed around the falling trend line of 51,150. We left off at 51,148, so practically there. And a decisive move above this trend line, which is a falling trend line, Bank Nifty can target the upper daily Bollinger Band, which is at about 51,867. Support for the Bank Nifty comes in at the swing low, which is 50,856. GIFT Nifty indicates, I think, about a 20-25 odd point lower starts, which is, as I said, neither here nor there. And I don't think there is too much to be read from what happened overnight from US markets. So it's entirely possible that, after maybe a flattish start, we quickly bump up and at least touch that sort of last all-time high at about 25,078. Surabhi.
Absolutely. I mean, I'm looking at the Asian screens as we speak, Prashant, and it's just to see a Fred out there because there is some caution, there is profit-taking that's going on. Whether you're looking at the Hong Kong markets or Shanghai right now, down 0.25%, Kospi, I mean, the whole lot, Japan, everything's down. It's not a slide, but yes, there's lots of profit-taking going on across Asia, which is why the GIFT Nifty is indicating that it will probably start off on a cautious note. Now, in terms of, the focal points, all that's happening around geopolitics suddenly is sort of back center stage, and we're talking several flashpoints. There's obviously what's happening between Israel and Hezbollah trading rockets, and then yesterday we had headlines out of Ukraine and Russia, with Russia targeting some of the oil infrastructure in Ukraine. And if that wasn't enough, now there's a third angle to it, because yesterday there was some chatter about Libya looking at shutting down a large part of their crude output, and that could, I was reading somewhere, I think, could easily, if all the output goes, it could take 1 million barrels off the market immediately. So there's a lot of rhetoric. I mean, those are internal issues in Libya ongoing, but the oil market really took note of Libya because of the extent of impact, direct impact on oil supply that could take place. So that led to that big surge both on NYMEX and Brent oil. In fact, even this morning, I mean, Brent, yesterday when we left off, remember we started the week with Brent around 79. As we were closing, we were at around 80. And this morning, the prices climbed to above 81. So that escalation is something that we need to really watch out for. Remains a bit of a spot of bother. Yesterday, of course, as Prashant mentioned, not too much out of Wall Street action, but that sector rotation is very, very interesting. For no apparent reason, the fall in tech is something that the market really took note of. Even the Dow couldn't hold at the all-time highs that it hit. Apart from NVIDIA, the other interesting facet is going to be Apple. Apple's event, of course, that annual fall event that they do where they unveil newer models of their products. That is slated for the 9th of September. But beyond that, the change in the CFO is something that's got the market's eye as well. The old CFO, Luca Maestri, he's being moved out. He's still in the company, but in a different role, and he's being replaced with Kevin Parekh, who's of Indian origin. So that remains sort of a point to track as well. Looking at flows back home, well, the situation is that FIIs, at least they weren't on the sell side. We had a mild buy figure, about 500 crores of a buy figure. Domestic institutions bought equity worth about 1,900 crores in the cash market. The Nifty, as we've been discussing, less than 70 points away from the all-time high, but the start is going to be cautious given the global cues. Will the buy-on dips play out is what we're going to see. Given what's happened on, NASDAQ overnight and the fact that IT rallied yesterday, I'm expecting some profit-taking on IT as we start, but then let's see if that dip gets bought. And the big question is going to be whether banks can provide that ammunition, whether they can step in and do some heavy hitting, the heavy lifting, so to speak, because that's where the performance has been patchy in the last couple of days, Nigel.
Well, that's right. I'll take it off from there then, Sarbino, because the Nifty Bank, that's the one that's going to be the trendsetter. That's in a bit of a range. If it can break out of the range, then that'll be actually good news. So today we'll have the Nifty Financial Services Index that plays out the options as well as the futures expiry. So that's going to be a mover in the second half of trade. The Nifty uptrend, I would say, is intact. The 20 DMA is held. This uptrend is well and truly, continuing. The Nifty Bank, that's been a bit of a range. That needs to move out of that range, and that's what will give us direction from there on. What about the FI positioning? Yesterday, they added some long positions, close to around 17,000 long contracts, and they covered close to 15,000 contracts, which explains why we went from 25,000 long positions to around 57,000 long positions. So the FIs, they are net long. In fact, the net long positioning is the highest we have seen all the way since 7th of August. So that's the data point on the FIs. The clients, well, they booked some profits because the long positioning, well, it did come down a little bit. The FIs as of now, 55% is the long positions as of now. That as well is at a couple of weeks high that we have seen. The client's positioning should come up here on the screen. Yesterday, from around 34,000 contracts, it came down to around 16,000 contracts. So they unbound some long positions, which is par for the course. That's about the FI and the client positioning. What about the options data? 25,050 call, that was extremely active in yesterday's trading session, and the 25,000 put. So plugging in these numbers, you get a broad range. You have these contracts that will expire on Thursday itself. So the levels to track, as I said, the 20 DMA, well, that's the important marker on the downside. That's the crucial support. And till that's held out, you'll see that the uptrend is well and truly on. Yeah, the highs that we saw at the start of August and the all-time high is at around the 25,078 mark. We couldn't get to there. So that's going to be the level that you're watching on the upside. The Nifty Bank, that's the mover, that's the important mark. Yesterday as well, we made this point, 51,300, 51,400. That's a bit of a resistance zone. And that's part in line with where the 50 DMA is at. You have support coming at the 20 DMA, but that's the important mark, which is at around that 51,400 odd mark on the Nifty Bank. As I said, the Financial Services Index will play out the expiry. So that's going to be the mover in the second half of trade. The stock I'm looking at is a stock from the cash market. We're looking at Gillette. Yesterday, Gillette moved very, very well. And in the last 1 year or so, it's moved from around 5,000 rupees, closer to around 9,000 rupees. So, and this big surge has come in the last few days as well. Keep in mind, it's come on very, very large volume. So Gillette is a stock that I'm looking at. They have their results that they report in the next couple of days. And this big surge was backed with solid delivery-based buying as well. It has its results. Is the street sniffing something? I'll tell you what, from 2019 to 2020, the stock was a big underperformer, but it seems to be breaking out of a range. So we'll keep an eye out on this stock as well.
All right, Nigel, thank you very much for that. So keep an eye out on that name and, of course, a range of factors which will be at play today and over the next couple of sessions. James Knightley is Chief International Economist at ING. He's joining us now to take some questions. James, good to have you with us here. Thank you very much for your time. you know, the point is markets both in the US and India, which are perhaps the two large best performing markets over the last couple of years, continue to knock at all-time highs, despite, of course, the slight cut last night in the US. Here in India, we're very close. I mean, I think 50 basis points, less than 50, 0.5%. What is your sense, James? I mean, is the setup overall positive? Could oil play a bit of a dampener? Or do you think geopolitics is unlikely to influence stock markets at least?
I think in the near term, we're all obviously very focused on what's happening to the US interest rate cycle as the next clear driver of where markets are going. I don't think, we're going to be progressing onto the US election in time, but for now, it's this US rate cycle. And we've got, say, 3 key data points between now and September the 18th. And if we get ongoing low inflation, we're going to get an inflation print this Friday. We're going to get another inflation print on September the 11th. And of course, it's the all-important jobs print on September the 6th in the United States. And if we do get a cooling jobs market, low inflation, then the market's anticipation of interest rate cuts and a soft landing, which is the ideal scenario for equities, this soft landing scenario where the economy continues to grow, we avoid recession, but we get a lower interest rate environment too, can really progress the strong narrative that the US markets can continue to outperform. There are obviously clear risks to that, and Jerome Powell laid that out last Friday at his Jackson Hole appearance, where he said, basically, we cannot tolerate any further labour market weakness. The Fed are clearly very concerned that the labour market is in a weaker position than it was in 2019. And if they don't take action, then they could see the economy slip away in terms of growth more rapidly than perhaps the equity market is currently anticipating. So I think it's a delicate balance right now. For now, the markets are in the optimistic soft landing scenario with lower interest rates. But as I say, the risk is that perhaps the Fed needs to step on the gas in terms of rate cuts if the jobs market is weakening, and that prompts broader weakness in the US economy.
Sure. James, hi, good morning. Great to have you on the show. The other point that my colleague Prashant just raised, geopolitics. What do you think, what kind of a risk could we be potentially looking at? I mean, so I think the Fed rate cut issue is behind the market. Everyone's expecting at least gradual cuts from here on, and, that Goldilocks soft landing. But could commodity prices be the next surprise, given what we're hearing and what we're seeing all around?
Yeah, I mean, there's certainly geopolitical risks out there. I guess mitigating against that in terms of a market and a macro economy is, if we look at Europe, Europe has been incredibly successful at building its gas stocks, its natural gas stocks. They're about 90% of capacity, well ahead of schedule. So from that perspective, the European economy is perhaps a little bit better insulated than it could have been in previous years. So that's a positive. But also, I guess, offsetting some of the geopolitical concerns is worries about China. The Chinese growth story isn't looking particularly robust right now. And we're going to get more of these Chinese business surveys, these purchasing managers indicators later this week. And they're expected to be flat to in contraction territory. And that could perhaps limit the upside on some of the commodity market moves. If you are in the camp that believes that the China slowdown coupled with a cooling US economy is going to offset some of these upside pressures from geopolitical tensions.
Hi, James. Morning, and good to have you on the show. This is Nigel on this side. I wanted to ask you about your expectations from central banks. From the Fed, I think you were hinting at multiple rate cuts this year. So how many are you penciling in? And from the Bank of Japan, that caused a bit of a scare with that rate hike. Do you think bulk of that yen carry trade has been done?
Yeah, no, it's an interesting point. So we've got about 100 basis points, or a full percentage point of rate cuts priced for this year over the next 3 meetings. And I'm pretty much in line with that. I think we could well get a 50 basis points in there with 2 25 basis point cuts, largely because I think there is scope for catch up from the Fed to the economic position that the US finds itself in. And I think, the market's looking at another 1.25 percentage points of cuts next year. And again, at this point in time, I don't have enough to really disagree with that. I think, Fed getting down to a more neutral level makes sense. Inflation is converging on target. So, yeah, I think multiple rate cuts, a whole series of rate cuts, 25 basis points, the the typical outcome, but I wouldn't be surprised to see a 50 at some point this year. So that's the course for the Fed, and we think that will generally lead to a bit more softness for the US dollar. But in terms of the yen, the Bank of Japan did raise rates 15 basis points. That was viewed as a catalyst for some of the market volatility we saw a few weeks ago. I think that was a bit overplayed. Japan raising rates 15 basis points really doesn't do that much to the global economy, to be honest. And we think that, given the commentary we've had from the Bank of Japan governor recently, and more of the research papers coming out of the Bank of Japan, they seem pretty behind the view that they need to raise rates further. Wage pressures are building, and there's a bit more sense of corporate pricing power. So, I think, we could see the yen continue to perform better, actually.
Oh, okay. All right. Well, live in interesting times, as you're saying. Let's see how the data shapes up going ahead in the US, in China, and of course in Japan. Good talking to you today, James. Thanks very much for making time for this conversation. Well, let's quickly move on and kick it off with the equity call of the day. Rupal Agarwal of Bernstein says that in 2024 so far, most Asian markets have displayed similar trends as the US, i.e. large caps outperform relative to small caps, except for India and Taiwan, where the market rallies have been led by small and mid caps. She says within Asia, they see Japan and some ASEAN economies showing positive growth trends, presenting a good setup to pick small and mid cap stocks. She adds that India is the only Asian market where small cap leadership has persisted, and in the near term, earnings trends are still supportive. However, she says large caps relative to small caps are now near record low relative valuations and crowding levels in India, warranting selectivity towards small and mid caps and increased exposure towards large cap names.
All right, well, this is Abhishek Goenka of India Forex and Asset Management, who says that the dollar is weakened following Fed Chair Powell's indication at the Jackson Hole Symposium that a rate cut cycle is likely to get underway. He says dollar index has dropped to the lowest level since July of 2023. Consequently, he says GBP INR, which is the British pound INR currency pair, has approached 111 mark, and the Euro INR pair is close to the 94 mark, both record highs. He continues to expect the rupee to underperform amid broad dollar weakness, but now to a lesser degree than what we've seen so far. He expects the currency, the dollar INR, to be between 83.4 to 84.4 to the dollar over the medium term.
On to bonds then. Vishal Goenka of IndiaBonds.com says bond yields remain mostly unchanged globally yesterday, post the Friday statement by Jerome Powell on US rate cuts starting in September. He says it is important to watch oil prices, which have rallied 6.5% last week on geopolitical tensions in West Asia. Domestically, he's expecting corporate bond issuance to pick up in the next month ahead of the first half of FY25. As the markets remain stable, he's expecting the 10-year benchmark bond yield to trade in a range of 6.83 to 6.88%.
Well, a lot of stock-specific action to track for you. We'll get to that in just a bit. But for the time being, let's run you through the list. We're looking at MediAssist, Segal India, Zydus Life Sciences, HCL Tech, Forge, Brainbees Solutions, Bilibili, and MedPlus Health. All of them will be reacting to positive news flow, while you have GPT Infra and AU Small Finance that could be reacting to negative news flow.
All right, well, we'll take a quick commercial break here. Our list of top stocks with our research team is lined up next. Stay tuned, that's coming up in just a bit.
Facilitate disinflation without the need for slack. This narrative attributes much of the increase in inflation to an extraordinary collision between overheated and temporarily distorted demand and constrained supply. While researchers differ in their approaches and to some extent in their conclusions, a consensus seems to be emerging, which I see as attributing most of the rise in inflation to this collision. All told, the healing from pandemic distortions, our efforts to moderate aggregate demand, and the anchoring of expectations have worked together to put inflation on what increasingly appears to be a sustainable path to our 2% objective. Disinflation while preserving labor market strength is only possible with anchored inflation expectations, which reflect the public's confidence that the central bank will bring about 2% inflation over time.
Dr. Deshpande, the crux of our problem is probably our diet. Statistics show that 51% of students eat junk food, 38% of adult Indians eat poorly. So what is wrong with our diet to that extent? Is it the lack of protein? Is it too much carbohydrates? Or is it the incremental amount of junk food that our diet has, turned towards in the past couple of years?
Right. So yes, you're very right. The problem is calorie excess because of abundance of food. The other problem is carbohydrate excess. And the third is protein deficiency. So all these three put together are a recipe for disaster, because you are increasing your calories, which is going to make you fat and obese, and you are increasing your carbohydrate intake with all the junk food that is there.
Welcome back. So as we've been telling you, the start is likely to be a little on the cautious side because of the red across the Asian screens. That's the implied open, about 14-15 points lower. But lots of individual stocks in focus as always, and we have our team standing by with the CNBC TV18 list of top stocks to watch. Let's kick it off with some M&A then. MediAssist in focus because it's snapped up another company. Yash, good morning. Tell us the details.
Well, it should be the largest transaction as far as the TP or the third-party administration space is concerned. MediAssist has acquired Paramount TPA. Now, the enterprise value for this particular company is at about 312 crore rupees. Estimated equity value for Paramount TPA goes to about more than 400 crore rupees. Now, as far as Paramount TPA is concerned, it's slightly bigger than the previous transactions which MediAssist has done, and hence comes at a higher valuation as well. Paramount TPA is about 2.5 times sales versus Raksha TPA, the company which MediAssist acquired previously at 1.7 times sales, and MedVantage at about 1 time sales. But importantly, what does Paramount TPA bring to MediAssist? It is the largest TPA in the group segment as on FY24. The acquisition will take MediAssist to have a total market share in the group segment to 36.6%, and in the health insurance segment to about 23.6%. So fits in well with what the company wants to as far as the group business is concerned, takes the company to a higher market share and accretive to EPS for the company that is MediAssist as well.
Okay, thumbs up there. Thanks a lot for that, Yash. Well, let's hop across to Vivek. He's tracking a few companies. Hi, Vivek. Good morning. Take us through the list.
Good morning. So two companies first on my radar. GPT Infra Projects, company is looking to raise close to 175 crore. This is via the QIP route. Base size for this particular deal is 150 crore. The upsize option the company has is another 25 crore. The indicator floor price for this particular transaction or the fundraise is at 174.6 rupees a share, almost 6.5% discount to the current market price. Motilal Oswal is the sole broker to this particular deal. The other stock on the radar is Seagull. Now, it's a recent listing. The company has just come out with its Q1 numbers. A good set of numbers from the company this time around as well. Revenues high by almost 26.5%, coming in at close to the 823 crore mark. EBITDA high by 65% on a year-on-year basis at 144 crore. Margins at 17.5%, a good margin expansion seen over on a year-on-year basis as well. Profitability higher by 80%. Where does the order book stand? At the end of or on listing day, the company said that they had an order book of close to 9,400 crore, 80% which were linked to NHAI projects. Company also said that they've bid for 16,000 crore worth of projects. So it'll be interesting to see, as details emerge, what is the current order book and what is it that the company is guiding for.
All right, Vivek, thank you very much for that. So that is basically some news related to names, but more, and there is a list. Vamakshi is here with that one. Vamakshi, good morning.
Well, absolutely. Good morning. Let me first start off with Zydus Life Sciences. The company has issued clarification report with respect to increased competition for Asacol HD generic. They have highlighted that the impact has already been factored into the sales as well as the EBITDA estimates for FY25. They've also guided for an improvement in the consolidated EBITDA margin by around 150 basis points for FY25, and this is as compared to EBITDA margin of nearly 27.5% that we saw in FY24. They're estimating high high teens consolidated revenue growth to also come through this year. And given all of those factors, going with the green for Zydus Life Sciences. HCL Tech is the next stock on our radar, and that is because the company and Xerox have extended the agreement to drive innovation with AI and digital innovation. Partnership between the company and Xerox had started back in 2009, and under this partnership, HCL Tech will deliver a unified interface that transforms the way employees and clients engage with Xerox. HCL Tech will leverage automation, product engineering, and process operation services to digitally transform Xerox. So going with the green for HCL Tech. Coforge is the next counter that I'm tracking, and that is because Motilal Oswal funds have acquired an additional 1.91% stake in the company, and with this, the total stake in the company has risen to 5.42%. Brainbee Solutions also expected to open higher after SBI MF under various schemes has acquired 4.5 lakh shares. With this, its stake in the company has risen above the 5% mark. And lastly, let's also focus in on Dilip Buildcon. The arbitration tribunal has pronounced an order in favor of the company. The award relates to arbitration of company against the Public Works Department (BNR) in Punjab and pertains to construction of Dharamkot bypass in Punjab. NHAI under this award has been asked to pay Dilip Buildcon 16.65 crores. Interest may be levied in case of non-payment. So overall, given this arbitration award in favor of Dilip Buildcon, going with the green for this counter.
Okay, all right. Thanks for that, Vamakshi. Going back to Vivek, then he's tracking a couple of companies that saw large trades yesterday. Vivek, we know the buyers and sellers. Tell us more.
That's right. So post-market hours, the details are out, who sold and who bought. So two companies on the radar. First one is AU Small Finance Bank. Yesterday saw almost 1.7% equity change hands. So the seller, very interestingly, was Fincare Business Services, 1.7% stake. They sold at 630 rupees a share. Deal size at a little over 800 crore. Who is Fincare Business Services? It was the ex-promoter entity of Fincare Small Finance Bank. That was the company that actually merged with AU Bank. They continue to hold a little over 6% stake in the company. Amongst the key buyers was DSP Mutual Fund, picking up over 1.3% stake. Whole list of other buyers as well. MedPlus Health, yesterday saw a very large block deal in terms of the percentage of equity trading hands. So Warburg Pincus actually made a complete exit yesterday. Lavender Rose Investment, that was the entity under which Warburg held stake. 11.35% stake sold at 616 rupees a share. Whole host of buyers, top amongst them being ICICI Prudential Pharma and Healthcare Fund, 1.4% stake they picked up in the company in the block yesterday.
Okay, all right, got it. Thank you very much, Vivek, for all the details there. Lots of action there on plenty of individual stocks. So let's quickly recap that list for today. The stocks that have positive news flow around them are Mediassist Healthcare, Segal India, Zydus Life Sciences, HCL Tech, Coforge, Brainbee Solutions, Dilip Buildcon, and MedPlus Health. Stocks with negative news flow around them are GPT Infra and AU Small Finance Bank. Okay, beyond the news, what are the interesting brokerage notes to track this morning? Sudarshan standing by. He's been going through all that reading since the morning. Sudarshan, so what comes up on your screener? What's interesting today?
Morning, Survi. So we'll start with Avenue Supermart. CLSA has written on the stock after analyzing its annual report, and it maintains outperform call and raised target to rupees 5,650 from rupees 5,535 per share. It says company is gradually improving across the environmental and social metrics, and it's increased its focus on utilizing more solar energy and green building certification. CLA remains positive on the outlook for the stock as company remains a long-term cost leader in the Indian retail sector. Next is Morgan Stanley has written on real estate sector. It says investor interest in real estate has waned against what it was 6 months ago. Developers are launch dependent and valuations are looking stretched, but it remains constructive amid a continued upcycle. It believes pre-sales outlook for DLF, Oberoi and Prestige Real Estate could be slower. Godrej Properties is its preferred play. It says on an EV to EBITDA basis, Prestige Estates and Godrej Properties, both overweight rated stocks, look cheaper at current levels. Last is JP Morgan on Indegene. It initiates coverage with neutral call and target is rupees 570 per share. It says growth slowed down post-COVID from client-specific factors and weakening macro conditions, but it expects growth to bounce back to early teens from FY26. But it believes company trades at a premium to most tech operations companies and at the upper end of mid-cap tech services peers, and with full valuations and clouded visibility on new launch, it finds the stock fairly priced at current levels. That's the reason it initiates coverage with a neutral call.
Okay, thanks Sudarshan. Gone through a whole host of notes and filled us in with what all you have read. Well, let's move to Manisha then. She's here to tell us about the commodity space. Morning, Manisha. Plenty has happened overnight.
Oh, yes, it has. And if you look at the crude oil prices, we've gained 3% overnight. If you look at the last 5 trading sessions, the crude oil prices have gained up by $5 in 5 days. So even with this correction that we've seen in Asian markets right now, crude is trading on the higher side of the range. Well, there has been near total production stoppage in Libya. The escalating tensions between Israel and Hezbollah are equally supportive. And then the street is looking at the U.S. crude inventories, which are the lowest in last 2 years at this point in the year. The OECD data also shows that the global crude inventories are 4% below 10-year average. And with the Chinese demand slightly picking up now, that seems to be adding into the markets as well. And of course, the U.S. dollar index decline, the Fed rate cuts are data that has been supporting various asset classes there. Within the metals as well, this is going to be a strong August. We are looking at gold at near all-time highs. Silver, copper, aluminum are trading at a 5-week highs. Iron ore prices at one point in time crossed $100 a ton in the late New York session yesterday. So there is money coming back in many of these commodities.
All right, Manager, thank you very much for that. Appreciate it. We'll take a quick commercial break here. We'll connect with Deepak Shenoy, founder at Capital Mine. It's a happy day for Deepak and his team at Capital Mine over there. And we'll tell you why if you've not been following him on social media. Stay tuned. That's coming up in just a bit. We'll talk specific stocks and his views on markets as well.
Also increasing your fat content, and all of this is ultimately going to lead to a lot of insulin resistance, fatty liver, and this is inviting all the metabolic diseases that are associated with obesity. So junk food is very high on processing, and processing is really bad because it can cause a lot of what we call oxidative damage.
What is a good source of vegetarian protein according to you, Dr. Deshpande, and how much protein should one consume?
Yeah, so typically if you're really very active, the formula is that you should get 1 gram per kg of your body weight. But if you're not very physically active, if you're much older, you can go to 0.8 grams per kg body weight. If you talk about vegetarian sources, there is no complete protein. So you will have to eat multiple sources of protein because all the amino acids are not contained in any single food. So vegetarian protein is basically not a complete protein. So you'll have to make a mix and match of different things like cereals, sprouts, maybe paneer, dairy, basically. So mushrooms. So these are all the ways that you can get proteins, but not one of them is a complete protein. So one has to be very vigilant. It's not a way. You have to be really careful where your protein is coming from, and maybe meet up with a dietitian to actually find out where the protein is coming from in your food. So it's not very easy to get all the protein that you need from vegetarian sources. But mushrooms, dairy, all these are very few sources are there of protein. Sprouts do have protein, but they also have a lot of carbs, which people don't understand. Everyone thinks that sprouts is full of proteins. It has protein, but it also...
Welcome back. So as we've been telling you, the cues are a little iffy this morning because of largely geopolitics. I mean, overnight, yes, we saw a bit of a sell down in Wall Street, but that some will attribute to some profit taking, some will attribute to nerves before Nvidia's numbers. But what's happening, as I said, I mean, 3 different flashpoints now. So you've got Israel, Hamas, Hezbollah, that's 1. Then you've got Russia, Ukraine, that's 2. And Libya opened up yesterday as the 3rd flashpoint. And Libya is the most dominant factor when it comes to the oil market, straight impact on output. And therefore, we saw that, very, very rapid escalation in oil prices. And that's kind of weighing on markets to see how these 3 flashpoints settle and sort of move forward. But, let's come back home. And there was some very interesting news and happy news for Capital Mine. We've got Deepak Shenoy joining in. Usually we, start straight off with markets. But Deepak, this morning, first of all, congratulations are in order. It's a big day. It's a good day for you all, I think. 10th anniversary, and you get the approval to set up a mutual fund. So what's the feeling? What's the thought process? Congratulations.
Thanks so much, Survi. It's been 10 years since we started, and that's of course one part of the news. And we've been applied to launch be a sponsor of a mutual fund, and SEBI has given us an in-principle approval. So now the bigger work begins on setting it up and creating it. So it's an extension of what we do. We are portfolio manager, so we actually manage money for customers. So in that sense, it's the same job, it's just in a much bigger way. But I think excited because a lot of opportunities open up, and also very challenging work. So the regulatory interface just goes up 10x more. So good times, crazy times. Sabi, thank you.
I can completely understand. And yesterday I was going through that press release that you folks had put out. I couldn't help but thinking this is fantastic because we know you as someone who's very, very investor centric, right? And that's what I think a lot of investors would want to see from the offering from Capital Mine. But I couldn't help but think that isn't this getting to be a very crowded marketplace? Setting up a mutual fund, competing with the big boys with thousands and thousands of crores in AUM, with the regulatory onslaught as you mentioned. So from a business standpoint, I mean, how does it make sense?
Oh, I think there's always going to be space for more. There's the market itself has about 48, maybe less than 50 mutual fund houses. And of that, it's only the top, I think, 20 that dominate. The 25th mutual fund has only about 15 or 16,000 crores as of December of last year. So it's not like this is a winner takes all. I think there is a lot of growth. India's total market is about 60 lakh crores, which is about, I think, roughly 18 or 19% of GDP right now. I think going forward, we should see this number go up to 50% of GDP. Close to 50% of GDP. Even if it became 30% of GDP, we'd go to 1.25 lakh crores. I think there's enough space for a lot of players. We are going to be small for the coming few years for sure. I don't think we're going to be in any way a threat to any of the big boys.
Well, at least not right now. But Deepak, congratulations. And what a journey, right? Inspirational, actually. I mean, it started with a blog and then, PMS, AIF, mutual fund. So the important question is, where is the party?
Anytime. I think we'll give parties when we actually get a final approval, because this is like it's like celebrating too early if you're celebrating just in principle. Yes.
But strength to you and all the best to you and your team. It's really inspirational. I mean, to you and the team, which has sort of built this from scratch, actually literally from scratch. Deepak, let's talk about markets in that sense. The story is domestic liquidity, which is, of course, I mean, what as an entrepreneur you're betting on as well when you start that mutual fund, and that's pushing markets to, I think, new all-time high. Hop, skip, and jump away. What's the sort of assessment, Deepak, now? Markets near term from here?
That's interesting that you say near term, because I think we're all, kind of on agreement in the long term that things are going to be still better for India in comparison with the rest of the world, perhaps. But the near term, everybody's more scared right now. I think most people I meet are still scared that the markets are overheated, that this is not the right time to put money in the markets. But the markets themselves are showing something else. There's a behavior that says, well, we want to put in more money. So there's more money coming into mutual funds. There's more money coming into equity. Domestic flows are strong. I think while domestic flows are strong, the flows are going to dominate the discourse, right? So to a certain extent, earnings and numbers will kind of be secondary, but eventually they start playing a role. So your problem is your price to perfection in some stocks, but not so much in the others. There are lots of stocks which are trading at perhaps levels they were trading at 3 years ago. In fact, the biggest, HDFC Bank, for instance, where we might have a position. So I think that that is there's a dichotomy of stocks. There's a lot of smaller cap stocks which are more expensive in that context. But I do think there is a lot of cheap stocks available in the market, and there is definitely something that to be said about finding good opportunities here. I think until it comes to a point where everybody is jumping in this euphoria, and literally that euphoria is translating into 30,000 Nifty is going to be here soon and all that. I think that's the time when you'll probably see that the markets top out, if you may. And usually it's liquidity that takes it away. So it's either a big IPO or a big global event that takes away liquidity from India. That I think is going to be the cause, but it may not necessarily be valuations.
All right. Hi, Deepak. Good morning. First of all, congratulations on the big development for you as well as your team. And it's been great being in touch with you, Deepak. Even pre-Twitter days, when you call up and, reach out to you, you'll explain things extremely simply. So kudos to you, the team. And I believe market takes you to other aspects of a person as well, whether it's the dancing or driving down to the coastal part on the beaches. Well, I've looked up to you on that. So enjoy life and wish you well professionally as well. Let's focus on the markets then. And one stock I wanted to address, if you track it, is MediAssist. They've gone ahead and they've done some inorganic growth. They've picked up Paramount TPA. Valuation-wise, it seems attractive because they bought it at around 2.5 times, on a sales parameter. And MediAssist itself trades at more than 5 times. Any view on MediAssist or this theme?
No, I'm sorry, I haven't tracked it at all. So I have no context of the numbers. But in general, let me say that if it's the 2.5 times sales and they are valued at 5 times sales in the market, this is actually a boost rather than a bane to your list. But sorry, I don't have any more fundamental news to give on this topic.
Okay, all right, got that. Because 2.5 times sales is what they've done it at. They themselves traded around 5 times, and on a PE basis as well, MediAssist trades at more than 45 times, and this asset has come in at less than 40 times. So we'll keep that aside. Let's focus on a couple of themes. Yesterday, we had the metal index that came back. Now, data points coming out of China are still extremely weak, but the street is willing to look ahead, and balance sheets are in far better shape. Anything you like from this space, either ferrous or non-ferrous?
No, we're actually away from metals because I think the dynamic here is cyclical, and I don't think the cycle's meaningful enough for us to take opportunities. To be fair, I find more opportunities outside of the space in terms of growth. The cyclical story is not very, not really exciting right now. We don't even see a major special situation in metals, in any kind of metals right now. Though I think, inflation numbers all over the world will cool. And I think that will provide a cap to overall prices. So I think not very interested in the metal space right now.
Deepak, what about the refiners? There's so much going on right now. Crude has climbed back to about 81. And there's enough chatter about what happens. We're getting to state elections, whether there will be any price hikes at the pump level at all or not. But what's your overall sense? Do refiners, IOC, BPCL, HPCL, do they merit a place in the portfolio?
Yes, definitely. I think there is actually quite a big demand for. I think the idea over here is not the refining piece, but the oil marketing piece. The oil marketing piece has legs in that sense because you don't have that much of a demand change, but the supply characteristics are changing, and to a certain extent, I think oil marketing companies will benefit. I don't think the refining game is quite as much in terms of our interest going forward. I believe honestly that we have some positions in oil marketing companies, but not meaningfully in any other of the core refining companies. The idea over here is that if you look at the crude prices over the last 2 years, despite Ukraine, despite the wars everywhere else, we haven't seen a major spike in crude. So it would have otherwise gone to 140 or 150. And it was 140 in 2008 also when there was a crisis. So right now it flitters between 70 and 90. So I think the marketing companies will make money in the long term, make a lot of cash flow. And to be honest, they're not that expensive. There are few non-expensive pockets in the market right now. But overall, I think refining is not really the place to be. We own Reliance, but it's not because of the refining arm. It's mostly because of Jio and the retail arms.
Well, speaking of Reliance, because we are getting to the AGM, you led us to the next question, and you were saying you don't own it so much for the oil and gas or the O2C business, but for retail and telecom. What would be the watch points for you in the AGM this time around? I mean, aside of the big announcements about any sort of business reorganization or demerger, that aside, what else would you watch for?
That's a good question. Actually, their AGMs used to be a lot more about announcements, but the last few years, they haven't been quite as much in terms of big announcements that have come in. There have been good incremental announcements. So we'll have to wait and see. They might throw a surprise out of the hat, or it might just be like it's just going to be bigger and better in that context. They have, in the last few years, accumulated more debt than their cash. So earlier they used to have almost as much cash as their debt. So there is a debt increase. But to be fair, if Reliance doesn't increase its debt, then who else will? The whole industrial lending has been like stagnant for like 4 or 5 years now. But I believe, at this point, I'll only look for surprise announcements. I don't think there'll be much more coming in from there. Of course, they've also applied. I think they will also probably be getting an approval for a mutual fund. That would be Geo Financials. So looking forward to that as well. I think it'll overall, I don't expect much, and I hope we'll be surprised on the upside. But the bias is that we own the stock.
Right. Deepak, I just want to put out a tweet which kind of went viral yesterday. And this is on the SME space. I'm sure that you would have kind of seen this as well. It'll come up for our viewers. This is a gentleman called Akshay Jogani who put out this tweet. He said, the resourceful automobile SME IPO is crazy. 2 Yamaha dealership showrooms, 8 employees. They asked for 12 crores and they got about 3,000 crores, 2,700 crores in bids. Market cap at 31 crores at IPO price and a net worth of 1.5 crores. Is no one asking what the terminal value of 2 dealership showrooms and 8 employees is? Of course, I mean, the fact is that they could be raising this money to expand, open 10 new showrooms. We don't know, but we have to go into the details of that one. But I'm just using this as a, I'm sure you must have seen this on social media, and I don't know if you had any thoughts. There are 2 parts to it. One, of course, is the approval itself. Now, the SME IPOs are not approved by SEBI, they're approved by the exchanges. That's one. And second, of course, is the demand. That's just, liquidity, right? What do? You ask for 10 crores, you get 100, 100,000. You can. Yeah, go on, Deepak.
Prashant, so to be fair, we're not handing them any money. It's all what's happens in the IPO space is you keep your money in your bank account and then you apply. And then maybe you get some, you don't get some, but the money never leaves your bank account, right? So you want to bid for as much as possible, whatever cash you have in your account, simply because that just increases your chances ever so slightly of getting some kind of allocation. And that is what's driving a lot of the IPO market. And that's what's driven a lot of the IPO market in the past. In fact, at that time, people used to take loans to keep money in their bank accounts so that they could bid for higher numbers. So you would get this 1,000 crore IPO getting 4 lakh crores worth of subscriptions. It's not 4 lakh crores. It's just like temporarily borrowed money from NBFCs until RBI put an end to it and SEBI eventually also put an end to it, saying you can't do all this borrowing money, like 100 crores borrow for 2 days and then apply for an IPO and all that stuff. So now the numbers are smaller because the IPO is smaller. Secondly, I'd say the big thing here is this is what the SME is for, SME exchange is for. It's a small company. It's less than 25 crores in paid up equity or something like that. It is trying to grow. They need to raise money. Now, would you rather have them raise money through debt or go to some private financiers or venture capitalists or come to the markets? I think coming to the markets is actually the best thing to do if you want to raise equity because you will have a layer of transparency on top. You will have to reveal your numbers. At least once in 6 months for the SME exchange, but you'll also be able to participate in growth. A lot of SME companies, some companies that we know of, say E2E, which listed in the SME exchange at, I think, 50 crores or 60 crores when it started. Today, it's valued at, say, 2,000 or odd crores or close to that in the market. So I think there are companies that start off as SMEs and then build up from there. Yes, we could make a meme out of this saying 2 cycle showrooms, only 8 employees. But honestly, it's not the number of employees. I think they make 1 crore of profit and, the value is 31 crores. So effectively, they're, just the cash returns on this 12 crores that they raise, if they just kept it in a bank account, that would double their profit pool or go give a significant boost to their profits. So the profile of the company changes. And of course, hopefully they will give a better return on equity. I have no comments on the company. I haven't analyzed this in meaningful detail. But I mean, I'm not outraged about it. So I think
I was also not outraged, but I wanted to ask you if you were outraged because it just seemed a lot of outrage all around. I mean, a lot of exclamation marks, etc. But I mean, it's not the terminal value of the two showrooms, right? I mean, they could expand whatever. And the idea is to boost SMEs. Of course, there are lots of winners and wealth creators in that space over the last couple of years. And like in any market, in any segment, there are also disasters. So one needs to exercise caution here and on the main board equally. Point taken. It's an interesting space, and we'll come back to this in a greater sort of way later, Deepak. But thank you very much for joining us this morning. Really appreciate your time, and once again, congratulations on the mutual fund license. We'll, I think, take a quick commercial break here. We'll come back with the management. Our first corporate of the day, Zen Technologies, will be with us in a bit.
And ultimately, if you had to get all your protein from the natural vegetarian sources, your calorie count is going to increase exponentially. So, so that is what you have to be careful about.
As we head into the festive season, in the months of September, October, November, we are very likely to cross a monthly sales production and sales rate of over 100,000 clean energy two-wheelers and three-wheelers. But I would hazard that definitely over 25% of our current revenue is already coming from or about to come from clean energy vehicles, which is quite remarkable.
Welcome back. Here with us on Bazaar Morning Call. Let's quickly get to that promised conversation with the management of Zen Technologies. The stock has seen a strong run this year. The returns are over 130% if you look at the last 12 months. And the company has now successfully raised 1,000 crore rupees via a QIP. To talk about the business outlook and the plans going forward, we have with us Mr. Ashok Atluri, Chairman and MD at Zen Technologies. So thanks very much for joining in. So let's start right there. 1,000 crores in the bag. The last time we were in conversation, you did indicate that you would be looking at potential acquisitions. So has something been firmed up? What are the timelines like? And what exactly is going to be the utilization, specific utilization of the 1,000 crores you've raised?
So we are still looking at, we are in talks with a couple of companies, and they're at quite advanced stage. And again, once we are able to sign the documents, then we will be able to reveal with the names of the organizations that are companies that we are trying to acquire. And as for the utilization, we are looking at the inorganic, inorganic growth through acquisition. That's one, and the second is working capital, and finally some bit of capex and internal R&D that we want to do, and general business purposes. Yeah.
So, Mr. Atluri, on the acquisition, the first point that you said. Give us some idea of the size of these target companies that you're looking at, and also the specific technologies or the areas, industrial areas in which they operate. Where would you be shoring up your presence? And again, out of 1,000 crores, I mean, are you setting aside, say, 500 crores for these acquisitions, more, less?
So it's a flexible. Currently we are saying about 350 to 400 crores, and the size of acquisition we are looking is between 100 to 250 crores. That is the acquisition size we are looking at. So that would accommodate for a couple of acquisitions for us. Yeah, and the area that you said, where are we focusing on? We are focusing on both the simulation market and the anti-drone or electronic warfare market. We're looking to strengthen ourselves in both the segments, and we expect that. Interesting companies are there in these spaces, and that will help us, fill some gaps that we have for our future strategy.
Mr. Adluri, so 100 to 250 crores is the size, and you will do at least two, right? You said a couple.
Yeah, 2 to 3. I mean, we are open to that. Yeah, that's right.
2 to 3.
Yeah.
So you're talking to at least 3 companies, and in advanced stages, then, right?
No, this will accommodate 2 to 3 acquisitions. Yeah, and we're talking to a couple of companies. You're right. Yeah.
Okay, and it's in both segments, simulation and anti-drone as well.
Yeah, that's right. Electronic warfare. That's right. Yeah.
I mean, if there is one industry which, I mean, you can look at what is happening around us, and I was thinking about it yesterday. I mean, when you read these headlines out of Russia, Ukraine, that drone attack, what you're seeing out there in the Middle East, right? I mean, it's just absolutely crazy. And the need for, I mean, what you make, anti-drone systems, I think you can see a real fundamental driver behind it over the next many years. I mean, just your thoughts. I just wanted your views, because this is all happening real time.
Yeah, so, I think we have been lucky that, very early 2018, we decided that we should focus on anti-drone systems, where the craze was drones. Everybody wanted to get into drones.
I think
we said gap.
Go on, Mr. Adluri. I think we're losing you, but go on. We'll give it another shot.
Yes. Please go ahead, sir.
Yeah. So I think we were lucky that we invested very early on in 2018 into anti-drone space, and today, we have a lead over any other thing. Again, the Armenia-Azerbaijan war proved, Ukraine war is proving that drones are a different level. If you in a gunfight, if you bring the sword, you are going to lose. So all the other weapon systems are becoming absolutely, outdated. So the ADS is very, very big, and the anti-drone systems, and we can see as we speak the inquiries and the demand from not only India but all over the world. It is exploding at this point of view. No pun intended. And the second was.
Okay, all right, Mr. Adluri. I think that line is not supporting us, but appreciate you joining, and thanks a lot. We look forward to the inorganic growth. One point that I would like to address with you was your operating cash flows that are yet to pick up. Even in the last year, it was only around 20-30 crores odd. So I'll want to track that. Revenues, EBITDA, everything's improving, but the operating cash flow is something that I'd like to address, given that institutions have put in 1,000 crores for just 6% in the company. Maybe that discussion for another day. For the time being, slip into a short break. You come back, we'll have our technical experts, Mitesh and Sudarshan, will be joining in.
US Vice President Kamala Harris created history when she accepted the nomination to contest the US presidential election. She's the first woman of color and the first South Asian American to become the presidential candidate.
Welcome back. Just a minute to go and then we start getting the pre-open rates. Like we've been saying, it's a bit of a cautious morning across Asia. With the GIFT Nifty, last time we checked, the implied open was almost 14 points lower. We'll have the pre-open rates come up any second now. Well, let's quickly get to our technical experts as well. We've got Sudarshan Sukhani as well as Mitesh Thakkar with us. Good morning, gentlemen. Good to have you on. Sudarshan, so what's the sense when we're just about 70 points away from the all-time high? Qs are not very supportive, at least as we start. If there's a dip, will you buy it?
Good morning. Well, if there's a dip today, I would not buy. We've had a very decent run, and that 70 points that need to be overcome would be overcome either today or in the next few days. I don't think we will shy away from new highs, but not today. In the sense, today is not a good day to buy. The markets can be choppy. This doesn't mean that the markets are going down. It simply means that markets pause. After all, every day is not a relentless buying, day. So the view for today is avoid the Nifty and the Bank Nifty and focus on stocks. If you have a positional trade, stay with that positional trade, keep a stop at 24,900 and stick with it. For intraday traders, avoid.
Okay.
Yeah. All right, got that. Gentlemen, morning. Appreciate both of you joining us. Mitesh, what about you? What would sort of your strategy be and your ideas?
Morning, Prashant. So I think, yesterday we had a gap up opening and we closed near the previous highs. And to me, gaps are important. So I think, I would be a buyer on declines. But as Sudarshan said, I think, depending upon what kind of decline we get today, I'll take the decision. I think this gap level of 24,850, 860 is very important for me, which is roughly about 150 points lower. So in case you get an 80, 90 point kind of a dip, then yes, but not a 20 point kind of a dip. I think that doesn't warrant a buying. Around 25,000, around 24,900, take a 60, 70 point kind of stop loss, take longs and expect this highs to be cleared, as Sudarshan also said. I think the view is that there's a strong chance of us making and registering new highs. And therefore, I think, buying on a slightly bigger declines is what I have in mind. But on stock side, we are clearly trading with more of long buys.
Okay, all right. Got that, gentlemen. Mitesh, tell us what about individual stocks.
I have 3 buy calls, Nigel. Hindalco made a fresh high, so very good chart pattern here should see some strong continuation on the upside. So keep a stop below 700, look for targets of 740. Dabur is something which I've recommended, very often in the last few weeks. Comes on the list again today. Keep a stop at 645, look for targets of 675. And a breakout happened in the charts of Bajaj Finance yesterday. Bajaj Finserv. If there's a pullback around 1680, 1675, which is about 8-9 point kind of a decline, buy with a stop at 1650 for targets of 1745. One sell call, Federal Bank. Keep a stop at 201.5, look for targets of 190.
All right, got it. So Darshan, let's come to stocks. What will you work with today? What's the list?
See, the list is an all-buy list. It's so much easier to buy in a bull market. Ultratech Cement is a buying opportunity with a stop under 11,200. Divi's Lab is a buy. Pharma is on a roaring, uptrend anyway. Divi's Lab is a buying opportunity with a stop under 48.50. Techem has been outperforming the other IT stocks, and the other IT stocks are outperforming the Nifty. So Techem is a buy with a stop under 1600. And finally, an old favorite, Asian Paints, has come out of a 6-month long consolidation. That's a positional buy with a stop under 3120.
Okay, all right, gentlemen. Thanks a lot for that. Well, let's turn the spotlight on the IT sector. That was the one that was buzzing yesterday in 2024. In fact, the IT index has outperformed the Nifty. Jeffrey says that the recent move may lead to price-to-earnings re-rating. To help us out with a quick analysis, we're joined by Sandeep Agarwal, fund manager at Subilo Investment Managers. Hi, Sandeep. Good morning. Thanks a lot for joining in. What's your take? The Indian IT space has outperformed the Nifty. We're trading at valuations in excess of what is the norm, in comparison to the 5-year average, and also at a premium in comparison to what Accenture is trading at. Your view on the sector from here on, and what's the top pick?
So, hi, good morning, and thanks for having me in the show. So, Nigel, we have discussed this many times in the past, and I will reiterate that, this is a sector where large caps generally should see a revenue growth of 8-9% because industry grows at 3-4, outsourcing grows at 6-7, and we gain some market share every year because of benefits of scale, availability of manpower, and all that. So our large cap grow at 8-9% on average, and because of some improvement on the margins, the EPS growths are generally 11-12%. Also partially aided by buyback of shares, which reduces the share count. Now, this is the actual mean average which the sector does because it is a matured sector. But when 1 or 2 years you don't see any growth coming in, or the growth is below this mean, then it all gets bundled up and shows up in the third year or second year, and the stock performance are little outsized. So I would say that this sector should be seen as a pure long-term investment sector where you should expect on an average, if you are putting your money for 5 years, 10 years, you should expect 12-13% on the large names, and the mid-size good quality names you should see 15-16%, and the small ideas, if they work out, you can see 20% CAGR on the performance. So that is the way this sector should be seen. So in Jan and Feb, there was extreme pessimism at that time. Also, our view was that, given the data of how attrition has come down sharply, the margin should surprise. And I'm telling you today also on the call, this quarter, you will see bumper margins by all the players. And every analyst will run to, upgrade the numbers, and the stocks will also move up. And then revenue growth will come after that. And once revenue growth starts coming in, you will again see attrition picking up and slowly margin is tapering off. But we have another 2 quarters where this stock should do well. That is what my sense is.
And your preference would be between the large, the mid and the small cap companies? What would it be? Because the growth is going to be better in the small cap names on a lower base. But, if you're allocating, say, $100, how would you split it up?
So, we run a PMS, so it is very hard to call out the names of the stocks. But let me put it this way, that within the large cap, the stocks which are trading at a much reasonable valuation and where there is turnaround stories likes of HCL Tech and Techem, they will still continue to surprise from here in my view. Similarly, in the good quality mid-cap names, if you leave aside the R&D names, ER&D names, because in ER&D, I still believe there is a small blip which can happen because of availability of manpower. It is still challenging in that area. Then you can get good opportunity to buy some of the names. But otherwise, the mid-cap IT services names are really overpriced in my view. Better to look at some of the names in the small space where the stocks have not moved up. And they also, the margins are at bottom. So, likes of FirstSource, likes of Gensar, likes of Buildersoft, these on some of the names like Onward and Axis Gates. These are the names where, there is a lot of scope for improvement of margin and growth momentum. So I would generally prefer a ER&D small cap or mid cap play where, there is some correction or if they are little reasonable, because see, ER&D any which ways for next decade will outperform IT services by at least 2x. So best to play ER&D at reasonable valuation. That is what I believe. And in the large cap, you play the names which are reasonably priced. So you have a play in large cap and you have a play in small cap. Mid cap, I think, is an overcrowded space now.
Okay, so ER&D, that's the place to be in. Got it. Just to go back to the earlier points in the morning, to go back to the earlier point when you said that if you're looking at a long-term exposure, then expect, I think you said 12 to 15% kind of return. And that's on a stock level basis, right? That's the overall return to expect steady state long-term from IT in your portfolio. That's the point you made, right?
Yes, absolutely. So what I'm trying to say is that, this industry is 8% revenue growth and 12% earnings growth. So you can expect 15-16% kind of stock return for the large names on a stable basis. So if it has not come for 2 years and the third year, it will come 30-40%. It has always been like that. If you see last 10 years, it has been like that only.
No, absolutely. So now the question is, what's the kind of multiple that you're willing to pay for that? It's not bad, right? Steady state. If you're saying the Nifty earnings compounding and overall compounding is supposed to be between 12 and 15%, and long-term IT will give you the same with reasonable margin of safety, cash, etc., etc. So maybe it's not that bad. But the question is, how much are you willing to pay for it? So multiples right now versus the peak, what's the further expansion that you think will still be digested by the market?
So I think 2 to 2.2 times PEG ratio is what anyone should assign. So I think for the large names, anywhere between 22 to 30 times is a reasonable multiple, because as you rightly said, there is a lot of cash balance, stability, and all that thing. And also remember one thing, that last 1.5 years, NASDAQ has finally made a new high now. And, most of the companies have done phenomenally well. And now the numbers will start tapering off. So the follow-on will be on Indian IT. We have not yet got the benefit of the growth which the ultimate market has seen. So always we see an impact with lag effect. So we will have honestly 3-4 very good quarters in that sense. So 2 quarters superb revenue growth and margins, and then followed by 2 more quarters of good revenue growth but mellowed down margins. So I think we have to yet get benefit of, and it always happens like that, we get benefit for next 3-4 quarters after this Apple and Google and everyone does well. So we have next 4 quarters which are good in my view.
Next 4 quarters could be good. Okay, we'll have a longer conversation later. But your point was 30 times earnings, price to earnings is perhaps what would be fair, which is exactly where these stocks are. I mean, the sector as a whole, Nifty IT at 30 times. So let's see if there can be any further expansion. Thank you very much. Little short conversation today because we're running into market opening, but really appreciate your views.
Surbhi, I was thinking in IT services, a lot of action is in the unlisted space.
Yeah.
And I think Sandeep would very well know what's happening there because, you know, the point is that the larger ones are so large that you're getting an exposure to a lot of stuff. But there are a lot of smaller companies, you know, doing AI work, specialized work, which are all kind of making a beeline into, so this pre-IPO kind of investing is also...
I'll ask you about it later because I'm quite interested in that. If they're digging the small ticket.
No, I mean, you know, and there are actually structures now, right? I mean, I think these pre-IPO, close to listing kind of structures, AIFs are booming, looking at sort of, you know, getting in earlier rather, in that sense. Well, I think we've got what, the Nifty IT index on your screen, 34 points. But Sandeep made a good point. He said last 2 years we've not got returns. But over the next couple of years, you will get that CAGR 15, 16, 17% kind of return from IT companies, which is, I mean, will be fantastic in any normal market. It's as though we've been in a very bullish phase for a while now. So those returns look meager. Okay, let's bring in our 9-10 calls with both Sudarshan and Mitesh. Sudarshan, what do you have?
Consider buying TechM with a stop under 1600.
TechM 1600. Mitesh, what about you?
So buy on Hindalco for targets of 740.
All right, Hindalco, a target of 740. Gentlemen, thank you very much, both of you, for joining us with that. Let's sort of put the spotlight once again on a few of these stocks which should be in focus. MediAssist is something we want to talk about. Yash is here. Yash, it's a big deal and a good one.
Well, that's correct, Prashant. One of the largest deals as far as the insurance TP or the third-party administration market is concerned. We don't hear much about this. Only one company listed from that particular space, and that is MediAssist, which has decided to acquire a TPA company called Paramount TPA. The deal happens at an enterprise value of about 312 crore rupees, equity value which is estimated to be upwards of 400 crore rupees. Just to look at this particular deal for MediAssist, that is Paramount TPA versus the last 2 transactions which they had done, Raksha and Medvantage. Paramount TPA is 3 times the size of Raksha TPA and 7 times the size of Medvantage. So as you said, quite a large deal for MediAssist. Paramount TPA deal is done at 2.5 times sales versus Raksha TPA, which happened at 1.7 times sales, and Medvantage at 1 time sales. MediAssist itself trades at about 5.2 times sales and 47 times enterprise value. Now, importantly, what does Paramount TPA bring to MediAssist? One, it is the largest transaction as far as the TPA segment is concerned. Acquisition to take MediAssist market share in the group segment higher by about 6% to 36.6%, and in the health insurance segment by about 4% to about 23.6%. So well aligned with what the company wants to do in the group segment, and a good transaction there for MediAssist.
Okay, bang on. Thanks a lot for that, Yash. Well, let's hop across to Vivek. There's a note that's come in on NLC. He's here to cover it. Vivek, take it away.
Well, good morning. You know, after NLC India's Q1 performance slightly muted, the stocks saw quite a bit of a significant coverage. This point of time, Elara has taken the opportunity to go ahead and initiate coverage on the stock with a buy rating. They have a target price of close to 373 rupees a share, a little over 30% premium to the current market price. First up, talking about NLC India, they note that the company has presence across varied energy multiverses, including presence in lignite as well as coal mining, power generation, power trading, and also offers consultancy services for mining as well as the power sectors. Remember, NLC controls over 50% of the country's lignite reserves as the designated nodal agency for lignite mining in India. A consolidated generation capacity of close to 6 gigawatt, and the company has plans to ramp up its total capacity to almost 20 gigawatt by FY30. Remember, Remember, NLC India also is in the regulated business, so has a fixed return of equity of 14% on captive mining and 15.5% on power generation segment, similar to peers, in the power generation segment. So talking about the regulated equity that the company enjoys, 9,500 crore, 5,900 crore out of that allocated to the power generation business and 3,600 crore to the mining business. So what is Elara anticipating? They say that over FY24 to FY27, expect revenue CAGR of 15%, EBITDA CAGR of 20% and PAT CAGR of almost 20%.
Okay, interesting. Thanks very much, Vivek, for that. The upside is 100 rupees from where the stock is right now. So let's see if the market takes note of it. But overall, Prashant, I mean, it's not bad, right? Given the cues, at least the pre-open is suggesting that we'll start flat, maybe with even a green tinge.
Yeah, absolutely. And that's the market, right? And you need just a little bit of green, just a tinge, as you said, to take us to, go back to the highs, the previous highs. 25,025 is what the Nifty is suggesting. But let's see. The opening bell comes up. We're at about 25.21, 25.15. This is absolutely flat as they come. The Sensex, now in the red, but barely so. The Sensex at about 81,700. Again, it's absolutely flat, down about 10 points. We've got the Bank Nifty, which is at about 51,140. Advanced decline on your screen, 3:1 in favor of advances. The broader market right out of the gates is looking very solid. The Nifty, though, as you can see on the heat map, is more mixed. So you've got about 15, 16 names which are sort of down, so a few unchanged, and an equal number which are higher as well. So 15 or 20 points lower on the Nifty to begin the day, 24,993. Let's talk about individual names.
Absolutely. Well, on the Nifty, bringing up the red side, BPCL. In fact, let me look at the other oil marketing companies as well. Yeah, even on HPCL, IOC expectedly, there's about a 1% decline coming through over here. Weakness in Hindalco after yesterday's mega rally. We're seeing some weakness on Tata Steel as well. Some of the commodities basically losing ground. There's Shriram Finance, Asian Paints. These are the stocks on the way down. Paints perhaps seeing an impact of the higher oil price, the kind of rally that we've seen yesterday. But then on the flip side, you've got a Power Grid, Ultratech Cement, HCL Tech, which has extended its long-standing partnership with Xerox. That's rubbing off well on the stock. There is some buying on an ONGC, Britannia. Apollo Hospitals is reversing some of yesterday's declines. And L&T is up about 0.5%. The Bank Nifty is doing absolutely nothing, absolutely flat. HDFC Bank is on the flat line. ICICI Bank is hardly changed. Kotak is down about 0.5%. Axis is down about, hardly down, just absolutely flat. And SBI is also at the flat line. So the banks are very, very quiet at this point in time. And we have an even-Steven market, actually. Not 1 point up, not 1 point down.
Well, the stock definitely that's in focus is NIT. What a beautiful move, right? Mr. Damani has checked in, and from there the stock is up closer around 45-50%, in a matter of a few sessions. Yesterday it was high, the previous sessions as well it was locked, and today it's up closer around 10%. Let's see whether or not, it does cool off a little bit from here. So that's the stock at around 170 rupees. GSPL, the street clearly believes something's got to give out here, so they're sniffing some kind of action out here. For the time being, the stock is up close to 6%, putting on weight after yesterday's big move. Aarti Drugs, they announced a buyback, very, very small buyback, but the street likes it for now. The stock is up another 3%. Edelweiss Financial, one of the top volume movers today, that stock as well is holding with good gains in today's trading session. High-Tech Pipes, that's another one that's doing rather well in trade today. Remember, they are coming to the market to raise some money by the QIP route. They joined us here on CNBC TV18 and they guided for better times going ahead. So that's a stock that's in focus as well. It's a good start.
MediAssist, I forgot to mention that. MediAssist is, market likes this acquisition and the pricing perhaps 10% up.
Well, and the writing was on the wall, right? When you're buying an asset that's trading at around 2.5 times price to sales and you are trading at around 5 times price to sales, well, the street will like it. And also on a PE basis, MediAssist trades at more than 45 times, while you have the acquired asset that's trading at less than 40 times. So valuation-wise, that asset is fitting in, it increases their market share, and that's the stock of the morning, up 9%. Prashant.
Well, let's look at a few other names before we welcome in our market master today. So 1,300 stocks are higher, and you've got about 700 odd stocks which are lower right now. So actually, it's about 2:1 now, moderated a bit on the downside. Just a few specific names. So And by the way, keep an eye out on the Nifty, right? And the distance to the previous high. We'll put out a sort of clock in that sense as well and see where we are at. So GSPL is the biggest volume-led gainer. So that's Gujarat State Petronet. That's 6% higher, and GSPL has got humongous volumes, 3.5 million shares on it at this point in time. Oil India is again got humongous volumes. It's up 3%. So with the slight relief in oil prices from 77, we're back above 81. Oil producer like Oil India seeing some relief. Aarti Drugs is up about 3%, 625 right now. GMR Power 2.25%, 129. It was a mover yesterday, at least at start as well. NLC India, we mentioned. A name like Balu Forge, I mean, out of the blue, it's a name we've sort of put out on our chatter list over the last 6-8 months with Nimesh. 5% higher, 800 rupees, and stocks, it's got volumes, and that's why I'm highlighting it. Never ever figures, with volumes at this point in the day. K Fintech is up about 5%. K Fintech is at about 1,060 or so. Shilpa Medicare is coming up with a 3% gain. Stocks at about 755. Shilpa Medicare, of course, has also had a very nice move through the course of this year. Tata Tech is the biggest volume-led loser. Tata Tech is down about 1.6%, and that's at about 1,032. There is CDSL, BPCL, Policy Bazaar, RPSG Ventures, the Sanjeev Goenka Group holding company is down 4%, but it's had a spectacular rally. And Reliance Power is down about 5% as well. It was down 5 yesterday. It's down 5 again this morning as well. So that's essentially the overall picture. We are holding about 25,000, 25,022, and we're up about 12 odd points or so. Rana Gupta is with us. He's Senior Portfolio Manager and India Equity Specialist at Manulife Investment Management. Rana, great to have you with us here on the program. Good morning. Prashant here. Do you sense, amongst institutional investors, what's the mood like? Do you sense a lot of enthusiasm that there is, there are greater upsides that you can see, or is there more caution and more wonder at this stage, Rana? What are you seeing?
Well, if you're talking about the foreign investors as an institution, then in looking at the flows, I would say that much of them have been quite concerned on the valuation. But having said that, I think the domestic institutions continue to pour in money. I think as for our understanding, the domestic flows are running at about $100 billion per annum, with the supplies of equities much less. So put together, if you ask us, we think from a liquidity standpoint, from a fundamental standpoint, the market is on good wicket.
Okay, Rana, hi. Good to have you on the show. The market's on a good wicket, you say. So valuations not much of a concern. I mean, where do you see pockets of opportunity in the market?
Sure, I think the valuation overall market, I think if you look at some of like the industrial stocks there, I think the valuations is an issue because they have had a fantastic run over last 1-2 years or so. But we do see pockets of opportunity. For example, I think let's look at the domestic consumption, a sector which has not done much. But within that, we see opportunity in sectors like telecom. We see opportunity in sectors like two-wheelers, tractors. Also, we see opportunity in real estate ancillary kind of industries. With the specter of rates coming down and hopefully liquidity improving, we also see opportunities in banks, large banks which suffered due to liquidity in the past. We also see opportunity in the smaller banks or the non-banks with a fixed asset book. We see opportunity there. Also, given the wealth creation in India, we continue to see opportunity in the wealth and asset management businesses.
Okay, all right. Hi, Rana. Good morning and good to see you. Tell us about this real estate ancillaries. What are the plays you're looking at? The tiles players? Is it the pipes players? Give us some clarity on that front. Which is the segment you're looking at?
So we are looking at the segments like the pipes, the cables, the switch gears, the lighting and all those segments. Because all those segments, we believe the organized sector has a definite edge and they can do better. The other sectors are good. I think overall volume growth will come back, but there is just too much of competition. And we would rather want a bit of less competition, a bit of more volume growth and pricing for the businesses that we like.
No, absolutely, and a point taken. Rana, any thoughts on real estate? The cycle continues, sales, etc., are strong, but at the margin, one is starting to hear more and more anecdotal stories, right? But it's a consumer sector, so anecdotes is an important part of the mix. There are a lot of speculative activity as well, and I think institutional brokers are also starting to talk about it, at least formally. I think there was a Kotak recently wrote a note about it. What's your sense? I mean, is it a bit of a concern, or things are looking rock solid? And that's a sector which is not just important for that space itself, but it supports so much else.
Oh, absolutely. Real estate is a very important sector that way, as we are all aware that the domestic capital formation is largely around real estate sector. Plays a very important role in that. Now, to your point on speculation, wherever the prices goes up with volumes and it's such a large sector, there is bound to be some speculative activity. But that does not mean that the sector does not have potential. In the sector, there's a lot of potential. Within the sector, we like residential as well as commercial property. What we like are the companies which has large land banks, and therefore they are not under pressure to sell, and they can we can choose their launching time and which pocket they want to launch. Of course, there is a theory in the market that the real estate companies should not hold land and launch as fast as they can. But given the speculative activity that comes with it, and given the price ups and downs come with it, we would like our companies to kind of have that a strong balance sheet and land, so holding power to launch whenever they would feel it gets the optimum, the optimum from that land.
Okay. Rana, what's your stance on IT, both large cap and mid cap? We were just discussing this with the guest earlier as well, because now in general, sector valuations at about 30 times perhaps are reaching, some would say, optimal levels. But would you be willing to add more? And with what lens are you looking at IT?
Look, I think in IT one has to be somewhat bottom up, because the large companies in IT, they're basically, one is expecting the bottom line growth of 10-11%, and they're trading at 25, 26 to 30 times. So they can give you compounding, but I'm not sure 10% compounding is something that the investors all will be happy with. But bottom up, we see opportunities. Bottom up, for example, let's think about in the US, if the rate cuts were to come back, if the housing sales were to do good, there are IT companies bottom up that you can find which are a lot of exposure to that area, and because of that, they suffered in last 1-2 years. So they can make a big comeback. So like that, you can find out bottom-up IT companies who have suffered in the last 2 or 3 years because of exposure to mortgages and those areas, and they can make a big-time comeback.
Rana, what about these new age themes? Many of them, people were throwing in the towel and suddenly they have become the flavor. Everyone wants to, look at them. Zomato at these prices, it was less than a fourth of what it is currently. But now everyone's talking about the big opportunity. Similarly, even Paytm, it's been a rank underperformer, but from the lows, it's up more than 60%. Anything you like in this space? You can maybe throw in an Ola Electric as well in there.
Look, I think, we like this space. I mean, to begin with, we wrote a note about a year back from now, where we highlighted the digitization theme, and our subline for the theme is let the cash flow. What we understood at that point in time is that many of these companies, they have put in all the required investments, and thus they do not require a very strong top-line growth for the operating leverage and cash flows to play out. And frankly, that's exactly what happened for most cases, and we are happy to see that play out. So the key for us is, if a company builds a platform, how can they add services on top of that platform without making further capital investment? So therefore, the incremental return should be quite high, and that compensates for all the investments that they have made before. So we like companies in the, let's say, in the food services, in the quick commerce area. We like, those kind of platforms.
I mean, and it's incredible, right? I mean, if you run around the world, these companies have not done well. Most of these companies, but here in India, it's been a different story, especially things like Blinkit, etc. Now, of course, there is Zepto, which is also garnering a lot of attention. By the way, have you met the folks at Zepto, Rana?
Not yet.
That's a hottest new thing. I mean, we had, I think, the Motilal, the conference and Motilal representatives telling us that, I mean, the most sought after session was the session with Zepto. It kind of sort of talks about what's happening in that space and the excitement around that one. So yeah, you know, it's something we'll watch. I just want to take a quick look at the market as well. It's kind of like it's nothing, 5 points lower, 10 points up. So just middling around with no real directional move at all at this point. Cosmo First is down about 3.5%, 845. Panacea Biotech, which has had such a one-way move over the last 1 month or so, is down about 2.5%. So these are simply just you know, pullbacks and profit booking that we're seeing. Policy Bazaar is another one which is down about 1.5%. And I think I mentioned CDSL, which is down about 2.5% as well at this point in time. One new addition on the upside is Castrol, if you want to look at it. 275 on Castrol now. And, you know, there's been a constant bid for the Castrol whenever it's come off. The range on this one over the last 1.5 months has been about 230, 235 on the downside. And it's gone up to about where we are now, which is about 280-ish levels on Castrol. Ola Electric is the other one, which I think is making a bit of a comeback. So the low yesterday was about 118. And the high, the all-time high, of course, after listing was about 157, 118, and is back at about 131 right now. So a large amount of volume traded on Ola Electric as well.
Just one more stock, Gillette, which we highlighted earlier today, Prashant and Surabhi. You know, in 2019, the stock was close to 8,000 rupees, and then everything went wrong, you know, for them. So the stock currently is making a fresh 52-week high. The shaving trend has returned. You know, the middle, no one was shaving. The appliances segment has been firing for them as well. And the products that they have launched for women as well are improving. So that's why, you know, there seems to be some kind of optimism out there. It was an 8,000 rupee stock in 2019. So if you look at that, then it's only at 9,000 rupees after nearly around 5 years. But in the recent past, in the last 1 year, the stock has doubled actually. So that's why it explains some kind of optimism coming in there.
Nigel, about 20 years ago, Warren Buffett was asked about Gillette. And his response was in his quirky humor. He said, you know, men have one face, women have two legs. So that is Gillette for you. And it's just, it's a big, sort of over a period of time, over a long period of time, of course, it's a sort of a big wealth creator. I think used to be about 700, 800 rupees back in 2006 at about 9,000 rupees, 9,100 rupees at this point in time. But yeah, I mean, some of these businesses are looking good. Rana, just one quick point. So let's talk about what is ahead of us, right? Elections are, I think, going to be important. Some are saying, well, you know, general elections hardly caused a speed bump. So why should state elections really matter? Maharashtra is an important state. You know, I've seen some institutional brokers talk about how it's going to be a big one. It's going to either solidify the impression post the general elections or it can reverse it. Will it have a market impact one way or the other? Rana, what's your sense?
Sure. I think the state elections, you know, that way there are not just Maharashtra and Delhi, there are many state elections in the next 2 to 3 years. For us, the significant one was the central election. Of course, not to say that state elections cannot impact the market on a day or a week or even a month basis. It certainly can, depending on the outcome. But since even before the election and after the election, our view has been that the government, in terms of their spending, they had done a lot on the industrial, manufacturing, and the corporate incentive side between 21 to 24. And that now going forward, the incremental spending, while the spend will continue, but the incremental spending will happen on the job creation, on the consumption, to boost consumption, or the welfare side. I think that view absolutely remains, irrespective of the election outcome. I think that is something that we are, quite, confident about. And this kind of ties into what I said in the beginning of this call, that we like that, you know, the telecom and the consumer segments.
By the way, I just want to go back to NIIT. The stock is up again another 12%. We've been highlighting this. Something that is worth noting is that not only did Mr. Ramesh Damani sort of step into the company, check into the company with that 0.5% equity, promoters have infused money. They've increased their shareholding as well. The increase in the promoter shareholding is a little over 2%, 2.6% to be quite precise. And that seems to be bolstering a lot of confidence as well. The company is anyway guiding for, I think, 10% growth in the coming quarter as well. So the business has been looking fairly sound and solid. And then you have Mr. Damani putting in money, promoters putting in more money, and the market's absolutely loving the sight of that. The stock's done, look at 52% in just 14 days. Let's pull up a one-year chart. It'll give us an idea about the kind of surge that we've seen because of these recent actions. That's NIIT.
Maybe the other one is, look at, I mean, you talk about Mr. Damani putting in money. Look, the other one is Protean, right?
Yeah.
Protean, again, a company that he invested in. Stock, I think, I'm not sure, we'll have to confirm, but I think about 1100 or so was where he came in. Stock's now almost double to about 2050. But with Protean, it's essentially, and this is the thing with the market, with this wall of money which is coming in. I mean, the buzz around Protean is ONDC and, all the, of course, the budget also had some stuff in terms of mapping land holdings and how perhaps Protean could come in and a few other things as well. So a fair bit of excitement around all of this. But in terms of actual earnings, I think the company has seen earnings downgrades pretty much every quarter. I mean, you look at the last quarter results as well. I think, there were sharp earnings downgrades post the result. Profits themselves were down. And I think on a last 4-quarter CAGR basis, you're down about 20%, as far as Protean is concerned. But a lot of this some of these are, of course, futuristic business, and the bet is not every quarter or 2 quarters down the line, and you perhaps have to have a longer sort of time horizon. But I think what is undisputable is the fact that markets are willing to have that longer term time frame or that view. Rana, I don't know if you have a view on some of these businesses or if you own any of them.
Well, I'll just say that on a top-down basis, whether it's the companies that you were showcasing. So these companies are creating new markets and are transferring market share. For example, this ONDC did not exist a few years back. Neither there were any institutional market in quick commerce, and a few years back there was no institutional market in even food delivery, or for that matter, online insurance broking. So these companies, through their capital or through their technology or through their position, what they have done, they have consolidated the market. They have become a platform for someone's the companies who started investing 3 or 4 years back. They're already a platform, so they are getting the cash flows. So I have no doubt in my mind, seeing those examples, many people would want to repeat that. Some of them will be successful, some of them will be not. For that, a bottom-up analysis of each company is to be done.
All right, Rana, we'll leave it there. Great conversation, and thank you for staying on a little longer than usual and sharing your viewers. So 24,986 is where we are at on the Nifty. We're down about 25 points, and market breadth is now much closer. I mean, the difference between the number of stocks up and the number of stocks down, 1350 stocks are up, and about 950 stocks are lower at this point. Well, we want to play out some more sound bites, and this is from the exclusive interview with Rajiv Bajaj, CEO of the two-wheeler company, Bajaj Auto, and his sort of goal of surpassing 100,000 clean energy vehicle sales. Mr. Bajaj also shared insights on the progress of the latest launch, the Chetak. Listen in.
As we head into the festive season, in the months of September, October, November, we are very likely to cross a monthly sales production and sales rate of over 100,000 clean energy two-wheelers and three-wheelers. But I would hazard that definitely over 25% of our current revenue is already coming from or about to come from clean energy vehicles, which is quite remarkable. See that Chetak is now close to about 18% market share, or just above 18% market share. We are neck to neck with our able competitor TVS and their iQube. I think just a few hundred vehicles separate us. Having just launched a third product, there are more due later this year, within this financial year. We talked about it the last time we met a couple of months back. And I think post the festive season and before March, certainly there will be more Chetaks in the marketplace. And I could reiterate what I shared with you the last time, that not only will there be more Chetaks in the market off the current platform, hopefully very sharply positioned, but there will also be a new Chetak platform.
All right, let's focus on CSB Bank. Q1 was weak for the company. The highest decline we saw in the net interest income, and asset quality also deteriorated. However, the slippages declined in Q1. How is Q2 shaping up? What's the outlook for the remainder of the year? We have Mr. Mondal, the MD and CEO of CSB Bank, who joins us on the show. Hi, Mr. Mondal. Good morning, and thanks a lot for joining in. Well, let's get a couple of aspects out of the way. What is the growth you're penciling in for the year? And tell us what went wrong in the last quarter. The retail loan segment, I see, there's a decline of close to around 12%. Why is that?
Good morning, Nigel, and good morning to all your viewers. Yes, we had a slightly soft quarter last year, last quarter. But going ahead, I think this year we are on track in terms of what we wanted to achieve for the full year. Last quarter, we had two challenges. One is we had some regulatory kind of reasons for some NIM compression last quarter because of the because of the some of the income we are having on the interest side, that came down because of some regulatory reasons, penal interest as they call it. So that we didn't convert into penal income at this point of time. That will do from next quarter onwards. But this last quarter was to that extent a little soft. The other reason was that we are correcting some of our wholesale portfolio because our new team has joined. And that is where we are exiting some of the older relationships, not because they were any bad or anything like that, but because of the segments which we are going to focus on with the new wholesale team will be different to what we had been doing in past. So given that perspective, we are reorienting our strategy on the wholesale side. That's why we had a little bit of a softer growth on the wholesale. Also, some of our DA book, which was
okay, all right.
Well, on retail as well as on the wholesale side. So that's the reason we had a little bit of a soft quarter.
Okay, all right. So there were some, various factors at play. That's why Q1 was soft. Mr. Mondal, for the remainder of this year, what kind of a growth are we looking at? Point number one. And also margins did see some kind of compression in the Q1 for the reasons that you just mentioned. From here on, what is the range? I think in the past you've hinted at a number of around 4.5% to 5%. What should it look like?
So, Nigel, we have hinted around 4.5% to 4.8% in past on our NIM. We are on track to achieve that for the full year. Last quarter, we went below 4.5% for the reason which I told. On the growth, we do have ambitious plans. So we will be faster than the system by at least 30%. And that, what we have said, will continue. So we will see a growth somewhere between 18% to 20% on the asset side going ahead for the full year. And this quarter itself will turn it around in most of the ratios and parameters, because what we had in Q1 was really a one-off because of some specific issues, which has been corrected now.
Mr. Mondal, hi, morning. So let's talk about gold a little bit, right? Gold prices are up and up. If you believe some targets, it's headed to $3,000, higher, according to a few. What can it do? I mean, if we are going to see a bit of a structural kind of move higher, quarter after quarter, what can it do for your gold lending business? Certainly good news.
Yes, I think the international gold prices are higher for obvious reasons because of the overall Fed commentary and other reasons. However, there had been tax reasons that rates came down in India because of the recent budget announcements. But that has been offset by the international gold prices. So to that extent, overall, I think it is at the similar kind of a level where it was prior to the budget announcements. So given that, I think in India, it has not made too much of a difference, and hence our LTV and everything has remained the similar kind of a levels where we were before. Going ahead, as we see Fed interest rates coming down and things like that, we see bullishness on the gold loan business as well as gold prices. And we are fairly bullish that we'll continue to do well on that business. It's good news for everybody, for consumers, as well as for the banks at this point of time.
What's the sensitivity to your business? I mean, is there a sensitivity? I mean, can you numerically for gold prices and what it does to your sort of lending?
See, gold prices, you know that generally the LTV is around 75% as per regulatory norms as well. So to that extent, the risk related, we always have a 25% buffer plus the making charges and some other emotional quotient which is there with the ornaments. So given that, I think a 10% drop won't make any difference to anybody at this point of time from a risk perspective. However, as it goes up, we are of course cautious because we know that what goes up can come down as well. So we manage our LTV accordingly. And these are short tenor businesses. So in a short tenor, you don't expect, because each of the tenor of these loans are anywhere between 6 months to 1 year, you don't expect too much of volatility in the prices at this point of time. So to that extent, we have been running this business for so long with sensitivity analysis. So we know how to run this business. So we don't see too much of an issue. But it's a good thing for us right now at this point of time because gold prices are going up and hence we can look at expanding our business further.
Okay, got it, Mr. Monal. I guess just going back to the point on margin. So you're saying, I think that what you're referring to is the change in regulations with respect to penal interest. And, you know, when the RBI was batting for borrowers saying that whatever is the penalty, it cannot be sort of counted as part of the interest and as part of the loan. But you're saying that's been rectified. So you're back on track to deliver 4.5% margin for the full year. Let's talk about asset quality as well, because in the first quarter, there's been some deterioration. We'll just get the numbers up on the screen as well. Your gross NPA is now moving up to almost 1.7%. So that's one concern. We'll have the GNPA numbers in just a bit. Yeah. So that's one concern. The other concern, sir, is going to be on deposit mobilization and CASA, because your CASA ratio is falling very rapidly. Now it's below 25%. It used to be around 30% a year ago. It used to be, I think, 27% just a quarter ago. So let's start with asset quality and then tell us what you're doing with respect to CASA.
Sure. So as you can see that our slippages have already started getting under control. And as we look forward, without making a forward-looking kind of announcement, our slippages are looking under control at this point of time. And we hope that will remain for the whole year. So we had one-off kind of a thing for the last 1 or 2 quarters, and that has been corrected. So to that extent, we don't see further increase in slippages at all. If at all, it will start coming down now. And to that extent, there will be lesser or no impact on the GNP and NNPA side. And we expect it to marginally come down as well from the current levels in the full year basis. Coming to the deposit, I think, and CASA, I think that's a systemic issue. There are structural reasons why deposit accretion and ability to utilize the deposit to our asset growth has a challenge, because there are so many parameters we have to look at, CD ratio, LCR, so many other things. And to that extent, I think CASA ratio is another important thing, and NSFR, all these things are important. But from a CASA franchise, I think overall systemic, there has been a compression of 4 to 5%. Our situation is also similar. We originally had a lower CASA ratio. So that is, we are following the systemic compression at this point of time. But
just give us a number, sir, if you can. Sir, I'm a little sorry, apologies over there, just because we're running short on time. If you could guide for some sort of a range or a number, CASA by end of the year, and a GNPA level that you're comfortable with, where you want to be by 31st March.
Yeah, I'll say that. But quickly, the more important thing on deposit franchise is LCR and CD ratio, on which both we are very, very comfortable. LCR is 117, 118%, and CD ratio is between 82 to 85%. We are one of the better placed private banks in the system. Coming to the specific question on GNP and NPA, we will be better than currently what it is, and hopefully will be somewhere between 1.5 to 1.6 on the GNPA side. And NNPA will be somewhere around close to maybe lesser than 50 basis points. So that's the way we are targeting for the full year basis. Quarter to quarter, we'll see how it plans out. On the CASA, I think we'll be somewhere below 25% at this point of time. But as I said, that we are not focusing so much of CASA because we are building our CASA franchise. We are looking at other parameters on deposit and funding franchise, where we are probably better than many other private sector banks in the system.
All right, Mr. Mondal, thank you very much for joining us. It's a pleasure. Appreciate you sort of coming on and talking to us and sharing what you make of things. You know, I just want to highlight 2 specific names. If you can highlight, you can put up Religare, the stock. It's down 1.5%. And I think our colleague Vivek highlighted some of this yesterday. The high recently was about 280. From 280, it's down to about 260 now. That is Religare in 2 or 3 days. And of course, the immediate trigger really has been the management postponing the AGM to December. Investors have not liked it. That is one. And the second is Orient Cements. Orient Cements had a big fall yesterday. So, from the previous close of 330, it left off at about 310 yesterday, and it's down to about 305. That's a sharp cut. Here there was, of course, speculation that, it's in the play as an asset which is going to be sold. There was the name of JSW, which was doing the rounds as well, JSW Cements. So we'll have to see if, something is, is it kind of gone cold or something is happening. But there was a marked move in Orient Cements and not other cement stocks. So perhaps something to do with the company and, of course, what the hopes and expectations they were. Markets down, of course, 18 points right now, 24, just under 25,000 right now. Nigel.
Okay, all right. Let's move on then. Let's get our next management on the show. We have Vinity Organics now. The company has given a revenue guidance of around 20% CAGR for the next few years. Brokerage, they have a mixed view on the stock. Motilal Oswal is positive. Kotak Institutional is a little bearish on the stock. To discuss the business momentum, the growth outlook, we're joined by Vinity Saraf Mutreja, the managing director of the company. Hi, Vinity. Good morning, and thanks a lot for joining in. Well, tell us, how's the year shaping up? Earlier, you were holding on to that guidance of around 20% growth, I think with margins of around 26 to 27%. Let's get both these two basic numbers out, and then we can focus on the business outlook as well.
Well, good morning. And these two basic numbers remain quite the same. We are seeing good growth in demand for most of our products, especially ATBS, especially compared to last year. IDB remains stable. We have gained market share in butyl phenols. Antioxidants is also picking up. And we are increasing revenue from that segment as well as the new products are shaping out well. So given all of that, we do expect a 20% growth this year, and I would expect EBITDA margins to be in the range of 26-27%.
Got it. All right, Vinity, I'm looking at a Kotak note, and they are talking about the ATBS segment. They're saying a new competitor, a smaller player, Atlantic Finechem. They have come in there and they have garnered close to 3 to 5% of the market share. Some believe that it could be a potential risk where you have a small player coming and creeping in there. What's your comment on it?
Well, Atlantic started production about a year back. From what I see in the market, they're still very, very small. And having said that, the demand for ATBS is very good. My new line for ATBS is coming up by the second half of this year because I have that sort of order book and my customers do want more material. So I really don't see that as much of a threat or really eating into our revenue.
If you could just expand on that. So let's complete the point on ATBS. Let's talk potential from this new capacity. First year, how much will it be working at capacity utilization? When it hits peak levels, then what's the revenue and volume implication? So ATBS, volumes and revenue projections for this year, and then once you hit peak with the new capacity.
Well, ATBS contributes to about 40-45% of our overall revenue. Now, what has happened is that the demand for the higher grade, the higher purity ATBS is very good, which actually limits our production. And hence the urgency to start the new line, the new production line. We do expect that the new production line has a total capacity of 15 to 20,000 metric tons, depending again on which grade we are producing. We do expect to reach that at full utilization in the next 2 to 3 years.
And then what will be the revenue implication? Also, just give us a sense, again, in terms of, the volumes that you look to do this year, the volume growth on ATBS, how prices are expected to shape up. And then also that number, when you hit the peak production, which is 2-3 years down the line, then, what's the volume then versus now?
Well, see, we are also adding new products. A lot of our volume growth is going to come from antioxidants, from butyl phenols, from Viral Organics, which is a subsidiary where we are making specialty chemicals such as MEHU, glycol. So they will also add to revenue. So the revenue share for ATBS will remain below 50%. And that is really the idea, to be not heavily dependent on any one particular product.
Got it. So, Vinity, then you mentioned 3 products, I think. So, 3 product lines that you're bullish on. Antioxidants. For this year, what does it contribute? FY25, how do you see it panning out? Viral Organics, I think you mentioned that was the second one, and butyl phenol. So a rough revenue range of all these three.
Yeah, correct. So as of now, butyl phenols and antioxidants together is about 20%, maybe 18%. Again, going forward, this antioxidants will increase. Butyl phenols are probably running at capacity, and some of it will be used in captive production of antioxidants. So this number will go up to say about 30%. Viral organics, we have just started. We are right now in the trial phase where our product is getting sampled, tested. We are also still optimizing the plant yield. So that will take some time to add to our revenue, maybe in the next 6 to 9 months.
Okay, so let's talk about the big numbers then, Vinati. The guidance that you've sort of, I think, spelled out is about 20% top line growth for this year. This margin, 26 to 27%. Any other lever that you see to perhaps push the margin higher, or will you stick to this range?
No, we definitely stick to this because, see, we do have about, we have formula-based pricing, contractual pricing, where our final product price is dependent on the raw material pricing. I don't see the margins fluctuating given our product mix now and going forward. This is a good number if we can maintain this over the long run.
Okay. All right, Vinati, we will leave it on that note then. Thank you very much for joining in. We'll take a break and come back on the other side. We'll be putting the spotlight on the Unified Pension Scheme. All the details and a discussion coming up with Indraneel Sengupta, Professor of Practice, Shiv Nada University, and Senior Journalist Sanjeev Srivastava.
Okay, welcome back. You got the market, which is up 25 points, and we're about, 40 points away from the prior all-time high. Look at the bump, which is materialized out of nowhere, about 26 points in the green. Now, over the weekend, the centre has unveiled the new Unified Pension Scheme, the UPS, for government employees. That basically is a marked departure from the NPS scheme, which is the new pension scheme. And also different from the old pension scheme, which was, of course, prevalent for government employees who joined before 2004. Many, of course, have called it, something which the government is doing with an eye on the elections, which, many of these states which are going to polls have been demanding a restoration of the old pension scheme. And more. Some are still, unions, etc. For example, states like Haryana are still saying that this is not enough. We need, nothing will do but a restoration of the old pension scheme. But let's talk about this a little bit with Indraneel Sengupta. He's Professor of Practice at Shiv Nada University. He's, of course, also a sort of a veteran analyst from financial markets. Indraneel, great to have you with us here on the program. Sanjeev Srivastava is Senior Journalist. Sanjeev, great to have you back on the program. Thank you very much. Indraneel, so how should we look at this UPS? The government is saying, well, it's a balance between NPS and OPS. In terms of actual sort of fiscal implications from what the government itself has shared, it's not very much, right? Because there is the contributory element which is there under this UPS, which was not there under OPS. Although the government is picking up the tab a little bit more. So your first thoughts, Indranil?
So I think that, first of all, thank you for having me. I would say that if you look at the OPS, that let us index at 100. The NPS was somewhere around 20. The UPS is going to be somewhere around 80. So in the OPS, obviously you were, it was a defined benefit concept. In the NPS, it was a defined contribution. But then obviously, given that government salaries are what they are, that fell dramatically from the OPS levels. In the current UPS, it's closer to the OPS, I will say. But of course, you are still making some contribution. So that's one. Right. The second is that I don't worry about the fisc too much because this has been going on. It's all, currently the government is, has a fiscal outgo pretty much on the OPS levels. And for the NPS to have worked at all, given that the first, most likely people who joined at 2004 were at least born 1980, they would retire in 2040. And then for that to become a significant cohort would have been 2050, 2060. At the same time, there is going to be a substantial wealth effect, and that should actually lead to more demand for, maybe autos, maybe housing, and that should also be a boost to the economy.
So, and we should put that out. What you're saying is the net present value under, if NPS was 20, under the new UPS is 80. It's not quite 100 like it was under OPS, but it goes up to 80, close to the old pension scheme, right?
Yeah.
So it's substantially more for employees under the UPS. Got it. I'm going to come back to you on that wealth effect point because that's interesting. Sanjeev, your first thoughts on what has been done and whether this is now going to be broadly acceptable?
See, so whether it will be broadly acceptable or not, Prashant, is depending on how much the unions can press for more. Because clearly an indication is coming from the government that they are willing to be or they are vulnerable or susceptible to being pressed for more. So this entire exercise is another step or another link in that trying to process the election outcome of 2024, wherein the BJP missed out on majority. So I wouldn't say that this is a rollback, but or some kind of scaling down in a big way, but it is what the government is trying to learn from the election outcome as to why they lost out. So one reason they have attributed to, and I don't fully agree to that, they lost out because of the OPS not being there, but this trying to please different constituencies, keeping that on the radar, this step is being taken. So somebody like you or Indranil will be better able to crunch the numbers, whether it's 80 on the old pension scheme and new pension scheme scale or 70 or 85. But what it signals is that the government, they're both positive and negatives to it. Negative is that they have become vulnerable, whether it's the Waqf thing being referred to the parliamentary committee going or other things. And this is another link in that direction. But the positive is that they are very good to adapt. So they're trying to learn from what real or perceived mistakes they made. So these are constituencies they want to address and get them back on board before the next election. I think it will be too late for a Maharashtra or Haryana kind of an election, but the big elections coming up, including the next big election, general election. So, but what is clear is that the government is vulnerable to listening, which was less of a listening government few months back. So that is both good and bad of how much a wealth effect is created, what really is...
Sanjeev, points taken and good points there. By the way, the elections are still not that far away there. We don't know. But what's your number for Maharashtra?
Mine?
You always have... Yeah.
You always put me on a spot. Well, I think Maharashtra, I don't have a number, but I think the BJP is and its allies, which is the present government, they are all on the back foot. So as things stand, they should lose.
Okay, all right. So at the margin, this may help, but will not do quite enough. The pension thing, right? I mean, it's just one constituency in that sense.
Yeah, because the government can't afford to keep sitting on its heels. They are 240 in the national parliament, and if they lose some key states, they need to be acting, and that's what I see as a positive for this government. At least they are proactive. They're trying to course correct. Now, whether that course correction will help or not, nobody really knows the answer. But at least they are reactive, which they were choosing not to react in the run-up to elections.
Indranil, let's come to the wealth effect. So, first of all, a lot of this will only start to show up post-2000, approximately 39-40, right? Because for those who joined after, for those who joined after 2004, right, who entered service after that. But do you see this leading to increased spending in that sense? Because would people have not spent on a car or something on the wedding because thinking, well, you know, the pension is lower? I mean, I'm just trying to understand, what will this do for employees here and now over the next couple of years?
See, the fiscal cost is 2040 plus.
Yeah.
But the wealth effect is immediate.
Yeah.
In the sense that, you know, earlier you were staring at a scenario where you would get only, say, 20 rupees to live your life beyond retirement. I mean, this is assuming you live a while. But now you see that going up to 80. So the savings that you were having to make on, you know, your retired life, now you can spend that today. Invest that today, maybe, you know, whether it is in a house, whether it is in a better car or whatever. So the point I'm making is that, you know, the impact on the fisc is going to come much later, but the impact on individuals' sense of well-being is going to come right now.
And typically something like this shows up in which segments? Which sectors or subsectors?
So I would think that housing is the biggest one, because you know, the government housing loan is also very limited given the current market prices. Cars could be another. So housing, I mean, that gets to its whole interrelated sectors of cement and so on. But then I think that is where most of the wealth effect that civil servants will get will go.
Got it. Gentlemen, a longer chat, but later. Thank you very much for joining us with an interesting sort of perspective on the pension bit and, of course, politics as well. Indranil, good to speak with you in the new avatar, and here's to many more. And Sanjeev, always a pleasure having you with us here on CNBC TV18. Thank you very much. We'll take a quick commercial break here. We are back. We'll focus on... Okay, I think we'll go to Mitesh and just ask him for his view on what the market is doing and any fresh trades he might have. Mitesh, over to you.
So, Prashant, I think the market has recovered very nicely. You know, I would have preferred a bigger dip to buy into it, but then it's okay. The direction remains on the upside. I have a buy on ABB. That's a buy with a stop below levels of 78.10. Look for targets of 8,050 to about 8,100 here. And the other call is GNFC, which I would recommend buying with a stop at 674 for targets of 710.
Okay. All right. Got that. Mitesh, thanks very much for your calls. Market is managing a 20-point up move, which is perhaps not bad given the kind of cues that we started off with. And the mid-cap screen is looking even better, 0.5% up on the mid-cap index. So it's literally up and away. Remember, yesterday we were talking about a move on Tata Elxsi. Well, guess what? That's happening again. There was a 9% sort of upward thrift yesterday as we were closing out, 6% this morning. GSPL's run has not stopped at all, still up about 5%. It's off the highest level of the in the opening high, but it's still up about 5%. Subros is up about 7.5%. MediAssist continues to run on that acquisition. So the short point is that the broader market, look at Tata Investments, by the way, up about 7 to 8% as well. So lots of stocks buzzing around on the broader market screen. We'll take a break on that note, come back on the other side. And then, of course, we'll discuss commodities with Manisha Gupta. Welcome back. It's time to talk commodities. Let's go across to Manisha Gupta. So much going on, Manisha, with geopolitics, and all these issues. Now, Libya's shutting off crude output. Tell us, what do you have your eye on? Starting maybe with oil itself?
Oh, well, yes. The crude oil prices, last evening's or last week's decline was at around 76. We're trading at 81 right now. So $5 of a gain in 5 days is what crude prices have done. But with the kind of decline that we've seen happen in US dollar index, the expectation that the Fed rate cut will now happen also seems to be supporting the base metal prices in a big way. Remember, the month of June and July were not so good, but the month of August clearly seems to be ending on a positive note for many of these metal prices. We have seen improving Chinese demand at lower levels as well. China did not buy metals at higher levels, but with the kind of declines that we've seen in many of these metals, 18 to 20% off their highs, there is buying in China that really seems to be happening as well. And as I was telling you, there are hopes of a US rate cut in the month of September. The US Fed would be doing it the first time, but we also have seen other banks do it. And the expectation that more global central banks would be cutting rates yet again in the month of September has been supportive for many of these asset classes. The markets also are looking at US imposing the sanctions on non-nickel subsidiaries, and that could really impact supplies for many of these metals, which also has been supportive. So Nornickel's subsidiary Bystrinsky does produce a lot of copper and gold. It also does iron ore, and we've seen some premium build up into many of these metals because of this one news as well. So if you look at the copper prices, we are trading at a 5-week highs right now. For the month of August, we are 4% up in the month. Aluminum prices also are trading at a 5-week highs, and it has been an outperformer when you look at metals as a sector. 12% up in the month of August, and we are trading at a 5-week highs. Alumina shortage, stronger demand, higher imports from China are supportive factors. Zinc also has been gaining quite strong. There are concerns and there are a lot of consultations as well on cutting output going forward in zinc, and that has been supportive. We've seen prices gain up by 15% in the month of August so far. Also, when you look at the kind of lows that we saw in August for zinc was at $25.88. We are trading at $2,900 a ton at this point in time. Strong support also has been seen in case of steel as China looks at cutting output. Iron ore prices have extended gains, hitting $100 a ton. Prices are up 4.5% in the matter of previous week itself, and the China port stockpiles have continued to decline. The one data that the street will now watch out for is the China PMI manufacturing data that comes in tomorrow. That would give you further direction.
All right. Manisha, thank you very much for that. That's commodities in focus. Markets are flat, 5-point change on the Nifty. We take a quick commercial break here, and we're going to come back with an interesting conversation. My colleague Lata will be speaking with Vetri Subramaniam, Chief Investment Officer at UTI Asset Management Company, and they talk about the first quarter earnings, where earnings are going from here on, top sectoral bits, and what after new highs on the Nifty. Stay tuned.
investing.
Welcome to Market Masters. The Dow Jones hit all-time highs overnight, and the Nifty now is just inches away from recording a fresh all-time high. This despite the Q1 earnings actually disappointing a bit. The markets are now, the Nifty is now perhaps trading nearly at 22 times 12-month forward earnings. I think the long period average at best is 20 times. Where do we go from here? And where does one invest at such high valuations? For all things macros and markets, I'm joined by Vetri Subramaniam, Chief Investment Officer, UTI Asset Management Company. Vetri, good morning and thank you very much. It's been a long time having you on the channel.
Good morning, Lata. Great to be here as always and have this conversation.
Well, first up, these all-time highs that we are trading at, does it make you elated that we have, steadily climbing, not looking back despite so many adversities in politics, in commodities, in global markets? Or is it making you nervous at highs?
Well, I think in some senses, I'm happy to see that there's a lot more domestic participation because, I've been professionally engaged with the markets for over 30 years. And I would say pretty much for the first 20 years of that, it was all about foreign investment. So I'm glad to see that there's a lot more domestic participation and wealth creation, which is happening for our local investors during this last decade. But, obviously, when prices tend to demonstrate very low levels of volatility, we haven't actually had a very significant drawdown for any significant period of time. And in some segments of the markets, valuations are looking sort of worrying. Then you do worry that, the cyclicality of the beast will reassert itself at some point of time. So that is certainly something to worry about. And I would only urge all investors not to get carried away by price momentum and to stick to their asset allocation, which is based on their financial goals.
Oh, yes, sir. Too often I hear people comparing bank deposit returns to mutual fund returns, not recognizing that the latter is not a fixed return. But to stick with the macros, the Fed statement, the Jackson Hole speech, and the possibility of rate cuts, one would think that a double rate cut on September 18th would actually be negative news, isn't it? A rate cut actually signifies that the most conservative force in the economy, the central bank, is actually saying they're worried about markets. But here we are seeing the Jackson Hole speech as a spur to all-time highs.
Sure. In a way, I would actually say there was nothing new that came out of Jackson Hole. In a way, I think the markets were already preparing for this. There was just that slight, moment about 3 or 4 weeks ago when people, I think simultaneously worried about the Japanese carry trade and about the fact that the US economy might be heading straight into a recession. But I think the data that's come out subsequently suggests it is slowing, but it is not slowing in a way that policymakers should panic. And obviously, markets panic a lot more easily than policymakers do. I think the bigger message that I would still tell people to focus on is that era of low interest rates, when we were accustomed to policy rate settings being at zero, when we were accustomed to policymakers talking about the challenge of getting inflation up to 2%, is now gone. I think that decade is in the rearview mirror. We now need to readjust to a Fed which could cut rates, but is still unsure about getting it down to the 2% target. And therefore, the kind of policy rate that you're talking about will look very different to my mind over the next 5 to 10 years as compared to what it used to be in the previous decade.
Okay, but do you think there is still a fear that the August payrolls turns out to be very bad and we can still get a hiccup this year? Or do the other data look too good?
I think so far on balance, the US economy is slowing, but against all expectations, certainly it has remained much stronger than what anyone anticipated. And I don't really see it hurtling into a recession unless there is an external trigger now, whether this comes from politics, whether this comes from, abrupt changes in fiscal policy because of a new administration. Those would be extraneous. But I don't see the economy itself, based on the data that's coming in, heading into a deep slowdown at this point of time.
Or even American fund managers are not willing to indulge in what will happen after November 8th. So let's not get there. We'll have to cross the bridge when we come to it. Let us look at Indian valuations itself. Do you think, as many fund managers have told us, it's best to stick to large caps now that mid caps are presenting a picture of exuberance?
A good question, Lata. Actually, even before you go to the question on large caps, right, we run our internal valuation models, which run the asset allocation, schemes that we manage internally. And remember, in some of those schemes, the sort of, equivalent weightage would be a 60-65% equity valuation when we think equity valuations are fair. Those allocations have actually drifted down now to 45 to 47% equity. So effectively, we are going underweight equities relative to the range in which we operate because valuations are unattractive. So I think that's the number one message that I would point to from valuations of equities, to say you should actually be looking to cut your allocations to equity. Maybe you're overextended because of the mark-to-market gains you've had. Within that context, the small cap and mid cap space is where our valuation concerns are extreme. Very rarely in my career have I seen small caps trade at a premium to large caps, and we can go through the whole host of reasons why that is a dangerous thing to be dealing with. Within that context, there is some relative comfort in large caps. We actually published a blog about this recently. Whether you look at it from valuation point of view, return on equity point of view, the share of market cap coming from large caps, many reasons to believe that large caps provide some relative valuation comfort at this point of view. But the bigger message is asset allocation, and that's where I'd like to conclude.
Oh, okay, actually, why don't you explain a little more on this? Because it is very tempting for a market anchor to go off into financials and EMS companies and e-commerce, which I'm going to ask you, but a little more. So you think we should all be, those of us who are not tracking markets and our stocks on a daily basis, who cannot do it even for professional reasons, it's best to go to a balanced fund then?
I think so. Our push to people has been, this is a great time to go into hybrid strategies because they do sort of protect you from the risk of an elevated equity market, and particularly the ones where asset allocation is being managed by us based on certain models, and those models are telling us caution. So if you're going to approach the markets from the point of view of my neighbor is making more than me over the past 1 month, so I need to find a higher risk strategy, then hybrids are not for you. But if you're looking from the point of view that, okay, I need to have some exposure, but what's the best way to position it such that I can handle any downside risk and look to participate in equity growth over the next 5 to 10 years, then hybrids, to my mind, are actually a far better option at this point of time. And also note, Lata, that actually, if you look at real yields in India, they are reasonably attractive. Now, because of taxation issues, people are unhappy with bank deposits, they're unhappy with fixed income mutual funds, but the hybrid mutual fund actually gives you the best of both worlds because it rebalances seamlessly, and at the same time those fixed income returns are coming through in a strategy which is, from a taxation point of view, more advantageous.
Personally, I think that is the only intelligent thing I have done in my life. It may have been because of laziness or professional constraints. But Vetri, we have to talk about sectors. And the sector I cover, of course, more intimately is banking. It's not been the darling for the market, especially the private sector banks. Do you think it's time it got a look in? There are enough problems. Deposits are expensive, margins are under crunch, they have to put more money in bonds because of LCR, etc. But valuations-wise, is it good to look at them again?
I'm 100% with you on this, Lata. In fact, I did one of the programs on, your channel 2 months or 3 months ago, where I said, banking is pretty much one of the only absolute return investment avenues I can think of in equity at this point of time. It's done reasonably well since then. Nothing which has set the house on fire, still not really outperforming the Nifty by a big margin. But I think those arguments remain. First and foremost, balance sheets give me great deal of comfort in banks, and eventually in banks, that is what matters more than anything else. Point number 2, the valuations give us comfort both in an absolute sense as well as relative to where the market is. So that gives me comfort. Now, are there a few problems? Are the banks having to back away from some unsecured loans? We know some of them have talked about challenges there. We know about the liquidity challenges in terms of peak NIM being behind them, which was last year's NIMs. But I think all of that is reasonably well known. And I think some of these are cyclical as well. Remember, RBI at its tightest point a year ago was holding liquidity in negative. It's gradually come to where we think it's more normalized, and there will come a point where it will start to look more surplus. So banking liquidity to myself is more important than looking at is money going to the stock market, taking away from money goes to the banks. No, it doesn't, because the money stays in the banking system. The kind of deposit may change for the bank. It could have an LCR implication for them, but the money stays in the banking system. So, let's not lose sight of that. So my mind, the arguments on banking are cyclical. That's why you're getting attractive valuations, but that is the time to go out there and invest. And this is what we said about healthcare 2 years ago. This is what we said about automobiles all the way back in 2021, when I said, how many sectors do you know in India where volumes are running lower than peak volumes seen 3 years ago? And auto has done spectacularly well since. So I would say the same for banking today. These are cyclical issues holding back the stocks, but that is really what gives you the opportunity.
Oh, that's amazing analogy. I remember all the conversations we've had about automobiles 2 years ago. Vetri, the places to avoid. I mean, look at the e-commerce valuations or the EMS valuations. Great companies, but your word on these.
Yeah, look, on e-commerce, it's always been a challenge, right? I mean, stocks some of them have done well since their listing in 2021, 22. But valuations were hard to understand. Even then, they're still hard to understand. Now, I think over there, you've got to go with the fact that some of these businesses are changing the way we consume. They're very capital efficient. They're high return on capital businesses. And the competitive environment is no longer favorable towards companies burning money. They're all under pressure from capital providers to manage their profitability and their path to profitability far better. So we still like some of those businesses. We are still invested in them. There are some of these names we bought in the IPO time. They went up, then they came down, then they're back up again. We're still invested. We are still happy to hold because we think there is a long-term story. But, are today's valuations the most attractive? Maybe not. But sometimes I would always say these businesses, particularly those that have a platform quality, they're not linear businesses. I don't talk stocks, but it's public matter. We invested in Zomato when the IPO was there. We're still invested in a very big way. Now, whoever knew that quick commerce would be a business that actually would create value for them? So I think these are some of the advantages sometimes in good managements and platform businesses that are not immediately appreciated straight out of the bat. And which is why we continue to own some of them. At what value you choose to buy them, I think that's a more subjective decision.
Okay. I'm not even halfway through my questions, but I have run out of time. I'll take a rain check from you for another day and another conversation. Thank you very much, Vetri, for some very useful tips on how to approach investment. That's it on Bazaar. We are leaving the markets pretty in the green in the first place and pretty close to all-time highs. Let's see if we can chalk it up in the next few hours. Chartbusters coming up after a break.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
Well, the Unified Pension Scheme, or the UPS, is the government's latest response to the backlash against the National Pension Scheme, primarily due to its lack of fixed pension and the uncertainty tied to the market-linked investments. So how does the new UPS compare to the old pension scheme and the NPS, and what does it mean for the government employees? Here's a quick breakdown. The UPS guarantees a pension similar to the OPS. If you have served at least 25 years, you will receive 50% of your average basic pay from the last 12 months before your retirement. Even with just 10 years of service, you are assured a minimum pension of 10,000 rupees per month. This is a significant improvement over the NPS, which didn't offer any fixed pension and was subject to market risks as well. One key difference between the OPS and the UPS is that the
Third-party insurance administration service provider MediAssist surges as it announces the acquisition of Paramount TPA for an enterprise value of 312 crore rupees. Brokerage Investec is also bullish on the stock.
NIT surges 15% today. It's up close to 50% in 3 sessions. The promoters hike stake and noted investor Mr. Ramesh Samani picked up 8 lakh shares in Friday's session.
Block deals continue on Dalal Street. Tata Tech opened with losses but recovered from the lows of the day after 3.3% equity changed hands at around 1,027 a share. Rolex Rings, on the other hand, has also rallied after a block deal saw 2% equity change hands.
And Bondada Engineering is up close to 5% circuit, with the company winning an order worth around 576 crore rupees. Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me is Hormoz Fatakia. Well, Hormoz, that's sort of for day. Well, we have some bit of consolidation, which I think is par for the course.
Indeed, and that's what the market has been doing, right? We're continuing to trade close to those record high levels for the Nifty as well, trading with almost at the flat line actually. Now 25,000 on the index, 25,078 continues to remain that level that we need to watch out for on the upside. The Nifty Bank also doing precious little at the moment, continuing to trade with minor losses of close to around 80 points. But it is a pharma index that is leading the gains in today's session, 0.8% higher. The broader markets are doing well. They were sluggish in yesterday's trade. The small cap index is up 0.6%. The mid cap index also trading with gains of around 0.3%. So nothing much to complain, I guess. But yeah, consolidation is the word.
Well, that's right. Well, let's focus on the primary markets then. Solar cell manufacturer Premier Energies, 2,830 crore rupee IPO has opened for subscription today. The IPO will close on August 29th. Well, the first guest on our show is Mr. Chiranjeev Singh Saluja, the managing director of the company. Hi, sir. Good morning. Welcome to the studio and welcome to the markets. You know, you have been running this business for a while, but now you're going to be listed, so we'll be interacting more often as well. Give us a broad sense, a few numbers if you could, in line with what the regulations are. What's the current order book and the potential order inflow that you're looking at for this year?
So the order book, Nigel, is about 5,900 crores. What we have, it's a kind of a robust, strong order book, which we have. This is going to be a realization cycle of 18 months. Okay. The order has to be executed in. And in terms of the demand which we are seeing in India and in the US market, it's very strong. And that's the reason for the expansion. The primary raise, what we are doing is a 1,291 crore raise. Out of that, about 1,000 crores is going into our greenfield expansion. That's a 4 gigawatt solar cell and module line, which we are setting up in Hyderabad. So with this capacity expansion, we would increase our present capacity, which is 2 gigawatt cells, to about a 7 gigawatt of cells, and from 4 gigawatt of modules to 8 gigawatt of modules.
Indeed. Mr. Saluja, first of all, welcome and congratulations on the IPO as well. And I had to ask you, so you mentioned that you're going greenfield expansion in Hyderabad and all of your 4 facilities, if I'm correct, are located in Telangana, in that state itself. Do you plan on expanding beyond that state, or does regional concentration act as a concern as well?
So we have plans for backward integration, and we have signed an MOU with a Taiwanese company with whom we are setting up an ingot and wafer facility, which is a backward integration of solar cell. And this facility, we're looking at moving out of Hyderabad. We are looking at various zones across India where we could set up this new facility. And on geographic expansion, we are also setting up a facility in the US, There again, we have tied up with a large module manufacturer based out of US, having a 20 years of experience in module manufacturing in America. We will be setting up in a JV, a solar cell facility with them. That's where our expertise comes in.
Is there a geography that you have zeroed in on India as to where you want to expand beyond Hyderabad?
We have still not finalized. We have shortlisted about 3 locations, but we are still discussing.
All right, Mr. Saluja, last year you did around 3,100 crores of revenues around about. Now, going by the expansion that you're talking about, what is the optimal revenue potential that you can do?
So we are growing at a CAGR of about 100% year on year. That's because our capacities are doubling in 21 to 23. We almost doubled, and now 23 to going to 26 will be doubling. So we are looking at capacities doubling, and hence even the revenues because of the increase in the operational capacity.
So post this expansion, the revenue potential of the company will be roughly around 6,500 to 7,000 crores. That's the potential. We're not asking for a guidance.
Yes.
Got it. Also, how's your balance sheet looking?
So today we have seen a great turnaround in the company because 21-22 was the year when we had just set up our large-scale cell plant. It takes about 2.5 years to set up a cell plant and about 6 to 8 months to even stabilize these lines because of the complexity of the chemicals and gases what you use. And with the lines getting operational, we have seen a significant growth in our EBITDA margins starting January 24. Our last year was good. Q1 performance also is demonstrated in the RHP, which shows a significant growth.
Mr. Saluja, for this quarter that ended in June, almost 80% of your top line came from your top 10 customers. Do you plan on bringing that number down? And also, are there more customers in the pipeline that you plan to bring on board?
So our business is such that, you have customers who are setting up power plants, and these power plants have a certain COD when they need to commission. So our concentration of the number of customers will remain around this, but every quarter the type of customer changes. Right. So depending on when their plant commissioning dates are. So it's 10 customers, but then it changes every quarter.
So you don't see it as a concentration risk?
It's not a concentration risk at all.
All right. Just getting back to the point that you were making with regard to the profitability as well, we're not asking for a guidance, but sometimes ahead of an IPO, suddenly the margins look good. And for you as well, you're moved into the mid-teens from single digits. Do you think this sort of a margin profile is sustainable?
So again, my answer to this question is that the solar cell lines, they've got stabilized, and you see the change in the margins in the last 8 to 9 months.
Yes.
And this is not because of any big change, except that the lines have got stabilized. So we feel that this will continue.
Got it. And I didn't get the point about how's your balance sheet looking. What's it? Do you have cash, debt in the books? What is it?
So we've got 1,398 crores of gross debt. As of now, our net debt is about 980 crores. We will be taking a new debt of about 2,200 crores for this expansion, which we are doing. That's a 3,400 crore project, which is a 4 gigawatt cell and module. About 1,000 is coming from the primary and rest is debt from IREDA, which is the Indian Renewable Energy Development Agency. So on total, we are looking at our debt a peak debt going to about 4,000 crores by FY27.
And what is the borrowing cost of that?
So IREDA is very supportive in promoting manufacturing in India and also development. They've got very competitive rates, so it's about 9.25% is what they lend at.
And that's a peak debt level, right? 4,000 crores.
Yes.
Do you see those margin levels, though, to be sustainable, Mr. Saluja? Because in the mid-teens, there's been substantial growth in margins from 22, 23, even in this quarter as well. Do you see those levels sustained?
So we feel that there is a very, very strong demand. The demand is surpassing the supply. So our guidance is, yes, they will be sustainable, need not be as what they are today. But on a guidance basis, yes, these are here to stay. Solar industry story is coming now. It's growing aggressively. You're seeing the kind of capacity coming in. So I think this is the era for the solar industry boom to happen in India, which is really good for us because the cheapest source of energy is clean energy, and we need to have a total manufacturing supply chain in India.
All right, Mr. Saluja, final question before we let you go then. What about the competitive intensity? In the space like yours, there's always that fear that a couple of large conglomerates here in India, could be competing with you, which in turn could put pressure on the business. Clarify on that. And this Chinese problem, are they a competition as well?
So I'll answer your first question. Yes, competition will catch up. We are happy that the industry is growing, especially because we have been in this industry for 29 years. This was started by our chairman, Sri Surendrapal Singh Saluja, who thought at that time he had the vision that solar is going to play a very important role in the energy mix. So look at us as a company which has been in this for 30 years now, 3 decades. And we have seen all the cycles of this industry. So we are happy that the competition comes in. We are happy that the ancillary grows and the whole industry space becomes much stronger in India. In terms of China, China prices and China aggressively selling is a great advantage to India. It's not a threat. Cheap Chinese prices only means that we get solar cells into India from China and offer, very competitively priced modules to Indian developers. So that Indian developers who are setting up large power plants, that market also is aggressively growing now because of softening in prices.
Now, one final question from my end, sir. I had to ask you about the utilization. What's the current utilization at your facilities? And you've also spoken about underutilization in your RHP as well, which is what I want to highlight about. Was this underutilization the utilization levels going to increase as more capacity gets added on?
So if you look at our DRHP and then the RHP, you've already seen an increase. When you set up these cell lines, the utilization is around 50-60%. Today, we are already at 80%. The peak where we can reach is about 92% on utilization.
All right, Mr. Saluja, wish you very good luck for your IPO. Thank you so much for joining in and wish to speak to you again on your listing day as well.
Thank you.
That was the management of Premier Energies, then the IPO opening for subscription today. And as of course, it's a fresh issue as well as a combination of an offer for sale. Take a short break, come up with more corporate conversations on the other side. Stay tuned. We'll be right back.
The contributory nature of the NPS, but with added security. Employees contribute 10% of their salary, while the government adds 18.5%, which is higher than the 14% contribution made by the government in the national pension scheme. This means while you contribute, your returns are more substantial here. The UPS also includes an inflation protection through the All India Consumer Price Index for industrial workers, ensuring your pension keeps up with the cost of living, a feature totally missing in NPS and managed via a dearness allowance or DA in OPS. For your family, the UPS offers a better support. If a government employee passes away, their family will receive 60% of the pension. This is generally higher than the 30 to 50% provided by the OPS and certainly better than the NPS, where there was no fixed percentage of the deceased salary for the family. Now, regarding the lump sum payments, UPS provides a defined lump sum payment based on a fraction of the salary for every completed 6 months of service along with the guaranteed pension. NPS, on the other hand, allows for a significant portion of the accumulated corpus to be taken as lump sum, but it involves market risks and requires the remaining portion to be used for annuity purchase. And OPS used to not provide any separate lump sum except for the gratuity. However, if you wanted to take a lump sum at the time of your retirement, you could do that only via commutation of your pension. So in this regard, UPS is a step up. However, there are some downsides as well. Unlike the OPS, you still need to contribute under the UPS, and although the government's share is higher than the NPS, it's not fully government funded.
Welcome back to Chartbusters. Continuing with our corporate conversations, then India Ratings recently upgraded J&K Bank's long-term issuer ratings, and to discuss the impact this could have on the bank and to understand the outlook on the business going ahead, we are being joined by Baldev Prakash, the Managing Director and CEO at J&K Bank. Mr. Prakash, good morning. Thank you so much for joining in. I'd like to start off first by asking you, sir, about this conundrum about that banks are facing with regards to the deposit growth. How has business been in this quarter so far? We are 2 months into quarter 2. How does business look like when it comes to the loan growth as well as the deposits?
Yeah, good morning, Mangalam. So as far as deposit is concerned, first quarter was a little challenge for us, but after 30th of June or 1st of July, we are seeing some deposit accretion, and we have to make little more efforts, which we have already started. Advances growth is in line with our guidance, and we are confident to meet the guidance.
Okay, all right. Hi, Mr. Prakash. This is Nigel on this side. So what would that guidance be? I recall earlier you were guiding for NIMs in that vicinity of around 3.75 to around 4%. What's the outlook on NIMs, loan growth? Let's get these numbers out of the way.
So, Nigel, our story on NIM is intact, actually. 3.75 to 3.85 we have guided. And first quarter, we ended at 3.86. And obviously, given the strength in our CASA, as well as the retail business, which is picking up in our core territory, we are confident to maintain the NIM within our guidance.
Okay. And what about loan growth? I missed that number.
Loan growth overall, mid-teens, we have guided around 15%. And first quarter has been little slower, but this quarter it has picked up, and we will be meeting the guidance.
Any pain that you are seeing in the retail, the unsecured retail side of things, Mr. Prakash, when it comes to your bank?
No, Mangalam, so far so good. And in fact, the retail story is opening up in our core territory, J&K and Ladakh. And this is mainly driven by the ecosystem of tourism. So retail, we don't have much problems. Even agriculture is also picking up good here.
Okay, all right. Mr. Prakash, that's Hormuz, and this is Nigel here. So, I just thought I'll get that out of the way. Hormuz is stepping in today for the show. Mr. Prakash, give us a few more details. As a percentage of your total mix, how much is unsecured of your book?
So, unsecured will be around 25%.
Okay, and you're saying there are no signs of stress as of now, according to you?
No signs of stress as of now.
All right. Now, what is your current restructured book and how much of it do you think can slip?
So, Nigel, our restructured book is around 1,000 crore left now. And you must be seeing it for the last 1 year and so. There's hardly any further slippages out of the restructured book. Whatever is being upgraded, that is being reduced from the restructured book. So whatever was stressed already slipped. No further slippages are expected out of the restructured book now.
What about overall slippages, Mr. Prakash? What's your outlook on that for FY25? The overall slippages, the credit cost, as well as the asset quality picture going into FY25, particularly because you mentioned that you are currently not seeing any stress in your business whatsoever.
So first quarter, if you have seen our overall slippages, hardly any slippages actually. We have been able to control it very effectively. And going forward also, our credit cost has been very benign, below, in the minus only. And given the type of portfolio we have in the form of already technical written off accounts, so we are expecting good amount of recovery. Because of that, our credit cost is likely to be benign only going forward.
All right, Mr. Prakash, in the region that you operate in the valley, what is your market share and are you growing faster than the peers? Or do you think competition is getting intensive out there? And also, there are some fresh bouts of terrorism. Is it impacting the business?
So, Nigel, our market share has been in the overall business in above 60%. And for the last few years, we have been able to maintain it, though some competition is being faced in the liabilities front, in the liability side, so which we have to tackle it more effectively. And the recent terrorist incidents have happened mainly in the Jammu division area, basically Riyasi and Doda side. So there, though our branches are there, but we don't find much impact on the business of these incidents.
Mr. Prakash, have you received any recommendation from the Reserve Bank of India to bring down the stake of the state of Jammu and Kashmir in the bank?
We have not received any recommendations from Reserve Bank of India. And as soon as we get it, obviously, we have to discuss with our majority shareholder, the government of J&K, and we will let you know whatever outcome is there.
Okay, all right. So as of now, you've not received that directive, but that could possibly come. Maybe that's what the street is speculating on. We'll touch base with you at that point of time. Final question before we let you go. Give us a number, right? The gross NPAs, net NPAs, and credit cost. I recall, you were guiding for lower numbers going ahead. So just fill us in with all those three.
So our guidance for gross NPA has been 3.5%. We are already at 3.90 now. And definitely by the year end, we will be 3.5 below, even better than that. And as far as credit cost is concerned, we have already advised in our investor call also that credit cost, because of the technical right of recoveries, right backs, we are expecting it to be benign for the whole year.
All right, Mr. Prakash, thanks a lot for joining in, sharing with us your views on the road ahead for the bank for FY25. That was the management of J&K Bank. The stock currently trading below the flat line, around 0.5% lower at around 110. Time to shift focus then to our special segment where we get you a few ideas for profit from Money Control Pro. Jitendra Gupta of moneycontrol.com now joins us to talk about a stock that he's tracking very closely.
Bharat Electronics still holds good value. Stock corrected recently and possibly with the inclusion of BL in the Nifty 50 in the coming months, we think there is there is higher possibility of re-rating of the stock. The company has a healthy order backlog of rupees 76,000 crore, providing strong revenue visibility for the next 3 years. During fiscal 24, the company backed order worth rupees 35,000 crore as against its own guidance of 20,000 crore. In the current fiscal as well, the company is expecting order inflows of close to 25,000 crore, which is of course excluding LRSM orders, which could be much bigger. Moreover, execution is quite good in Q1. It delivered close to 20% growth in revenue. In the current fiscal, it is expecting to deliver 20 to 25% growth, led by strong orders in hand and focus on export. In terms of EBITDA margins, it has guided to achieve 23 to 25% margins, led by better revenue mix. On the valuation front, stock is trading at 35 times its fiscal 26 estimated earnings, which is reasonable. More so, I think, in the light of earnings visibility supported by strong orders in hand and improving execution.
Okay, thanks for that, Jitendra. For the time being, though, we'll slip into a short break. Come back. We'll continue our focus on markets. Don't go anywhere.
Back with us here on Chartbusters. The markets continue to remain where they are, continuing in consolidation mode. The Nifty remains around that mark of 25,030, still around 50 odd points away from that record high level. Pull up the Nifty Bank as well, and that is going to be the index that you will have to watch out for in today's session as well, since it is the financial services expiry today, nearing that mark of 51,200 yet again, and it needs to sustain above those levels. The high of yesterday was around about 51,300 odd. So that is the index that you need to watch out for, both the Nifty Bank and the financial services index. Pull up a few stocks, and these Tata Group companies have been on a tear in the recent past, yesterday and today as well. Tata Investment is one of them. That's the top gainer on the small cap index. 8% higher now is Tata Investment, and that is also at the highest point of the day now, 8.5% higher, nearing that mark of 7,000. Pull up Tata Elxsi as well. It is continuing to build on those gains that it made yesterday. The stock was up around 10-11 odd % in yesterday's trading session, up another 3.5% today, was up around 5.5% at one point. So nearing slightly off the day's high, but continuing to trade higher. And the third one that I wanted to point out is NIIT, and that is also continuing to build on from the upper circuit of 20% that it was locked in yesterday. Ramesh Damani, the veteran investor, has bought stake in the company. Promoters have also increased stake. 7 17% higher now. The stock is up for the 7th day running, nearing the mark of 180. Isn't it?
Well, that's right. And a few stocks actually from the broader markets. PTC India Financial, just pull up that stock. It's up close to around 6%, moving on high volumes. And it's hard to keep the Sanjeev Goenka stocks out of the game. Today you have CESC that's up close to around 6%. So big up move is what we're seeing out there. Another one that's moved actually very, very well is Lakshmi Organics. I think they had an investor meet. A couple of notes is what I read earlier today. And that one, in fact, has moved from strength to strength. Actually, just let's pull up a last 5-day chart of Lakshmi Organic. That one has done quite well. The chart should come up for you on the screen, which will tell you the kind of move that we've seen on Lakshmi Organics as well. Another one buzzing on trade on rather high volumes. For the time being, though, we'll wrap up on this edition of Chartbusters. Stay with us. Trading Hour comes up next.
Good morning. Welcome to Trading Hour. It's a Tuesday morning. Things are quiet on the Lal Street. I'm Reema Tendulkar. With me is Surbhi Upadhyay. to be very flat and practically unchanged on the benchmark indices. But it's good to see the Nifty still hold on to the 25,000 marks, a striking distance away from our all-time high levels, and mid-caps are powering through.
Absolutely. And Rima, off late, we've seen the market make more of a directional move in the second half of the day. And I think today might be one of those days as well, because the cues that we started with were not the best. I mean, most of the Asian markets have been down in red territory. But if you look at the Nifty for the time being, there are interesting moves that are showing up. Look at Bajaj Auto. It's suddenly surging to the highs of the day. There's some buying on Maruti as well. Some of these auto names are looking good. Hero MotoCorp can be counted in that list. Yeah, days high on Bajaj Auto. So stocks are on the move. Look at a Larsen. L&T is right now the Nifty winner with about a 2.5% up move. Some of the banks like ICICI Bank are also trying to get a more of a green directional drift. So not too bad, but yeah, let's see if the bulls can manage to prevail by the second half.
And not bad considering the spike that we saw in Brent crude prices, with Brent now well above that $81 per barrel, and Asia still holding up, largely in the red, with names with the Taiwanese markets or Hang Seng down close to about 0.5%. On the way down, you've got many of these consumer staples, FMCG stocks under pressure. So whether it's in HUL and ITC, Titan too in the consumer discretionary space is down close to about 0.8%. Oil marketing companies have been on the back foot with the rise in crude prices, and metals had a fabulous day yesterday. So some retreats seen in names like JSW Steel and Reliance Industries. That heavyweight is a bit subdued, 0.5% lower, ahead of the much-awaited AGM on Thursday that starts at 2 o'clock. But let's straight away invite the first guest on the show now. S&P Global Ratings last week upgraded the rating on upgraded the credit rating on Tata Power from a BB plus to a BBB-, accompanied by a positive outlook. The company calls out extraordinary support for Tata Power from Tata Sons Private Limited. To talk more about it, we've got Neil Gopalakrishnan, Director, Sector Lead of South and Southeast Asia Infrastructure Ratings, joining us on the show now. Neil, morning, and thank you for joining in. This is Rima here. First, take us through your call behind upgrading Tata Power.
Good morning, Rima, and thanks for having me on your show. Firstly, this was not just an upgrade of Tata Power. We reviewed all the rated Tata Group companies that we have for the potential that extraordinary support that we had factored into the ratings could be stronger than what we previously anticipated. Now, the question you might have is what led to this review, or what's changed? And that's a perfectly logical question to have. And what we observed has been that in the last few years, the group has become more cohesive, both strategically and also operationally, with greater operating linkages between the various Tata Group companies and also between Tata Sons and the operating subsidiaries. This greater cohesion to us indicates greater long-term commitment as well as incentives to support. And that led to the review of all the Tata Group companies, including Tata Power that you mentioned.
Got that, Neil. So the question is, we understand your viewpoint that this is an overview of the entire group and maybe greater support anticipated from Tata Sons. But specifically speaking about Tata Power's debt profile and how you're expecting perhaps the cost of servicing that debt to shape up, because they are going ahead with an aggressive capex plan, right? They're adding a lot of capacity on the renewable side, big plans afoot. So what's your sense in terms of the increase in debt levels that we may see over the coming years, and then the ability to service that debt, and now, of course, this new better rating?
Sure. The company does have large expansion plans. And this is not something specific to Tata Power. We see utilities across India and indeed the wider Asia-Pacific region having significant expansion plans, particularly in renewable energy to execute the carbon transition strategies. Specifically coming back to Tata Power, while the company's capex is high and this would consume a large part of its operating cash flow, what we also find is that the company is managing this risk by phasing out its capex. So, for example, we don't see a very large capacity expansion being planned in a very short period of time. If you just look at renewable energy, we expect about 1 to 1.5 gigawatts of capacity being commissioned every year for the next few years. And given the company's growing cash flows, which is also benefits from capacities being periodically commissioned, this is quite manageable. Purely from a debt perspective, we do expect debt levels to increase modestly from where they are now. But the leverage should still be well within the levels that we expect for this level of a standalone rating.
And what is that level? I mean, the level of gearing that which is within your expectation range for an entity like Tata Power?
So one of the metrics we look at is debt to EBITDA, and we think around 4 times is a pretty reasonable level. In fact, in the utility space, where you expect cash flows to be very predictable and stable, you could even say that 4 times is fairly comfortable level to be at, 4 times debt to EBITDA. And the company has also stated that while it executes this expansion plan, it'll keep an eye on leverage, and debt levels should not increase very significantly from where they are now.
Neil, going back to the first point that you made about greater cohesion between all the Tata Group companies, the greater operational integration that we could expect. What exactly would it mean for Tata Power? Can you give some examples of what you anticipate how this will play out in the near future?
Sure. Maybe if I can take a step back, and we went maybe 7 or 8 years back. Our impression was that many of the Tata Group companies were operating very independently, or in silos, if I can use the word. But in recent years, there's been a lot more integration, and the companies working together to realize synergies within the group. And more recently, this has got accelerated by, I think, 2 main developments. One is the electric vehicle business, which is focused on by Tata Motors and its 100% subsidiary JLR. And the other is the carbon transition strategies that the entire group is implementing. And that is where Tata Power has become involved in a big way. So Tata Power specifically is involved in setting up a lot of capacities for the other group companies. And on the electric vehicle side, it's setting up a part of the charging infrastructure which would support the electric vehicle business of Tata Motors. And also we see the company bidding jointly for electric commercial buses, for example. So there's a lot of integration within the group, and Tata Power is a key player in that integration.
Okay, and just one final question. Typically, when we see a credit rating to the tune that you have given Tata Power, what's the interest rate savings? Is it a 50 basis point cut that we should expect, say, from Tata Power? Typically, if you could give us, how much does it help the rate of interest, the rate of borrowing for companies?
A couple of things here. One, the cost of borrowing is a function of market and the broader interest rate. So at what cost companies borrow depends on where you are in the interest rate cycle. And the second thing is our rating is in foreign currency rating. And where Tata Power would benefit is on offshore borrowings. Whereas currently, if you look at the company's borrowing profile, most of it is onshore. But what an investment grade foreign currency rating does is, one, it improves sentiment. So it may not necessarily lead to lower borrowing cost onshore. But if the company chooses to borrow offshore with an investment grade rating compared to a BB+, it opens itself to a much wider pool of investors some investors who may not necessarily look at sub-investment grade issuers. And just for the benefit of audience, when I say investment grade and sub-investment grade, any rating that is BBB- and above is considered investment grade, and those below are sub-investment grade. The most recent rating action took Tata Power from BB plus to BBB minus, which is the lowest rating on the investment grade scale.
Okay, all right. Neil, we'll leave it on that note. Thank you very much for joining in and sharing some perspective on the reasons behind that ratings upgrade that you have assigned to Tata Power. We'll take a break on that note, come back on the other side and discuss everything that's hot in the commodity markets. Manisha will join in.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube.
Well, the Unified Pension Scheme, or the UPS, is the government's latest response to the backlash against the National Pension Scheme, primarily due to its lack of fixed pension and the uncertainty tied to the market-linked investments. So how does the new UPS compare to the old pension scheme and the NPS, and what does it mean for the government employees? Here's a quick breakdown. The UPS guarantees a pension similar to the OPS if you have served it.
Welcome back. Well, the stock of the week so far has been NIIT, and I know it's only the second day in the week, but then that's the kind of move that we're talking about. NIIT right now up 18% after a 20% circuit yesterday. Rima, so it seems that, beyond the business, there's a lot of excitement about who's checking into the company.
Well, so let's tell our viewers who's checked into NIIT Limited. So for starters, last week on the 22nd of August, the promoters, via a block deal, acquired 35 lakh shares. And with this, they increased their stake to 37.26 versus nearly 35%, a pretty substantial increase. After that, on Friday, we had Ramesh Damani, veteran investor, much followed. He acquired about 8 lakh shares in NIIT. So on Thursday and Friday, we had the promoters and Ramesh Damani both acquiring stake in NIIT Limited, and that's the reason for the stock. You spoke about the 20% up move yesterday. Well, on Friday also the stock was higher once the promoters had checked in. So in the last 3 days, Friday, Monday and today, it's up close to about 50%. And there are other notable shareholders. The market cap of the company is not very large, but you've got an MIT, Massachusetts Institute of Technology, with a 5.5% holding. Hornbill Orchid India, that's another FI with a holding of 2.5%. Amongst the DIIs, you've got Nippon Small Cap Mutual Fund and Marathon Edge. And these two together hold more than 10% in the company.
Imagine the stock already gives you 43% in 3 days. What's left for the remainder of the year, I wonder. But then that's the bull market. And that's NIIT for you. So we thought we'll just, quickly give you this data snippet on the shareholding changes that seem to be getting the market very, very excited. Well, with that, let's move on to the promised conversation on commodities. We've got Manisha joining in. So much going on, whether it is, the expectations of the US rate cut or geopolitics. Manisha, so what's catching your attention today?
Well, at this point in time, it is gold and silver prices because we have seen a smart rebound onto this one, still holding above $2,500 an ounce for the gold prices. And remember, we've done an all-time high of $25.30, holding around $25.10 at this point in time. So the gains have been quite on the stronger side. We started this year, by the way, with $2,050 an ounce, went down to $1,992 as well, and we are holding above $2,500. So it has been a very strong story there. Also, when you look at the silver prices, we've seen that trading at 5-week highs, $30 an ounce is holding. The markets are looking at the declining US dollar index. Expectation that the US Fed rate cut in the month of September is imminent now, and that clearly has been supportive. Interestingly, when you look at the money managers, gold bullish bets, they are at a 4-year highs right now. So you have hedge funds and large speculators boosting their net longs by nearly 7.5%, and the number that you have at around 2 lakh contracts is at a 4-year highs. So clearly most people staying invested here. Even the kind of corrections that we've seen in gold have been very shallow. So the strong hands holding gold, adding to positions, and we haven't seen a very sharp or big profit taking come into this one. Also, the geopolitical tensions has been adding to the premium. That is what we've done in the month of August so far for gold and silver prices. 6 to 8% of gains coming in on your screens there. Interestingly, there also is this report from Citi which says that the gold ETFs, the global ETFs that is, have not been party to the kind of run-up that we have seen in gold. If you look at the number there, from November 2020 to May 2024, we have seen nearly 930 tons of outflows coming in. For the year 2023 alone, it has been 250 tons of an outflow. But Citi also says that from 2023 to 2024 and 25 going beyond, they do anticipate that a good mining chunk that would come into the world markets would be taken in by ETFs. And that is where the next support perhaps could be coming in.
Thank you very much for that. So gold has been the big success story of this year. Let's slip into a very short break. We'll come back and discuss market technicals. Mitesh Thakkar joins in with his top trading bets.
Years, you will receive 50% of your average basic pay from the last 12 months before your retirement. Even with just 10 years of service, you are assured a minimum pension of 10,000 rupees per month. This is a significant improvement over the NPS, which didn't offer any fixed pension and was subject to market risks as well. One key difference between the OPS and the UPS is that the latter still retains the contributory nature of the NPS, but with added security. Employees contribute 10% of their salary, while the government adds 18.5%, which is higher than the 14% contribution made by the government in the national pension scheme. This means while you contribute, your returns are more substantial here. The UPS also includes an inflation protection through the All India Consumer Price Index for industrial workers, ensuring your pension keeps up with the cost of living, a feature totally missing in NPS and managed via a dearness allowance or DA in OPS. For your family, the UPS offers a better support. If a government employee passes away, their family will receive 60% of the pension. This is generally higher than the 30 to 50% provided by the OPS and certainly better than the NPS, where there was no fixed percentage of the deceased salary for the family. Now, regarding the lump sum payments, UPS provides a defined lump sum payment based on a fraction of the salary for every completed 6 months of service along with the guaranteed pension. NPS, on the other hand, allows for a significant portion of the accumulated corpus to be taken as lump sum, but it involves market risks and requires the remaining portion to be used for annuity purchase. And OPS used to...
Welcome back here with us on Trading Hour. ABB India has been gaining ground in trade after Axis Capital has issued a bullish call on the stock. It has upgraded the stock to a buy rating from a reduce. We have Amakshi joining in with more details. 2% up, Amakshi. Okay, I think we'll have Amakshi in just a bit to tell us more about that call on ABB. But the other call that's being sort of really, noticed in the market today is on real estate. And this is a view that's coming in from Morgan Stanley. We have Sudarshan joining in. It's a detailed, I think, note talking about where we are in the real estate cycle and whether there's more upside still left on the stocks. Sudarshan, fill us in.
So there is an interesting note for Morgan Stanley on real estate sector. While it remains optimistic on the sector, but it says investor interest in the sector has waned
what it was 6 months ago. First, talk about the luxury segment. It says developers are launch dependent, but valuations are stretched at the current levels, and it believes pre-sales outlook for DLF, Oberoi and Prestige Estates could be slower in the coming days, as these companies depend on launches, and the majority of which are in the luxury segment. Now, what it finds that most of the investors are now more interested in the smaller company. It says investors are looking at smaller developers like Sensu Textiles and so on developers, and these companies may benefit from cheaper valuations and higher sales growth. Lastly, its preference, it prefers retail over the office space. It says investors agree on its preference for the retail over office at this stage of this cycle in the real estate sector, but key questions are whether current ROIC and earnings growth of 15% can be maintained. Few investors favor Nexus or Phoenix on valuations, and it says Nexus could gain investor recognition if it demonstrates DPU growth. What is DPU? DPU is distribution per unit. Lastly, amongst preferred picks, it says its preferred pick is Godrej Properties but there are concerns, and there are concerns related to lower margin and the cash flow. So there is a detailed note on the real estate sector from Morgan Stanley.
Thank you very much for that. I want to also talk about the IT sector. Now, HSBC has come out with an interesting note where they're talking about how mid-cap IT was the big, outperformed the large-cap IT space ever since COVID struck. Their growth rates were higher. But now what HSBC is observing is that the growth differential between mid-cap and large-cap IT, which was as high as 10% in the aftermath of COVID, has come down. And according to HSBC, it will settle between 4 to 6%. So mid-cap IT will continue to outperform large-cap IT in terms of growth rates. Their base is small, but the extent of outperformance, according to HSBC, will moderate. Also, on mid-cap IT, HSBC has noted that the operational performance has been a bit of a negative surprise. So, mid-cap IT companies have won a lot of cost rationalization, margin dilutive deals, and therefore the margin performance has been a bit of a negative surprise. Also, bear in mind that valuations of mid-cap IT companies are now at a 50% premium to large-cap IT companies, given the stronger performance, but it's much higher than the historical premium that mid-cap IT enjoyed. That said, while this is on one side, on the other hand, mid-cap IT's cash conversion cycle has been pretty strong and has only improved. Now, particularly on KPIT Tech, HSBC has downgraded KPIT Tech. And remember, KPIT Tech was the star in the entire mid-cap IT space. Now, the reason for this downgrade to hold is they're noting that R&D spends of automotive companies has come down. This is according to HSBC. They go on to give their estimates up to FY27, FY28, but just as a comparison of what's expected this year versus what it was about 4 or 5 years back, you would see that R&D spend as a percentage of revenues for large OEMs is coming down. So that's reason number one that HSBC cites. They go on to say that yes, KPIT will try and diversify into Asian clients, US clients, but there still could be a downside risk to their growth. Also, competition from peers, because automotive ER&D has been so strong, is now intensifying from the likes of LTTS, Tata Tech, Infosys, Cognizant. And therefore, HSBC is saying that KPIT's growth rates will come down. The last 3-year average growth rate has been 34%, and that could come down to 15% going ahead. So they prefer an LTTS over, say, a KPIT Tech, because now that KPIT Tech is fully dependent on automotive OEMs, LTTS, that's L&T Technology Services, also an ER&D player, but it has a diversified revenue base, and therefore their preference is for LTTS over KPIT Tech. There is a downgrade on KPIT Tech. On LTTS, they continue to maintain a hold, though they've gone ahead and raised the target price marginally to 5,560, marginal upside from current levels.
Okay, so that explains, the buzz around some of those stocks on the IT side of things. Well, with that, let's quickly move on and see if we can indeed go to Vamakshi now. Yes, I think Vamakshi is with us to talk about this note on ABB. So what exactly is Axis Capital saying? What's their contention, Vamakshi?
Well, absolutely. Axis Capital is saying that they've gone ahead and they've upgraded their rating on ABB from reduced to buy. They've also increased their target price from 8,190 earlier to 9,340 per share. They say that the earnings uptrade cycle in ABB continues. In fact, post the second quarter numbers, which is the April to June quarter, they have upgraded their calendar year 24 to 26 EPS estimates by almost 9 to 12%. Significant portion of the recent gross margin improvement, in their opinion, is structural and is here to stay. In fact, post Q2, that is over July and August, commodity prices, including that of steel, aluminum, as well as copper, they have moderated, and this in turn could be a tailwind for the margins for the company. They're expecting 41% earnings growth in the second half of this year. Base order inflows were flattish in the first half, but they're expected to pick up in the second half with the election as well as the budget uncertainty now behind. They're expecting the second half of this calendar year inflows to pick up by almost 20% and execution to pick up by 22% on a YOY basis. The core return on capital employed for calendar year 24 is expected at 120% plus. This is in comparison to 80% that we had seen in calendar year 23, and in fact is tracking much higher as compared to the peak of almost 100% that we saw in calendar year 2006. The cash to net worth ratio too is at 76%, and this too is at an all-time high. Overall, given all of these factors, they've actually switched their preference from ABB to Siemens, from Siemens to ABB rather. ABB has underperformed Nifty by almost 18%, and Siemens has Siemens by almost 12% over the last 3 months. And in this duration, they've gone ahead and upgraded ABB estimates by around 9 to 12%, while they've cut the Siemens EPS estimates by 2.5%. In fact, on a one-year forward basis as well, ABB is trading at a discount of almost 7% to Siemens as compared to a medium premium that we've seen since 2017. So overall, it's quite a bullish note coming in from Axis Capital on ABB.
All right, got it. Thank you, Vamakshi, very much for those details and for telling us more about that note. Let's go back to Mitesh now and get a couple of trading calls in. Mitesh, thanks for joining in. So the market's continuing to hold steady. I think at the index level, it's trying to build on some momentum and traction. 25,000, almost 60 is here. So we're not too far away from that milestone also now. What are the trades at the moment?
I have a buy on ICICI Bank. I think, the banking index has also shown signs of picking up from lower levels, and ICICI is leading the rally. So buy here with a stop at about 1210 for targets of 1260. And another one is cash stock. After a long time, Gufic Biosciences has come on the radar. A good breakout taking place over here. Keep a stop at 390, look for targets of 440. And this is a slightly personal call for a couple of weeks.
Okay. All right, Mitesh. Thanks for that. We'll touch back, base with you in the afternoon. 50-point move on the Nifty now. Let's pull up the Nifty intraday. Like I said, we are now less than 20 points away from hitting the record high levels. The gainers include an Infosys, ICICI Bank, L&T. These are the big boys that are leading to this kind of momentum right now on the screen. And then you have a couple of auto stocks, of course. You've got Hero Moto, there's Bajaj Auto, there's Maruti. So some of these auto names are also looking fairly good at this point in time.
It's
so
less than 15. It's less than 15 minutes. 15 points away from our all-time high levels. Is today going to be the day? Today is also the Fin Nifty expiry.
Yeah.
So the second half of the trading session could be interesting, but after a slow start, there is some momentum building up in the markets on the upside. We'll get into that break. We'll come back and invite Manish Dangi of Mosaic Asset Management on the show. Stay tuned.
See that Chetak is now close to about 18% market share or just above 18% market share. We are neck to neck with our able competitor TVS and their iQube. I think just a few hundred vehicles separate us. Having just launched a third product, there are more due later this year, within this financial year. We talked about it the last time we met a couple of months back. And I think post the festive season, and before March, certainly there will be more Chetaks in the marketplace. And I could reiterate what I shared with you the last time, that not only will there be more Chetaks in the market of the current platform, hopefully very sharply positioned, but there will also be a new Chetak platform. As we head into the festive season, in the months of September, October, November, we are very likely to cross a monthly sales production and sales rate of over 100,000 clean energy two-wheelers and three-wheelers. But I would hazard that definitely over 25% of our current revenue is already coming from or about to come from clean energy vehicles, which is quite remarkable.
Investing.
Welcome back. So there you have it. The ticker is on, the timer is on, just about 10 or 15 odd points away from the all-time high. In fact, we came very close. I mean, it was less than 8 points off. And then that's how the numbers are changing for the time being. Well, good time to bring in Manish Dangi. He's from Mosaic Asset Management. Manish, great to have you on the show. What a market we've been in, right? And what a month we've had. Complete roller coaster from this whole yen carried trade unwind to maybe a hard landing in the US to now a soft landing and more rate cuts. It's really been all over the place. But do you think from an equity market perspective, the worst of the volatility has settled? Because the equity market seems to be thinking that there's only one direction in life and that's up. What's your sense?
Hi. So I made this point to you in the past that, the views from bonds and equities are divergent. We sort of collectively pricing peak Goldilocks. Bonds are pricing about 200 to 225 basis point rate cuts and paradoxically, equities are pricing not just what bonds are pricing, but along with a 12-13% rise in earnings in US. Now, two of these cannot happen simultaneously. Something similar you could say in India that, bonds are beginning to price, it's a flat curve, bonds are beginning to price rate cuts because they're worried of, weak PV sales, weak import growth and whatnot. And equities continue to price 15% CAGR in earnings. Simultaneously, both of them are not possible. So, it's a party time. The past inertia sort of continues to hold the market on, but underlying momentum.
Manish, well, let's press you on the toughest question. Who's right? And you've beautifully summarized it. Both bonds and equity can't be right. If bond yields are going to come down, and earnings going up the same fashion. So who do you think is right?
See, bond is called Mr. Bond is because it tends to be the hero in the room, and it's adjacent to macro, and therefore its life depends on, to get the growth macro right and the inflation macro right. So if you want to hear and pay heed to an advice of someone between equity and debt with respect to macro, pay heed to bonds. If you want to pay heed to, general corporate capex, this, that, maybe equities. So if the driving force is going to be a growth inflation macro, then it's of course bond that you want to pay heed to.
So you're betting on a recession in the US, and that is retrospectively called based on what history tells us, well into the rate cutting cycle. So what should we expect? And how will this impact equity markets globally?
So I guess, we've again discussed this for the last 6 months. These things take time and markets are, and of course, commentators are more impatient. I guess the cycle is advancing like a clockwork. The US has slowed significantly. Bonds have started to pay heed to it. Even the Fed is beginning to sort of course, they pivoted clearly, and there is going to be a 225 basis point rate cuts now being priced in. So essentially, when there is US recession, you tend to have 20-25% knock in earnings in US. And there is sort of a reflection of something similar happening in India and at many other emerging markets, because US is a force to reckon with respect to global demand. So my sense is that, one thing that I do not agree with the market is the earnings growth. And my sense is that even in India, earning growth will be more like 8-9% versus 15-17% that markets are baking in right now.
This is important. So, I mean, we don't know whether this is a bit of a last hurrah then for the time being. But Manish, I guess from an equity market standpoint, and you've seen so many of these cycles play out, right? Let's go back and see when we had the last recession and the last rate cut cycle from the US. I guess from the equity market standpoint, as long as it's orderly, kind of life goes on, maybe you go into a bit of a time correction, you stop expecting the market to give you 20-25% every year. But what we saw at the beginning of this month was not orderly. This whole yen carry trade unwind and immense volatility. So are you expecting more of those kind of instances? Because the wisdom then was that the Bank of Japan has been put on hold. There's no way they can hike if the Fed is cutting. So again, orderly sort of deceleration of growth and a gentle recession versus maybe more accidents. What do you see ahead?
So if you're thinking of financial crisis like 2008 or something what happened in China in 2015, unlikely. So a lot of these so-called deleverage cycles have big knocks in the market, but they tend to be short-term in nature, precisely because, regulators are aware of not letting it persist. So they kind of take affirmative action with respect to these, sudden stops. What I'm arguing is that, it's a slowish weakening of economy, which results in lower earning growth. And that is not what markets are pricing in. So US recession, all recessions need not be sudden stops led by financial crises. It could very well be the income recession.
Sure, yeah. Just an economic recession, absolutely. So you're saying the risk is basically markets' anticipation on earnings growth not really playing through. Take that point. Rima?
You're also of the opinion that the RBI is late and the RBI should start aggressively cutting rates back home in India. Take us through that viewpoint.
No, India has slowed quite significantly, and the external setup also has sort of improved. I think RBI and the rhetoric from all policymakers is still sort of tightening bias is there. You ought to ease up now. Very few data which is reliable in India is available today tells you that Indian underlying growth is slowing. Even the upper part of K, like PV sales and all, have started to slow quite significantly. I tend to believe that the best marker of India growth is core inflation, and at 3% or thereabouts for last 3, 4, 5 months tells you a story of how underlying demand is pretty weak in India. Private capex, despite all the sort of exuberance in the markets, hasn't really picked up anywhere close to what used to be, and sort of a little bit of incipient stress is beginning to appear even there. So my sense is that it's best time in India that we chop rates quite significantly, improve liquidity, and let this stress on banking sector, which is there right now, quite persistent for last many quarters now, get relieved.
Okay, all right, Manish, let's see how it plays out. Thank you very much for offering us that perspective, and let's see if it indeed is, Mr. Bond's turn to be right once again. Thanks for joining us on the show today. Well, with that, we have to take up another quick break, but on the other side, we get chatting with the management of Office. Amit Ramani, the Chairman and Managing Director of Office Space Solutions, will be with us to talk about the company's business outlook.
markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Welcome back. Office Space Solutions is in focus today. This, remember, was one of the recent listings, I think listed about 2 or 3 months back. And just last week, the stock zoomed to its all-time high levels of 946, a 140% premium to its issue price of 383. But in the last 2 days, the stock has come under pressure. So from levels of 940, it's now down to 775. Now, there are two sets of news flow that we wanted to discuss. So last week, the company announced in a press release that they're expanding their footprint in Bengaluru and they've unveiled more than 66,000 square feet of premium workspace. Also, their Q1 numbers were out recently and it was a strong showing, 37% revenue growth, 56% jump in the EBITDA. To talk about the way forward, we have Amit Ramani, the CMD of the company, joining in. Amit, thank you very much for joining in. First, if you could talk about your expansion plans. Now, you've already indicated that you added 15,000 new seats in Q4, 5,000 in the quarter gone by. So for FY25, what will be the seat count addition? For FY26, I think you've spoken about 40,000. And now with this Bangalore facility coming on board, which you recently announced, how many seats are we talking about? Just break it up in terms of timeline.
Sure. So we had announced, at our last earnings call that we ended the FY24 at roughly about 95,000 seats. We added another 5,000 seats in the last quarter, so we have about 100,000 seats operational. In addition, we have close to about 12,000 seats that are currently under fit out, and another 15,000 on top that essentially are going to be in the LOI stage right now, and which will convert into a fit out in the next few months. So the target for FY25 is essentially 135,000 seats. We'll add about 40,000 seats this year. Obviously, the Bangalore facilities are part and parcel of that overall number that we are targeting for FY25.
Okay, so this 1.35 lakh seats that you're targeting by the end of FY25 includes this Bangalore facility.
That's correct.
Okay, and what's have you spoken to any clients? What is the kind of occupancy that you anticipate by the end of FY25 for this, 1.35 lakh seats for mature and even on a consolidated basis?
Sure. So, Rima, if you look at the whole outline, the last quarter we reported an overall occupancy of 71% and a blended occupancy for centers which are more than 12 months operational of 84%. At least the guidance for the future FY25 is that we will exit FY25 also along similar numbers because the seat addition continues to be at a rapid pace. For FY24, for the 12-month trailing, we had added close to about 30,000 seats across 48 centers. So the seat addition is happening rapidly. Hence, our guidance for FY25 occupancy is 70+%, and for mature centers of 12 months or more is 85%.
Mr. Ramani, the street, of course, has been liking your pace of growth because it's outstripping, I think, the general growth levels as well. I think there are estimates ranging between 25% to 26, 27% in terms of flex working spaces overall. But you've managed to grow at 30% plus. Now, there are estimates on the street that project you growing at 40% and more over the next 2 years, 2 to 3 years, on a CAGR basis. Is that a fair assumption to have? Do you think you can, sustain at 40% growth rates?
So we've given the guidance of 30%. We ended FY24 at about 850 crores top line, and we have given a guidance of about 1,100 odd crores. We will continue to keep that guidance. Obviously, one area where we are very focused on is our operating efficiency and operating leverage. We have given a guidance of 1.5% on our EBITDA. And for this first quarter of FY25, we were already overachieving that. So I think clearly focus is on growth, but I think the guidance continues to remain at about 30%. But there is a very focus on improving the EBITDA margins and ultimately the PAT and the profitability.
You know, speaking about margins, I just wanted to understand the difference and the margin sort of variance between the two models, the managed aggregation model versus straight lease, and you do a mix of both. So just explain what makes better business sense and what's the targeted mix that you look at, say, by the end of the year.
So see, if you look at globally, some of the straight lease models have not been that successful, right? We've seen that what challenges they come with, because you are taking the primary risk. When you are taking a straight lease, you are putting 100% of the capital, as well as all the occupancy buildup is on your plate. So from our standpoint, when we coined the term managed aggregation, our model was partnering with the landlords. And as a result, what we end up doing is that we partner with the landlords for two things. One, we ask our landlord partner to put in the capital towards the fit out, a large portion, typically anywhere between 80 to 90%. And then we request them for a operational minimum guarantee free period. And even after the minimum guarantee kicks in, usually it is about 50% of the market rental. So it has done two things. The managed aggregation does two things for us. One, it mitigates our risk because our landlord becomes our partner. Second, we become asset light because our landlord partners are putting in the capital. Obviously, in that model, the margin, contribution margin at the center level ends up being lower because I'm not putting in the capital and my landlord partner is taking the risk. So in a typical profit share model, after covering the operating expense, 70% of it typically goes to our landlord partner and 30% comes to us, which translates to about 23 to 24% for us at the EBITDA level, at the center EBITDA level. In a
Got it.
model, yeah.
Sorry, I'm so sorry to cut you short. Actually, we're a little short on time. We got that. That really helps us understand the way the model's working. Now, and straight lease is different. I mean, it all comes to you, but you're taking on, the bulk of the risk as well. Now, going forward, what's going to be your strategy? You're saying globally it is a managed model, which is sort of perhaps working better. What's the targeted mix that you will hope to achieve, and what's that margin rate, blended margin rate, that you will want to sustain at, again, on a steady state 2 3 year basis?
So currently we are a 65% managed aggregation, 35% straight lease. The guidance continues to remain in that direction. We will continue to do straight leases where we already have demand with us, and we will do speculatively our managed aggregation. So the ratio will remain. As far as, our numbers in terms of margins go, we currently do about 23-24% in managed aggregation and about 30+% in straight lease. So at a blended level, we will be in the 25 to 26% at the center contribution level, center EBITDA level, which obviously translates into, the overall company EBITDA as well.
Amit, out of time, but thank you very much for joining in and wish you all the very best. Need to get into a break on that note. On the other side is our special segment, Fin Street. Stay tuned.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
And what a great way to celebrate our own 25th year, with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today. Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV18, embarking on a quarter century of investing.
Welcome back. Well, as promised, let's get you our special segment now, Fin Street. This time, our colleague Abhishek Kothari focuses on the banking sector's performance in the first quarter.
Well, in our banking sector review of Q4 FY24, we did highlight that in Q1 FY25, net interest margin of the banking sector will be under pressure. Credit cost and asset quality will rise owing to normalization. MFI loans and unsecured loans will see deterioration. Not much to our surprise, the results are quite the same. Net interest margin has come under pressure. Deposit growth is coming in at a huge cost for many lenders. Credit cost is rising. Deterioration is happening on asset quality, especially for private banks being higher than PSU banks. Pain has continued, especially for lenders having exposure to rural market like microfinance loans, and now even for lenders having exposure to unsecured retail loans. Let's take a look at this in a detailed manner. Now, it was a tale of two cities for PSU banks and private banks in this quarter. So PSU banks saw their operational performance being weak in Q1 FY25, while private banks, on the other hand, saw their asset quality deteriorate the highest in last 3 years or 12 quarters. Now, despite low credit deposit ratio, PSU banks saw their NII decline on a sequential basis. Private banks' NII growth was about 2.5% quarter on quarter, largely led by the high-yielding retail loans. Dhanlaxmi Bank is the only lender to see YOY and quarter-on-quarter decline in its net interest income for second quarter in a row. Now, calculation shows that the net interest margin might have declined by 10 basis points for PSU banks and improved by 7 basis points for private banks. So, overall, the net interest margin has declined quarter-on-quarter for all the banks at an aggregate level. Operating profits got impacted in Q1 FY25 due to weakness in NII growth that you had, lower treasury gains and higher OPEX as well. Overall, operating profits declined by 4% quarter-on-quarter. So, operating profits for PSU banks declined by 2% quarter-on-quarter, and for private banks, it declined by nearly 6% quarter-on-quarter. Now, again, Dhanlaxmi Bank is the only lender to report an operational loss for second quarter in a row. 19 out of 39 lenders saw their operating profits decline quarter-on-quarter for this quarter. So, PAT growth also declined higher for PSU banks on a sequential basis. So, PSU banks' profits declined by more than 40% quarter-on-quarter versus a gain of nearly 3.3% sequentially for private banks. Overall, banking sector's PAT declined by 1.3% quarter-on-quarter, and this is ex of AU Small Finance Bank. Dhanlaxmi Bank was the only lender to report net loss in Q1 FY25. PAT declined YOY and quarter-on-quarter for players like Equita Small Finance Bank, Ujjivan Small Finance Bank and IDFC First Bank as well. 14 lenders saw their PAT decline on a sequential basis. Coming on to asset quality, private bank slippages increased substantially when compared to that of PSU banks. So, private banks' quarterly slippages increased by nearly 11% quarter-on-quarter when compared to 6.5% growth quarter-on-quarter for PSU banks. So, overall, slippages increased by 8.7% quarter-on-quarter in Q1 FY25 for the banking sector. The slippage growth rate that you are seeing in Q1 FY25 was 8.7% quarter-on-quarter. This compares to more than 10% quarter-on-quarter ex of AU Small Finance Bank that the banking sector saw last year, that is Q1 FY24. Now, asset quality of the banking sector continues to remain robust, one of the best in last 9 to 10 years. So, sequentially, highest increase in gross NPA ratio and net NPA ratio was seen for private banks in last 3 years or even 12 quarters. So, absolutely absence of recovery and upgrades largely has impacted their asset quality, along with the fact that slippages were on the higher side as well. Interestingly, net NPA ratio difference between PSU banks and private banks is now only 19 basis points, the lowest ever seen in the banking sector. In FY18, remember that this gap was about 552 basis points. In terms of outlook ahead, analysts do say that deposits for private banks coming in at a huge cost. So they continue to see the rise in deposit rates, which can impact the net interest margin to decline further. Now, weakening government business and private banks making inroad into SURU, that is semi-urban and rural market, deposit growth has weakened for PSU banks. Loan growth is slowing down, especially for lenders with high market share. Credit cost and asset quality will rise owing to normalization in FY25. Now, microfinance loans and unsecured loans have seen deterioration in asset quality, which can increase pressure on earnings going ahead as well. 6 states are going into elections in the next 18 months. So any farm loan waiver, if that comes in, can impact lenders as well. These states, remember, they form about 20% of system's agri loans and have double-digit NPAs already.
Interesting data compiled there, Abhishek. Thank you for bringing that to our attention. Get into a break. Stay tuned. Halftime report is up next.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com. CNBC TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence and in-depth reporting that makes CNBC TV18 India's #1 business news brand. Foreseeing change, growth and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC TV18, your trusted partner and investment ally.
See that Chetak is now close to about 18% market share, or just above 18% market share. We are neck to neck with our able competitor TVS and their iQube. I think just a few hundred vehicles separate us. Having just launched a third product, there are more due later this year, within this financial year. We talked about it the last time we met a couple of months back.
The benchmark Nifty index hovers near the 25,000 level and within striking distance of its previous all-time high of 25,078. Realty and capital goods are the big gainers, even as FMCG and energy drag.
Mediassist buys the second largest group TPA Paramount Health Services to further cement its position in the market. The indicated valuation of the deal gets a thumbs up from analysts. The stock jumps up in trade.
Crude sees strong gains overnight on escalating tensions in the Middle East, stoppage of production in Libya and declining inventories, while metals get a boost from a pickup in Chinese demand.
RBI Governor Shaktikanta Das expects unified lending interface to digitalize credit delivery, just like UPI digitalized payments in the country. The platform will access records in different silos to speed up credit approvals with little or no documentation.
Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Nigel D'Souza. Well, what we are seeing on the screen is a little bit of follow-on buying. So yes, maybe the enthusiasm is tempered a little bit at this point in time, but we were just about 5 points away from the record high or the previous record high for the Nifty today. So we're probably going to get there soon enough. But nonetheless, we have the Bank Nifty as well as the mid-cap index, which is leading from the front today. So up around 0.3% for both of these indices. The advanced decline ratio favoring the declines. A lot of companies in focus on account of their AGMs. So we have Maruti, IndusInd Bank, Imami, and then we have RIL, the big boy, which will take place on Thursday as well. So we have a lot to watch out for in the next couple of days. Hi, Nigel.
Hi, Ekta. And a couple of stocks are moving. We have the Nifty Financial Services Index that plays out the weekly and as well as the monthly expiry today on the futures as well as on the options side. And you have SBI Life, HDFC Life, both of them buzzing in trade. Both of them actually are relative outperformers, and that's why the Nifty Financial Services Index as well is doing quite well in today's trade. Even from the broader markets, there are quite a few big winners. Tata Elxsi, in 2 sessions, the stock is up close to around 15%. So big move is what we're seeing out there. And GSPL has come off a little bit from the highs of the day, but that one as well is bucking the trend. It's spiking up on very, very large volumes. But Ekta, let's get straight to the first management that we have on the show.
Well, yes, absolutely. Poly Medicure is the first company that we're watching out for. The company's raised around 1,000 crores via QIP and has indicated the proceeds will be used also for inorganic opportunities. To discuss this and more, we have Himanshu Baid, who's the MD of Poly Medicure, joining in. Mr. Baid, thank you very much for taking the time out. Well, if you could just start by giving us a sense in terms of this 1,000 crores that you've raised via QIP. What is the kind of interest that you did see? How many investors participated? How many were probably foreign funds, domestic funds? And what's the utilization of funds?
So I think, thank you very much for having me on the show. I think the most important thing was that the common theme across outside India, especially the foreign investors, was that nobody was investing more in China in last 1.5 years. And even in our sector, medtech sector, I've seen that most of the large companies have kind of trying to move away from China. So I think now that China plus one story is playing very well. And for us, I think what's very important to build more capacity, more plants, so that, we can, cater to, let's say, more larger markets, global markets. Our business is still export driven. So we are seeing more traction coming to us from global markets. And that's the reason that we're building 3 new plants out of this QIP proceeds. And of course, we're keeping some watches for some acquisition opportunity, which we'll look into it in the next 4, 5, 6 months. And some money will go get into the GCP, general corporate purpose.
All right. Hi, Mr. Baid. Good morning and good to see you. When I recall talking to you when the market capitalization of the company was a third of what it is today, and you said that, Nigel, there's immense potential, unorganized to organized, and even import substitution. It appears the street, in fact, is playing that story as well. Let's understand a couple of numbers then. 1,000 crores is what you have raised from a whole host of investors. So break it up for us. In the past, you have, I think, mentioned medtech is something that you were interested in. So will the acquisition be from that space? And what is the quantum of this 1,000 crores? How much would be inorganic? How much of it would be the core capex? And how much of it would be corporate governance that you were talking about?
See, basically, Nigel, we want to focus on technology because India, if you look at the current state of affairs, we are still 70% import dependent. So we need technology for manufacturing in the country. And our idea is to look at companies outside India where there is technology and where we can bring this technology and then grow it globally, which we have done in the past in our oncology business. We are seeing now big traction there. We did a small acquisition in Italy in 2019. So that's worked well. So I think similarly, we are looking at technologies in critical care or cardiology or in let's say, oncology space or renal space where we can expand. These are some of the businesses we are focusing on right now. And when we look at the allocation, so around 250 crores from this QIP is getting into allocation for future inorganic opportunities. And if we need to add more capital to it, depending on the business or acquisition we do, we'll add it from our internal accruals, or even we'll take debt to do that. So I think the bigger idea is here to look at outside India for new technologies.
Okay, so you would look at outside India for newer technologies. But would that be more complex technologies, Himanshu? Because, the trend is that India is probably becoming more apt when it comes to consumables, when it comes to medical technology and export of that. But where we are lacking is probably high-end medical technology. So is that a space that you're looking at closely? Is that a space that you're going to probably look at in terms of inorganic acquisitions? And would 250 crores be enough for that?
See, I think the amount is not enough, right? So I want to answer that first. So I think, as I said, we'll add maybe more money from internal accruals or through debt. The important thing is our focus has been on import substitution. So we are still importing a lot of critical catheters, critical devices, and our focus will be to expand in that same area of critical, devices. And most of it is import driven today in the country. So we will be working on substituting that by making them in India. And then again, going to global market, because today we are exporting to over 100 plus countries. So the target would be to make them in India, make them at a good pricing, bring in new technology, and then go to global markets.
Okay, all right. Let's get to the numbers then. The guidance, I think, for this year is around 20 to 24%, Mr. Ved, revenue growth?
Yes, we are sticking to that guidance, Nigel. Definitely are sticking to the guidance.
And with the margin improvement of 150 basis points, I understand.
Yeah, that's correct. That's correct.
All right, break it up for us then in terms of, the smaller businesses that are expected to start to contribute. The renal business, what kind of revenue will it do in this year? You also launched the cardiology business. So what could that be? And the third driver is the US business, which is very, very small, but has a potential to grow. So on all these three parameters, what will the contribution be?
See, on the renal side, we are seeing the contribution going from almost 90 crores to 150 crores this year. So this business is actually now picked up well, and we see a big potential in India. And now next year we will also focus on export market. I think that's what we want to do in renal space. But India itself, the target is in next 4 to 5 years, we want to have around 20% market share of this category. And cardiology is a very, very new area for us. Just started a few months ago. So I don't have a guidance on this area right now, but I think the target is that in maybe next 4 to 5 years, we want to reach between 300 to 400 crores in cardiology business in India and outside India. And that's how we are building product and product portfolio in this area and focusing more on interventional cardiology today. And later on, we'll get into more, let's say more on the surgery side and maybe more on the structural heart side. That is what we want to do. Critical care, which we started. Yeah. Sorry, say again.
The US business also. So we got renal goes from 90 to 150. Cardiology will be 300 to 400 in the next 3 to 4 years. And US 4 to 5 years.
4 to 5 years. That's what we have.
And US for this year, how does it scale
up? On the US side, we have already given a guidance of 15 to 20 million over 3-4 years. So already, the exports have started to the US, and slowly we'll build up the whole, ecosystem, the whole supply chain. And we already have contracts in place. So we are building more products right now for the US market. So hopefully this year we will, end up doing close to around 2 million revenue. But then going forward 3 to 4 years should build up to around 15-20 million.
Okay, so you'll do around 2 million in terms of sales in the US. Just wanted to understand, Himanshu, there's a lot of PE interest which is being seen in the entire medical devices space, in the unlisted space at least. Give us a sense in terms of, what the interest is when it comes to private equity, probably for your company. Have you been approached to whatever extent you can talk about? And what are the industry dynamics at this point as well?
I think it's very clear that the industry is kind of carved out now from the pharma sector. And today we are 70% import dependent. So I think this gives a lot of, let's say, opportunity to domestic companies to scale up in India and also for the global markets. Because I spoke about this China Plus One playing very strongly. And there are very few limited opportunities for companies to manufacture products outside of China. And I think India promises to be the best place to manufacture these products. So my view is very clear that Indian medtech sector will grow very rapidly in next 5 to 7 years. And I think that's the reason that today Ps want to invest more money in this sector and expand. And I think globally medtech is on a roll right now. If we see US market, every company is doing well. In Europe also, almost every company is doing. So I think medtech per se is a sector which is going to be, pretty, say solid for next 5 to 7 years.
And any other segment that you would be looking to enter? You're in renal, you're in cardiology, but any other segment that you're looking at within the Indian space?
So I think it's more of a, let's say, natural progression. So maybe in future we could look into urology or gastroenterology, which are maybe closer connected to renal segment. So, but we have to keep on building the competence in every product area and also develop that clinical excellence. So I think that's what we are working on right now.
Okay. All right, Himanshu, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is Polymed talking about 1,000 crores that they raised via QIP, and the company is looking to spend around 250 crores when it comes to inorganic opportunities, sticking to their guidance in terms of revenue growth, and would look to do around $2 million in terms of US sales this quarter. We take a short break. On the other side, Abhishek will focus on some insights on valuations of Cholamandalam and Bajaj Finance. Stay tuned.
Post the festive season and before March, certainly there will be more Chetaks in the marketplace. And I could reiterate what I shared with you the last time, that not only will there be more Chetaks in the market off the current platform, hopefully very sharply positioned, but there will also be a new Chetak platform. As we head into the festive season, in the months of September, October, November, we are very likely to cross a monthly sales production and sales rate of over 100,000 clean energy two-wheelers and three-wheelers. But I would hazard that definitely over 25% of our current revenue is already coming from or about to come from clean energy vehicles, which is quite remarkable.
Welcome back. Well, a few stocks. Just take a look at CESC. That one's continuing its upward trajectory. So big move is what we're seeing on CESC. Add to the list Amara Raja. The stock had cooled off a little bit of late. Month to date, it's down closer around 2.5%, but today it's moved up. It's up closer around 5% as we speak. So solid up move is what we're seeing on a couple of these counters. But as promised, let's focus on the NBFC space. Abhishek is standing by with some insights on the valuations of two stocks, Cholamandalam and Bajaj Finance. Abhishek, tell us how the valuation is shaping up for both these two names.
Well, under Valiant, the valuations of Cholamandalam and Bajaj Finance have seen a convergence. So Bajaj Finance for the longest time was believed to be the most expensive NBFC in India with respect to price to book value. That spot has been taken by Cholamandalam. So in the current calendar year, Cholamandalam's stock movement with respect to the price has been that it's moved up by 10%, while on the other hand, Bajaj Finance stock price has actually declined by 8%. Hence, if you take a look based on Citi's estimate of book value for both these companies based on FY25 book value, now Cholamandalam trades at 4.8 times, while Bajaj Finance on the other hand trades at 4.5 times 1 year forward price to book value. Based on Citi's estimates, the return ratios of Cholamandalam is expected to improve in FY25, while that of Bajaj Finance is expected to decline in FY25 versus FY24. So Citi estimates ROA, that is return on asset, of Cholamandalam to be at 2.7% in FY25 versus 2.5% in FY24. Citi estimates ROA, that is return on asset, of Bajaj Finance to decline to 4.1% in FY25 when compared to 4.5% in FY24. Now again, Citi estimates ROE, that is return on equity, of Cholamandalam to be at 22% in FY25 versus 21% that it was there in FY24. So again, Citi estimates ROE, that is return on equity, of Bajaj Finance to be at 20% in FY25 when compared to 23% that it was in FY24. So it's important to note that return ratios of a lender do weigh on the valuations of that lender as well. AUM growth as per Citi's estimate is largely expected to be strong both for Cholamandalam as well as Bajaj Finance in FY25. So on a YOY basis, Chola's AUM growth as per Citi is estimated to grow at 29.65% YOY, while that of Bajaj Finance is expected to grow at close to 27.5% in FY25. Operationally, Citi estimates better performance coming in from Chola when you compare to that of Bajaj Finance. So Citi estimates operating profit growth for Cholamandalam to be at 40% YOY in FY25. This compares to 26.5% that they have estimated for Bajaj Finance. Again, Citi estimates provisions to rise by nearly 46% for Cholamandalam in FY25, and that compares to 58.1% that they have estimated with respect to provision rising for Bajaj Finance in FY25. Citi estimates PAT growth to be at about 37.7% in FY25 for Cholamandalam on a YOY basis, while that for Bajaj Finance they estimate a PAT growth of 18.8% in FY25 YOY, that is year on year. Back to you.
Okay, all right, Abhishek. Thanks very much for that comprehensive analysis. Thanks. So that's the difference between the two NBFCs. But let's move on then. MediAssist is in focus as it's announced the acquisition of Paramount TPA. Yash is here with the details on this particular acquisition. Yash.
Well, Ekta, it's one of the largest acquisition that we've heard of in the insurance TP or the third-party administrator, sector. MediAssist has announced the acquisition of Paramount TPA, and this particular transaction will happen at an enterprise value of about 312 crore rupees. The equity valuation of this particular transaction exceeds about 400 crore rupees. Now, MediAssist has very recently also acquired two another companies in the TPA sector. One was, of course, Raksha TPA, and the second one was Medvantage. As far as Raksha is Paramount TPA is concerned, it's 3 times the size of Raksha TPA, and it is about 7 times the size of Medvantage. As far as valuation is concerned, Paramount TPA is pegged at about 2.5 times sales versus Raksha that happened 1.7 times sales, and Medvantage which happened just at 1 time sales. MediAssist itself trades at about 5.2 times sales and 47 times enterprise value. So it's a decent valuation at what it itself trades, giving it an additional market share. How much market share does MediAssist get through this acquisition? The acquisition will take MediAssist market share in the group segment higher by about 6% to 36.6%. Also in the health insurance segment, it will take the market share higher by about 4% to about 23.6%. So of course, the acquisition comes in with the larger, ideology of the business in the group segment. It adds significant market share to what the company has at this point of time and comes at a decent valuation, explains why the stock is up in today's trading session.
Okay, all right. Thanks a lot for that, Yash. Well, NIT, that continues its dream run. The stock is up more than 15% today. It's up 50% in 3 sessions. The promoter's hike stake and Mr. Ramesh Tamani as well a few sessions ago pocketed 8 lakh shares. Rima joins us to run us through a quick analysis. Rima.
Hi, thanks so much for that. So last week on the 22nd of August, the promoters, the Thadani family, bought over 35 lakh shares in the company via a block deal, raising their stake to 37.2% versus 34.5%. So a substantial stake increase. Now this happened on the 22nd of August, that's a Thursday. Then on Friday, veteran investor Ramesh Tamani checked into the company and acquired 8 lakh shares. So since then, the stock has been excited. It rallied on Friday, it rallied 20% yesterday, and it's followed it up with a big move, taking the 3-day gain to nearly 50%. But there are a lot of other notable shareholders that I'd like to draw your attention to. So amongst the FIs, you've got Massachusetts Institute of Technology with a 5.7% holding. Hornbill Orchid India has a 2.5% holding. Amongst DIIs, Nippon India Mutual Fund, the small cap one, has 8.2%, and Marathon Edge has close to about a 3% stake in NIIT Limited. Back to you.
Okay, all right. Well, strong gains coming in for that particular company. Thanks, Rima, for that. NIIT, which is up around 16% odd. But for the markets, there are a couple of other movers. Just watch out for Castrol India. That stock is up around 6 odd% at this point in time, and it's done very well this year. It's up around over 50 odd%. Giving it company is MedPlus, which was in focus yesterday on account of a large trade. That stock is up around 5 odd% at this point. So a couple of these stocks in focus. We'll take a short break, but Sachitanan Uttekar of Trade Bulls will join in with some trading calls. Stay tuned.
Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc.
Welcome back. Well, the markets are sitting with some mild gains. We're a little bit away from the fresh all-time highs, but par for the course. I'm just looking at the options data, and that's giving you confidence that this market has got the momentum with it. Let's look at the Nifty strikes. I'm looking at the 24,800 call, which was seeing a fair bit of action. Now, what's happened out there is those call writers, they are running for cover because now the stops are getting, triggered. If you're writing the 24,800 call, you were hoping that the markets don't go above the 25,100 mark, which appears now it's inside. So that's why there is some unwinding at those levels. But also you pull up the 25,000 put, there is signs of writing out there. And in an uptrending market, you want to see the nearest possible strike, see a fair bit of addition. And that's precisely what's happened on the 25,000 put. For me, the trigger is, and I've been mentioning this the last few days, the Nifty Bank needs to get past the 51,300, 51,400 mark. Why is that important? Because that's been a bit of a resistance zone, and that's where the 50 DMA as well comes in there. So we have visited this mark numerous times, but we have not able to conquer that. So that's the important mark. Keep an eye on that. We are holding above 51,300. You want it to perk up a little bit and get past that 51,400 odd mark. Let's get a technical check then. Sachidanand Uthekar of TradeBull joins us on the show. Hi Sachi, I just stated out some levels that I'm looking at on the Nifty Bank as well. Tell us, how would you trade the index though, and fill us in with your picks.
Good afternoon, Nigel. We have already beautifully explained the setup. In fact, my job is very easy now. If you look at the overall structure, the Nifty has been looking very confident since last week, the way it has been holding itself above its 5-day exponential moving average support. Now, this particular support has moved higher towards 24,900. And if you look at the options data, 25,000, also looks like a probable support. So we may see a very strong extended rally, which may push the Nifty towards 24,450. Now, this is a particular target that we have been indicating since last couple of weeks. So we are of the opinion that the ADX on the daily scale has started moving up above the 25 mark, which is a very strong, convincing sign of momentum. So the market structure looks clear. We may see during the day itself Nifty moving towards 25,120. Eventually, the positional target is well set at 25,450. And on the lower side, the support looks very strong at 24,800. So I think every opportunity, whenever the Nifty is consolidating, we are indicating and build further long positions.
Okay, and what about specific stocks, Sachi?
Good afternoon, Ekta. I think the OMC pack has been very consistent within this particular space. We like BPCL. On the weekly charts, there is a clear-cut bullish flag formation, which is indicating a price target somewhere close to around 372. Even right now, we saw an intraday dip towards the 5-week exponential moving average support, which is placed somewhere close to around 342. From there, the recovery has been very strong. So I think there could be a very strong short covering move which may unfold here, which may push the stock price higher towards 372 within a week. That's why we are recommending building long positions with a stop loss at 343. And on LNT, there's a diamond formation which has been exhibited. Now, this particular formation was ensuring that the price was oscillating within the range of 3750 on the higher side and 3550 on the lower side. But if you look at last couple of trading sessions, the stock has confidently started trending about that 3600 mark. There's a good convergence of its 520 and 50-day exponential moving averages. So I think the cluster support is now placed at around 3600. And with the convergence of moving averages, it is an indication that there could be a very strong directional momentum play here. We are anticipating that this particular move may extend towards 3940 on a positional basis, and that's why we are recommending building long positions here when it comes to LNT. The stop loss for the trade can be placed at around 3670.
Okay. All right, Sachidanand, we're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us all of those strategies. We need to take a short break with the news that the Nifty is just about consolidating with a positive bias, up around 33 odd points, Sensex up around 100 odd points. Bank Nifty is speeding ahead with a gain of around 0.3% comparatively. Take a break, but on the other side, we have Pranav Bansal, MD and CEO at Bansal Wire Industries, to discuss their business. Stay tuned.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today. Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV18 Embark Pro.
Welcome back. You're tuned in to Halftime Report. Well, if you look at the metal index, it's a little bit lower in today's trading session, but Vedanta is still holding well in the green. I understand that Mr. Anil Agarwal, he's in town, and in all probability, he could be meeting some of the larger investors. So that's what could be giving some kind of a hope. Remember, the stock went to around 500 rupees and then corrected all the way to around 410. So that's why it's making up some part of that lost ground. So we'll stay tuned to any update coming in from the promoter entity. Well, let's focus on Bansal Wire Industries. That's the one in focus. We have Investec. They've initiated coverage, buy rating on the stock, and they've listed out a few factors to understand whether or not the management's vision is matching with what Investec has to say. We have Pranav Bansal, the Managing Director and CEO at Bansal Wire Industries. Hi Pranav, good day and good to see you win. Well, Investec has put on a whole host of points, and two factors that they have focused on is backward integration, and the other one is the foray into specialty steel wires as well. Let's focus on the backward integration first, on the stainless steel side of business. The stainless steel rods is what you're backing up your unit with. They are talking about the EBITDA per ton moving up substantially. Could you tell us what could the potential savings be on a per ton basis? And do you believe that the EBITDA per ton on stainless steel wires moves from that 7,000-8,000 to around 15,000 in the coming years because of this backward integration?
Yeah, sure. So just to give you a background on this product, we are already the largest stainless steel wire company in India. And with this backward integration, what it will help us do is, of course, increase our EBITDA, but in the same, with the same thing, we will also be able to increase our quantities. Right now, we do about 70,000-80,000 tons of stainless steel wire. With this backward integration, we are targeting a capacity of about 1.5 to 1.8 lakh tons. And definitely, the EBITDA will almost double from the current 7,500 tons, 7,500 rupees per ton. It will go up to 15,000 rupees per ton after this backward integration.
Got it. Okay. All right. So we got that part of it with regard to you'll do bigger volumes and also you'll double your EBITDA per ton on the stainless steel wire part of the business. Got it. The other factor they're talking about is your foray into specialty steel wires. That's through steel cord wires. What capacity are you looking at, and what will be the steel cord EBITDA per ton? I understand that it could be in the vicinity of 40 to 50,000 rupees per ton. Can you confirm? And what about the volume front?
Yeah. So again, specialty steel wire is a segment that we are adding within this financial year. We've already started, or we will start within this financial year, a pilot project of 20,000 tons for steel cord. The potential for this product for us is 200,000 tons that we will add in the next 5 years in a phased manner. Right now, this is a good product for us right now because there is no other company. We will be the first Indian company to make this product. Right now, the demand is completely fed by imports and a Belgian company called Beck.
Got it. What can be the EBITDA per ton, Pranav? Sorry, the line is a little scratchy, so I just want to understand what is the EBITDA per ton? I believe it's 40 to 50,000 rupees per ton. Can you confirm? And also, you're talking about 200,000 tons, but Investec, they have assumed only 70,000 ton of capacity, and you will manufacture around 35,000 tons. You want to counter that? Will you do better than that?
So right now, the potential that we are looking at for this product is 200,000 tons. But yes, of course, this will be done in a phased manner. So by FY24, 25, 26, only some of it will be onboarding. And plus, there is a long approval process. So just installing capacity will not help us utilize it as well. There is a lead time for that.
Okay.
So even that number that Investec has put, I would say it is good for us, because as a company, in the last 10 years, we've grown at 20-25%. With only those numbers that Investec has put, we will be able to achieve a higher value, which is good for us.
Okay. All right. But Pranav, if we have to talk about the whole business as a sales mix, based on the fact that you're also looking to get into these new segments, specialty steel wires, like you mentioned, and competition seems to be lesser within that space. What would your entire profile of sales look like, say, for example, low carbon, high carbon stainless steel, say in the next 2 odd years?
So we are in an industry where, being the second largest steel wire company in India, we only have 6% market share as a whole. So I would say there is a potential of growth in each and every segment. Yes, definitely, we are focusing a little more on specialty wire because this is a new vertical. But with that being said, all our 3 products, low carbon, high carbon, and stainless steel, will grow at its own pace as we have been. Plus, there will be a good increase in low carbon wires because of consolidation of our group structure. We are consolidating 2 of our group entities in this Bansal wire, which will give us a big jump in low carbon wires. So as a whole, all our products are going to increase. In fact, we've already set a plan to increase our capacity by 2.5 times by the end of this year. And this will only keep on growing every year.
Okay. So based on the amount of capex that you have, as of now, your balance sheet, I understand, is almost debt-free. So how exactly are you funding this capex? I think it's assumed to be around 2,000 crores in the next 4 years. Just give us a sense in terms of where exactly this money is going to be coming from. What is the debt figure that you're comfortable with? And what is your cash flow like as well?
So in the next 4 or 5 years, I would say a couple of things will happen. First, most of our expansion will come from internal accruals. Because right now, all the debt that we had on the balance sheet is almost zeroed down because of the IPO money that we got. And in the future, also the kind of expansion that we are planning, this would only be funded by majorly internal accruals or some level of debt. As a whole, if you look at our business for the last 10 years or 20 years, we've been at a very stable margin kind of thing. So our EBITDA or our profitability has been very, very stable every year. Therefore, we are also comfortable with a good amount of debt on our balance sheet in the future.
Got it. And I think your operating cash flow is approximately 800 crores odd, so that's what's giving you some kind of confidence. Give us 2 more numbers. We look at volumes and a blended EBITDA per ton. Now, I'm looking at the Investec note. They are talking about you doing 505,000 tons in FY26. And from there on, they're saying that it will scale up close to around, you are guiding for around 600,000 tons. So could you tell us what is your estimate on the blended volume front, point number 1? And the EBITDA per ton, I understand, as of now, you're doing around 8,000 rupees per ton. But because of the backward integration, because of the better mix, do you see it going to 10,000 rupees, say by FY27?
So if you look at our numbers in the last 2 years, as a company, we've not actually been able to grow at the 20-25% that we have been, majorly because of the delay in the new facility that has now only started. Because of this facility, by the end of this year, our capacity will already be there for 600,000 tons. Now, whatever is what remains is for us to utilize it. And till now, we have been able to utilize all our expansion very well in the next 1 year or 2 years. And this is what we are hoping for in this expansion as well. With this, we are also adding a lot of new products other than just steel cord and backward integration. There are small products that we keep on adding every month. So with a mix of all of this, I think we are quite comfortable with what Investec has given us as a target for our sales.
So, but for FY26, 600,000 tons should be doable, keeping in mind the Dadri facility comes on stream, which has the automation as well, with an EBITDA per ton of 9 to 10,000 rupees. Can we work with that?
So EBITDA per ton completely depends on the product mix. Whatever Investec is, I would say that we will try our best to focus on that. But as a whole, as a company, we've grown at 20-25%. So it is only fair for us to commit a number which is 20-25% even going forward. Yes, the opportunities are there. We have a big investment in here. We now have a good capacity. The growth of all our sectors are better than what it has been. So we should be able to do a little better. But for me to commit a number right now would not be possible.
Okay, all right. But you seem fairly confident that you can go ahead and meet what Investec has done, and probably on some parameters you're looking like you can outdo that. So we'll hold you to these numbers, Pranav. It's been a good listing for you and a lot of excitement as well post this brokerage note. We look forward to having a chat with you and understanding further details with regard to your return ratios as well as your working capital cycle. For the time being, though, we'll slip into a short break. You come back, we'll continue our focus on markets and stock-specific action. Don't go anywhere.
Century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Welcome back. Well, a couple of these pharma stocks are doing well today. So Glenmark is continuing to gain after its numbers which came out around 2 weeks ago. So that stock is at a fresh 52-week high. We have Cipla, which is giving it company, which is at a fresh 52-week high, along with Alkem, which is at the best levels that it's seen in a year, along with Jubilant Pharma as well. So all of these stocks are managing to gain some amount of traction in today's trading session. In fact, even Aurobindo Pharma has moved to a 52-week high, despite a lot of negative news circulating it with regards to one of their UGR units 3, which is under the regulatory scanner. But nonetheless, that's on a couple of stocks at this point in time. Let's focus on a CNBC TV18 exclusive. Sources say that LIC has reached out to IRDAI seeking a review of surrender value regulations. Yash is here with more details on the same.
Well, Ekta, we just have about a month to go before the new surrender value regulations, which are issued by the insurance regulator, become effective. They start to become effective from 1st October. And just a month before that, what we've been given to understand is that the largest life insurance company, LIC, has written to the regulator seeking not an extension to the timeline, but a review of certain aspects of the increased surrender value regulations. Of course, we've been reporting constantly on it, how the surrender value was increased significantly, going to as high as 75% of the total premium from the current 30%. And there are certain aspects of the regulation where LIC has sought a review from the regulator itself. There are two specific points, if I could take you through both those points. For the calculation of surrender value, as per the formula which has been specified, one important element which comes in consideration in the calculation of surrender value is the 10-year GSEC yield. Largely assuming that at about 7%, the IRDAI in its regulation had given a 50 basis points cushion, which means the insurance companies could take the interest rate for the calculation of surrender value to be about 7.5%. The first ask from LIC is to increase that spread of 50 basis points. The numbers not been specified, but the demand is to increase that spread, have a higher spread for the calculation so that the surrender value which they have to pay to their policyholders in situations of early surrender of policy comes down. The second, ask from from LIC is that, instead of hardwiring the 10-year GSEC yield into the regulations, which again assuming could be about 7%, let's have a plan-based interest rate, which means a particular insurance plan which invests in 30-year government securities should have the benchmark as the 30-year GSEC yield, and of course the plan which invests in 10-year government securities could have a 10-year GSEC yield interest rate as its benchmark for the calculation of surrender value. The difference in currently, as we see, for 30-year it's about 7.1%, and for 10-year is about 6.86%. But this could be a meaningful number as the number of policies for the calculation of surrender value increase, and of course the amount compounds by itself. So this difference is what LIC has asked for. First one, to increase the spread for the calculation of surrender value, and the second ask from LIC is to not hardwire the 10-year GSEC yield for the calculation of surrender value, rather have plan-based GSEC yield, which means 30-year, there could be 30-year GSEC yield, and for 10-year plans where investments are made, there could be 10-year GSEC yield consideration for the surrender value. This could, of course, ultimately bring down the surrender value which LIC has to pay to its policyholders and could be beneficial for them. So these are the two demands. We'll have to see if the regulator considers them positively or not.
Okay, all right, Yash. Clearly, that news has got the market excited. LIC now at the high point of the day, as his insurance stocks are doing well. And now, post this exclusive from Yash, we have LIC stock moving to the high point of the day. For the time being, though, we'll slip into a short break. On the other side, we'll take a break from equities. We'll focus on the commodity markets. Manisha Gupta will be joining in to help us out with something on that front. Stay with us.
Welcome back, and joining us on the show now is Mr. Atul Chaturvedi. He's Chairman, Asian Palm Oil Alliance. Mr. Chaturvedi, hi, thank you so much for joining us. And finally, some good news on horizon. There is a proposal that has gone in from the Agriculture Ministry, and this is about increasing the import duty for edible oils, something that the industry has been asking for over a year now. But with Agri Ministry now getting involved and a proposal through, you think this would see the light of the day sooner than later?
Honestly speaking, Manisha, Agriculture Ministry has been pitching for higher import duties for quite some time. But somehow or the other, their pleas were getting rejected by the Consumer Affairs. And obviously, that's because India was facing elections and the government was worried as far as the food inflation is concerned. But now, this time around, we have a minister who carries a lot of weight. And the other thing is that he comes from the state of Madhya Pradesh, which is going to be marketing soybeans in the next month or so. So I'm sure with the soybeans actually selling almost 700 to 800 rupees, much below the minimum support price, this time it seems his voice or the Agriculture Minister's voice might get accepted. So we are hoping whatever we've been asking the government to do for quite some time now might actually turn out to be correct this time around. Let's see how things pan out. I hope it doesn't end up being a wild goose chase. Yeah.
We hope that too, Mr. Chaturvedi. Also, the point being that from the kind of MSP that has been put out by the government for soybean and for groundnut, the prices for both of these commodities are way below the MSP. We've heard of some agitations from farmers, from MP. There is, of course, elections waiting in Maharashtra to happen. Would you say that it could get farmer-centric from here on?
No, it should. In fact, the oilseed farmer has been shortchanged for quite some time now. And that's largely because India was facing elections and the government was worried on the inflationary impact of edible oil. But the trouble is that you were having headache, but you were putting the balm on your knees. In fact, if you look at the inflation, it was largely driven by vegetables and pulses and not by edible oil. In fact, edible oil was actually suffering from deflation and not inflation. So I think finally it seems that the government might see reason and they might impose. And the other thing which I thought is important is India should not fight shy of imposing duties. Because at the end of the day, if you impose higher duties, part of it is actually borne by the exporting nations like Indonesia, Malaysia, or Latin America, Argentina and all. Because there the values would come down. So I think India should not fight shy of imposing duties.
That message seems to be going loud and clear right now, and the expectation that this could come across as early as in the month of September, the first week itself. Mr. Chaturvedi, the other thing is, what is the kind of demand that you're looking at for India, especially ahead of the festival season? The numbers actually tend to get bigger. On a year-on-year basis, what is the kind of edible oil demand that India is looking at? People are eating out, so whether it's Horeca, it's hotels, it's institutions, food products, and in-house, all of those numbers are growing. What is the total number that you're looking at right now?
In fact, when the Indians imported massively in the month of July, hoping for duties getting jacked up, the demand actually fell and the prices in the country also suffered big time. But for almost now, last 15 odd days, we are seeing demand coming back with vengeance. And the other thing is that the festival season is just around the corner. So I think demand at this point of time is reasonably strong, whether it remains strong or not. But if we keep on listening that duties are coming, I'm sure that would help domestic demand reasonably strongly. My take is that this year our imports could be closer to about 16 million tons, even though this month I think has been a lot more sensible because we had imported far too much in the earlier months. This year we are putting a number at around closer to 15 million tons. And that should help improve the domestic values. But the other thing is that we are what we are getting from the ground level is that the soybean crop is shaping up very well, and groundnut is also shaping up very well. And Gujarat, for a change, is getting very good rains.
Very good rains.
All that
Yes,
should
we've been
help.
seeing those pictures. Yes. Mr. Chaturvedi, thank you so much for joining us. Well, yes, Gujarat scenario, Gujarat crop numbers, all of that on the positive side. And of course, we are anticipating an import duty hike, and that could support prices. And we take your point on the fact that the demand ahead of the festival season also really seems to be picking up. Well, that's about edible oil as a sector, and that's all the time that we have on the show as well. But stay tuned, because Business Lunch will take all the action ahead.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now,
The benchmark Nifty index hovers above 25,000 and is within striking distance of its previous all-time high of 25,078 level. Realty as well as capital goods are the big gainers today, even as FMCG and energy drag.
Mediassist buys the second largest group TPA, Paramount Health Services, to further cement its position in the market. The indicated valuation of the deal gets a thumbs up from analysts. The stock jumps.
Crude sees strong gains overnight on escalating tensions in the Middle East. Stoppage of production in Libya and declining inventories, while metals get a boost from a pickup in the Chinese demand.
And RBI Governor Shaktikanta Das expects unified lending interface to digitalize credit delivery just like UPI digitalized payments in the country. The platform will access records in different silos to speed up credit approval with little or no documentation.
Hello and welcome to Business Lunch. I'm Nisha. With me as always is Hormaz, and market is looking green today. Let's take stock of the markets at lunch hour. So Hormaz, minor gains but still holding up above the 25,000 level. That's the big story, that it's comfortable above that. Of course, the high point of the trading session was above 25,070 odd levels, and it's only minor step down from the highest levels or the all-time record highs for Nifty 50. But it's been a tight range in which it has moved and closer to the higher point of the trading session. When we talk about Sensex, it's comfortable with over 100 points gain at this particular point. Bank Nifty is showing outperformance to the key indices and is up almost close to 0.4% in trade. And so is the case with Mid-Cap Universe, also outperformance to the key indices which are trading cautiously and with minor gains. So mid-caps 0.3% up, and that's also revving up the strength of the market today with advanced decline ratio in favor, comfortably in favor of the advances. On my screen at this particular point, life insurance companies, SBI Life, HDFC Life doing well. Some of the auto stocks are also looking good in trade today. Hormaz.
Well, we came within 5 points of scaling past that previous record high on the Nifty, which was 25,078. We made a high of 25,073, and we have slightly reversed from those levels now, but still at around 25,050 is where the Nifty is. Very crucial last couple of hours coming in for the trading session today, and the Nifty Bank, as Nisha was mentioning, is the outperformer in today's session, also because it is trading at a very crucial level. It's trading at around 51,350. Now it's trading above that level. It's trading above that 51,250 level, which it was supposed to sustain. It is the financial services expiry today. We'll keep an eye out on the Nifty Bank, and that might just ensure that the Nifty does cross that record high levels towards the final few minutes of the trading session. The broader markets are doing well for themselves. The small cap index is up 0.8%. The mid cap index is seeing some bit of gains in today's session, but there is plenty of stock specific activity and some flashes on your screen as well. Granules is one of them, and that's a CNBC TV18 exclusive, where there is sources are saying that a surprise inspection is underway at a key facility of the company, which is in Gagilapur in Hyderabad, and the stock has seen a nosedive after this news break. We'll get more information on this as the show goes by, but Granules India is the stock you need to keep an eye out for. Currently 1.5% lower, was flat before this news break, but now has taken a nosedive. But what on the flip side is having a very good day in today's session is Medi Assist, and that stock has been up and about in today's session right from the word go, still trading with gains of around 9%, and that is because it acquired Paramount Health Services for an enterprise value of 312 crore rupees. Yash is joining in with more details. Yash, tell us, what does this bring to the table for Medi Assist?
Well, it's quite an attractive acquisition which Medi Assist has made, one of the largest in the insurance third-party administrator space. The company, that is Medi Assist, has announced acquisition of Paramount TPA. Now, this particular transaction of 100% stake in Paramount TPA by Medi Assist happens at an enterprise value of 312 crore rupees. When you look at the equity value, that exceeds about 400 crore rupees. Now, just compare Paramount TPA and the transaction here as compared to the last two transactions which Medi Assist has done. Paramount TPA is 3 times the size of Raksha TPA, the last transaction which Medi Assist did, and 7 times the size of Med Advantage, of course another transaction which Medi Assist has done. Paramount TPA deal, the current deal that you're speaking about, happens at 2.5 times sales. The one with Raksha, that happened at 1.7 times the sales. Medvantage happened at just 1 time sales. Medi Assist itself, that trades at about 5.2 times sales and 47 times enterprise value. So of course, valuation is much more attractive. The company itself trades at about 5.2 times sales. The acquisition happening at about 2.5 times sales. So that becomes attractive from the valuation point of view. Apart from that, what does Paramount TPA bring on the table for Medi Assist? The first one, it
is the second largest TPA in the group segment as on FY24. It brings significant market share to MediAssist. The total market share of MediAssist in the group segment will increase by 6% to 36.6%. Acquisition will also increase MediAssist market share in health insurance space by 4% to 23.6%. So valuations attractive, incremental market share coming in, and the acquisition fits well with the kind of business that it wants to do.
And that's also reflective on the stock. That stock is revving up, almost 9% up. Thanks so much, Yash, for getting us all those important details. We now bring to you our special segment, which is Fin Street. And this time, my colleague Abhishek Kothari focuses on the banking sector's performance in the first quarter or FY25. Abhishek.
Well, in our banking sector review of Q4 FY24, we did highlight that in Q1 FY25, net interest margin of the banking sector will be under pressure. Credit cost and asset quality will rise owing to normalization. MFI loans and unsecured loans will see deterioration. Not much to our surprise, the results are quite the same. Net interest margin has come under pressure. Deposit growth is coming in at a huge cost for many lenders. Credit cost is rising. Deterioration is happening on asset quality, especially for private banks being higher than PSU banks. Pain has continued, especially for lenders having exposure to rural market like microfinance loans, and now even for lenders having exposure to unsecured retail loans. Let's take a look at this in a detailed manner. Now, it was a tale of two cities for PSU banks and private banks in this quarter. So PSU banks saw their operational performance being weak in Q1 FY25, while private banks, on the other hand, saw their asset quality deteriorate the highest in last 3 years or 12 quarters. Now, despite low credit deposit ratio, PSU banks saw their NII decline on a sequential basis. Private banks' NII growth was about 2.5% quarter-on-quarter, largely led by the high-yielding retail loans. Dhanlaxmi Bank is the only lender to see YOY and quarter-on-quarter decline in its net interest income for second quarter in a row. Now, calculation shows that the net interest margin might have declined by 10 basis points for PSU banks and improved by 7 basis points for private banks. So, overall, the net interest margin has declined quarter-on-quarter for all the banks at an aggregate level. Operating profits got impacted in Q1 FY25 due to weakness in NII growth that you had, lower treasury gains and higher OPEX as well. Overall, operating profits declined by 4% quarter-on-quarter. So, operating profits for PSU banks declined by 2% quarter-on-quarter, and for private banks, it declined by nearly 6% quarter-on-quarter. Now, again, Dhanlaxmi Bank is the only lender to report an operational loss for second quarter in a row. 19 out of 39 lenders saw their operating profits decline quarter-on-quarter for this quarter. So, PAT growth also declined higher for PSU banks on a sequential basis. So, PSU banks' profits declined by more than 40% quarter-on-quarter versus a gain of nearly 3.3% sequentially for private banks. Overall, banking sector's PAT declined by 1.3% quarter-on-quarter, and this is ex of AU Small Finance Bank. Dhanlaxmi Bank was the only lender to report net loss in Q1 FY25. PAT declined YOY and quarter-on-quarter for players like Equita Small Finance Bank, Ujjivan Small Finance Bank and IDFC First Bank as well. 14 lenders saw their PAT decline on a sequential basis. Coming on to asset quality, private bank slippages increased substantially when compared to that of PSU banks. So, private banks' quarterly slippages increased by nearly 11% quarter-on-quarter when compared to 6.5% growth quarter-on-quarter for PSU banks. So, overall, slippages increased by 8.7% quarter-on-quarter in Q1 FY25 for the banking sector. The slippage growth rate that you are seeing in Q1 FY25 was 8.7% quarter-on-quarter. This compares to more than 10% quarter-on-quarter ex of AU Small Finance Bank that the banking sector saw last year, that is Q1 FY24. Now, asset quality of the banking sector continues to remain robust, one of the best in last 9 to 10 years. So, sequentially, highest increase in gross NPA ratio and net NPA ratio was seen for private banks in last 3 years or even 12 quarters. So, absent absence of recovery and upgrades largely has impacted their asset quality, along with the fact that slippages were on the higher side as well. Interestingly, net NPA ratio difference between PSU banks and private banks is now only 19 basis points, the lowest ever seen in the banking sector. In FY18, remember that this gap was about 552 basis points. In terms of outlook ahead, analysts do say that deposits for private banks coming in at a huge cost. So they continue to see the rise in deposit rates, which can impact the net interest margin to decline further. Now, weakening government business and private banks making inroad into SURU, that is semi-urban and rural market, deposit growth has weakened for PSU banks. Loan growth is slowing down, especially for lenders with high market share. Credit cost and asset quality will rise owing to normalization in FY25. Now, microfinance loans and unsecured loans have seen deterioration in asset quality, which can increase pressure on earnings going ahead as well. 6 states are going into elections in the next 18 months. So any farm loan waiver, if that comes in, can impact lenders as well. These states, remember, they form about 20% of systems agri loans and have double-digit NPAs already.
Abhishek, thanks a lot for that detailed analysis. Time for a short break. Up next, the RBI governor announces that the Reserve Bank of India is launching a unified lending interface platform to enable frictionless credit. More on this story after the short break. Stay tuned. We'll be right back.
24/7 on YouTube.
Well, the Unified Pension Scheme, or the UPS, is the government's latest response to the backlash against the National Pension Scheme, primarily due to its lack of fixed pension and the uncertainty tied to the market-linked investments. So how does the new UPS compare to the old pension scheme and the NPS, and what does it mean for the government employees? Here's a quick breakdown. The UPS guarantees a pension similar to the OPS. If you have served at least 25 years, you will receive 50% of your average basic pay from the last 12 months before your retirement. Even with just 10 years of service, you are assured a minimum pension of 10,000 rupees per month. This is a significant improvement over the NPS, which didn't offer any fixed pension and was subject to market risks as well. One key difference between the OPS and the UPS is that the latter still retains the contributory nature of the NPS, but with added security. Employees contribute 10% of their salary, while the government adds 18.5%, which is higher than the 14% contribution made by the government in the National Pension Scheme. This means while you contribute, your returns are more substantial here. The UPS also includes an inflation protection through the All India Consumer Price Index for industrial workers, ensuring your pension keeps up with the cost of living, a feature totally missing in NPS and managed via a dearness allowance or DA in OPS. For your family, the UPS offers a better support. If a government employee passes away, their family will receive 60% of the pension. This is generally higher than the 30 to 50% provided by the OPS and certainly better than the NPS, where there was no fixed percentage of the deceased salary for the family. Now, regarding the lump sum payments, UPS provides a defined lump sum payment based on a fraction of the salary for every completed 6 months of service along with the guaranteed pension. NPS, on the other hand, allows for a significant portion of the accumulated corpus to be taken as lump sum, but it involves market risks and requires the remaining portion to be used for annuity purchase. And OPS used to not provide
Back with us here on Business Lunch. Now, the RBI governor yesterday announced that the central bank is launching a ULI, or a Unified Lending Interface platform, to enable frictionless credit. Lata Venkatesh is here to explain more about this ULI.
Well, a couple of years ago, the Reserve Bank announced that on the UPI platform, people will be given credit. Actually, what the governor said is they've spun that off as a separate unified lending interface. So it's really work in progress now, about to be scaled up. The data, the PI cum ULI platform will be able to tap multiple sources to draw information about the borrower before the lender gives that person credit. Of course, those data can be tapped only with the permission of the borrower. Now, how they're planning it is this ULI architecture will have common, simple APIs, apps, which are plug and play. So even the borrower, the entity which has the data, like say you have bank deposits in some place, land records in some place, telephone bills and GST data in another place. All these data sources can plug into this API and the data can be downloaded by the lending authority or the lending entity. Now, basically the idea is to ensure frictionless and quick turnaround of loans. It is expected to benefit the people who have least amount of these digital or any kind of collateral, like SMEs, farmers, agricultural entities, people in rural areas who have so far not been within the gamut of credit simply because of the distance from the banking system. Now that should be made possible is what the governor said. They already have pilots and a nationwide launch of the ULI is ready to be done in due course. The expectation, the governor said, is that it will become as ubiquitous as the UPI itself.
All right, and also let's listen into what the RBI governor had to say on the ULI scheme.
Unified lending interface is expected to cater to large unmet demand for credit across various sectors, particularly for agricultural and MSME borrowers. Based on our experience from the pilot project, a nationwide launch of the ULI will be done in due course. Just like the UPI transformed the payments ecosystem, we expect that ULI will play a similar role in transforming the lending ecosystem. The earlier Trinity was Jan Dhan Aadhaar Mobile, JAM Trinity. We are calling it the new Trinity. The new Trinity of JAM, UPI and ULI will be a revolutionary step forward in India's digital infrastructure journey.
All right, on that note, we'll slip into a short breather on Business Lunch. But up next, remember, Russia hits Ukraine's power grid, and we get you more details on that conflict after a very short break. Stay tuned.
Sum except for the gratuity. However, if you wanted to take a lump sum at the time of your retirement, you could do that only via commutation of your pension. So in this regard, UPS is a step up. However, there are some downsides as well. Unlike the OPS, you still need to contribute under the UPS, and although the government's share is higher than the NPS, it's not fully government funded like the OPS. But in exchange, you're getting a more secure and predictable pension than the NPS without putting the full financial burden on the government like the OPS. One thing that needs more clarity is the taxation. A central government employee currently receives tax benefits for the government's contribution to the NPS scheme. Specifically, a 14% deduction is available both under the old and the new regimes. Since the OPS did not require employees' contribution, there was no associated tax benefit. The government now needs to clarify whether contributions from both the employee and the government under the new unified pension scheme will qualify for any tax benefits. So in summary, the UPS aims to strike a balance between the OPS and the NPS, offering a mix of security and sustainability.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head.
Welcome back, and let's focus straight to the global developments, and this one is from Russia and Ukraine war as well. Now, Ukraine cities, including its capital Kyiv, were attacked by a barrage of Russian missiles and drones targeting key energy infrastructure. In fact, NBC's Erin McClock gives us more details on this rundown of what really happened in the capital city of Ukraine.
In Kyiv, a Russian missile strikes near a critical dam, stunning Ukrainian soldiers, part of Russia's latest attempt, the Ukrainian president says, to terrify. Russia launched more than 120 missiles and 100 drones, he says, killing at least 4 and damaging civilian infrastructure, triggering rolling blackouts in the capital and sparking international condemnation.
We condemn in the strongest possible terms Russia's continued war against Ukraine and its efforts to plunge the Ukrainian people into darkness.
The attack, days after Ukraine marked its independence, with a somber ceremony in the capital. Our team woke to the sound of explosions and took shelter, as did millions of other Ukrainians. Metro stations once again doubled as safe havens. Yet within hours, life returned to normal as the fighting rages on and Ukrainian commanders braced for a long war.
We fight for our freedom.
2 years ago, we met Colonel Igor Obolensky, shortly after his men pushed the Russians out of the area around Kharkiv. Since then, he fought in the battle for Bakhmut, one of the bloodiest of the war.
The last time we met, you told me something that stuck with me, that you were fighting for your little boy.
Yeah.
So that he didn't have to.
Yeah.
When your son becomes a man,
yeah.
Do you think this war will still be going?
Maybe, yeah. But it's not very active phase, but I think, yeah, it will be.
Ukrainian officials say of the 127 Russian missiles fired at Ukraine today, they shot down 102. And there are reports that the drones were made in Iran.
Updates coming in there from the Russia-Ukraine conflict. Now moving on, Pavel Durov, the CEO of the messaging app Telegram, was arrested in France earlier this week on allegations of the platform hosting content on child porn, drug trafficking, fraud and terror. However, it is not only France that has been investigating the messaging app. The app has also been under investigation in India. Ashmit is joining us to tell us more. Ashmit, what are you picking up here?
Well, let's begin with some context. As far as use of Telegram is concerned, it boasts of nearly 1 billion users, billion active users. Of them, about 5 million here are in India. The concerns that are being raised here in India are similar to the concerns that were raised back in France. The concerns stem around the issue of lack of content moderation, which allows for spurious content, for banned content, for prohibited content around child pornography, whether that's extortion, fraud, scamming, gambling as well. Gambling is something that's on the watch list of the government as well. And all of this is something that is on the government's watch list. The Telegram social media platform is being probed. We understand that this probe is being led by the I4C, or the India Cybercrime Coordination Center. This center, we understand, operates under the MHA and is looking into the questions of lack of moderation and questions of the spurious content doing the rounds on the Telegram platform. Important to point out, conclusive findings have not been reached yet, so the probe is still underway, and depending on the findings of the probe, there could be consequent action raised against that platform here in India as well. So clearly a difficult time for the application. We've reached out to, of course, the application. They are yet to respond. So clearly issues being raised here in India as well, not just in France.
All right, Ashmit, thanks so much for getting us up to speed with the latest developments on that important developing story there. Now, Apple announces its product launch event. Its Glow Time will be held on the 9th of September. Now, the new iPhone 16s and other major products and updates are expected to be launched while AI is also likely to be in focus. In fact, CNBC's Steve Kovac joins in with all the details of that much-awaited event.
It is a day earlier than we expected, too, September 9th on a Monday. Usually they hold these events on Tuesdays. And the slogan here from Cupertino is, "It's Glow Time," which I assume is a reference to that new design that Siri is going to get with all this AI stuff that's happening. So here's what we're expecting. We got new iPhones, of course, plus the other stuff you carry around with you, AirPods and the Apple Watch. And by the way, this is the 10th anniversary of the Apple Watch reveal. And, of course, that U2 album they stuffed on everyone's phones without asking us. But as far as the iPhone goes, the most important product, not expecting significant hardware updates here. They're going to look largely and feel largely like the models from last year. And of course, that's because this is all about artificial intelligence. To use those new AI features, you're going to need a 15 Pro or better, presumably the next line of phones we're going to see in a couple of weeks here. And by the way, most on the street think this is going to spur a huge upgrade cycle thanks to AI. But MoffettNathanson this week, although they did agree with that thesis, they said it's largely already baked into the stock. And by the way, this is going to be a really slow rollout, Scott. It's going to be in U.S. English at first, and the features are going to be rolling out over several months. So you're not going to get everything at day one. ChatGPT integration, for example, is going to come by the end of the year, and some more advancements in Siri and other things are going to happen next year. And after all that happens, it's still going to be a beta version. It's unclear when artificial intelligence on Apple devices is going to launch in China, the next most important market, due to regulations there. By the way, CEO Tim Cook told me a few weeks ago the company is working with officials to get artificial intelligence cleared, but expect a slow rollout for now there, Scott.
Steve Kovac there with all the latest updates. But some more news from Apple. The company announced that it will replace its current CFO, Luca Maestri, with the current Vice President of Financial Planning and Analysis, Kevin Parekh. Now, Parekh, who's been at the firm for around 11 years, will take over from the 1st of January 2025.
All right. So, Hormaz, you're ready for the Glow Time event on September 9th. That will be a much-awaited event. With that, it's a wrap on this edition of Business Lunch. Thanks so much for tuning in.
Trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com. CNBC TV18, an unending pursuit for excellence. A pioneer, a leader, a visionary, building a lasting legacy of credibility, consistency, and trust. Giving unparalleled access to global thought leaders and powering conversations that are shaping the new world order. Setting the highest standards through exemplary leadership. It is this unrivaled reputation for the most comprehensive coverage, actionable intelligence, and in-depth reporting that makes CNBC TV18 India's #1 business news brand. Foreseeing change, growth, and transformation for over a quarter of a century. Trendsetters crafting innovative content formats. And award-winning business journalism. On air, online, on social media. As we embark upon 25 years of excellence, we invite you to be a part of our future. CNBC TV18, your trusted partner and investment ally.
See that Chetak is now close to about 18% market share, or just above 18% market share. We are neck to neck with our able competitor TVS and their iQube. I think just a few hundred vehicles separate us. Having just launched a third product, there are more due later this year, within this financial year. We talked about it the last time we met a couple of months back.
Good afternoon and welcome to Midcap Radar. I'm Vivek Iyer, and with me today is Reema Tendulkar. Well, Reema, it's a strong day, almost flirting with the lifetime high levels, and the broader markets too doing very well in the session.
And there's so much sector churn. So even at the index level, though we haven't covered too much ground, we are waiting with tantalizing breath whether we're going to cross and reclaim those all-time high levels. But as Vivek pointed out, flirting very close to those levels. But sectorally, you've got consumer staples, which are on the back foot, but on the way up. You've got private sector banks like ICICI Bank, flying high. L&T is a big mover. You've got insurance names too up and about. Let's take you through the top headlines on the show now. Benchmark Nifty index hovers near 25,000 within striking distance of its all-time high level of 25,078. Pharma, financial services are the big gainers, even as FMCG, energy dragged. Mid-caps outperform.
Third-party insurance administration services provider MediAssist surges as it announces the acquisition of Paramount TPA for an enterprise value of 312 crore rupees. Brokerage Investec is also bullish on the stock.
Datamatics gains after the company announced a partnership with Microsoft to build its own Copilot solutions, focusing on process automation to accelerate business transformation.
ABB India surges in trade after Axis Capital double upgrades the stock to a buy rating from Reduce and raises the target price to 9,340 rupees a share versus 8,190 rupees earlier. The firm says they expect strong earnings growth in the second half of this year, adds that they prefer ABB India over Siemens.
And the rally continues for NIIT Limited, 15% up today, 45% in the last 3 days. Last week, the promoters and noted investor Ramesh Thamani picked up and hiked their stake in the company.
Well, it's been a very strong session as far as, the bulls are concerned. Lot of stocks are doing quite well, and like Rima pointed out, certain specific pockets of the market are doing extremely well. If you could pull up the entire insurance pack today, a very important news break that was done by our colleague S. Jain, was talking about that there could be some more tweaking as far as the surrender values are concerned. Rather, LIC has requested, for further tweaking and a further relook at the surrender values issue. And on the back of that, have a look at LIC, have a look at HDFC Life, ICICI Prudential. All of these stocks doing very well in the session. In fact, near the day's highest point, even Max Financial Services for that matter. Today we also have a lot of stocks doing very well in the session. Hormaz is standing at the wall. This is our special segment, Mid-Cap Movers. Hormaz, take us away.
The broader markets are doing well today, even as the Nifty is nearing its record high. There is a lot of action within the small cap space as well. JSW Infra is one of them. Jefferies initiated coverage on the stock today, projecting an upside of close to around 20%. Castrol is another one, continuing to grow from strength to strength. Was up on Friday as well, up another 5% today. Century Textiles and Torrent Power are some other stocks that are having a good day in today's session. A couple of these Tata Group companies have been having some very strong moves over the last two sessions, and Tata Elxsi is one of them, was up 13% yesterday, another 13% today. Tata Investment is another one at the high point of the day as well, 17% higher. And Tata Technologies, another block deal took place in the stock today, opened lower but now is trading with gains of almost 4%. All three of them trading at the highest point of the day. Stocks that are doing well on the back of volumes, and Gujarat Ambuja Exports is leading the charts here, 8.7% higher there. CESC, another RPSG group company there in the news today. Lakshmi Organic is another one, and KFin Technologies on the back of some very strong volume, seeing gains of anywhere between 5 to 7 to even 9% in today's session. Some other stocks that are building on to their gains from yesterday, and NIIT, as Rima just mentioned, is one of them, another 11% in today's session after the upper circuit yesterday. GSPL was up almost 7% yesterday, is adding on to that, and eClerx is up for the third straight day today with gains of another 5%. And lastly, some stocks on the back of that are bucking the trend in today's session. Actually, Granules is one of them. There's a news break that we just did a couple of minutes earlier, a few minutes earlier, 2% lower there. Minda Corp and Chola Finance also not having a good day at the office today. Back to you guys.
Thank you. Interesting list as always. On Century Textiles, which Hormuz pointed out, 4.5% up. There's a Morgan Stanley note on real estate where they say that while they are constructive on real estate amid the upcycle, investor interest in real estate has waned a bit compared to what it was on luxury segment, the likes of DLF, etc. They're saying the valuations are stretched and investors are looking at smaller developers like Century Textiles and Shobha, and they may benefit from cheaper valuations and higher sales growth. So some reinforcement has come in for Century Textiles, which perhaps has pushed the stock
In fact, yesterday on our show, we had Knight Frank, and they had come out with a report, talking about the key premium luxury market projects which were being undertaken, as far as Delhi, Bangalore, as well as Mumbai were concerned. And they said that while demand, is up almost 17% in certain cases on a year-on-year basis, last couple couple of months, it's moderated. And we're talking about premium luxury real estate. And I think Morgan Stanley is reiterating that.
Oh, absolutely. But let's move on and get you some source-based information, because sources tell CNBC TV18 that a surprise US FDA inspection is currently underway at Granules India's Hyderabad facility since yesterday. Vivek, this is your story. What did you pick up?
Well, that's right. So, it's a very important development as far as Granules is concerned. At this point of time, you can't read too much into it because we understand that the inspection is still underway. But why are we, discussing this particular development? Number one, to reiterate, a surprise inspection is underway at Granules' key facility, which is the Hyderabad Gagillapur facility. What does the company manufacture here? The company actually has formulations as well as a PFI business manufacturing facility over here. And it's very important because almost 70% of the total business or total top line in Q1 came from this particular facility. PFI, in fact, is the pharmaceutical formulations intermediates. Not only that, it also assumes importance given the fact that in this particular facility, there are 11 ANDAs filed and which are pending for approval from the US FDA, and the company has a total of 16 pending ANDAs with the US FDA. 36 ANDAs are already approved from the facility. So in that context, it's a very important facility as far as Granules is concerned. We reached out to the management of Granules, to get a comment on this particular development. We are yet to receive a response from them.
Okay, let's move on now and talk about the market technicals. Will we or will we not? That's the big question, right? Whether we'll reclaim our all-time high levels. Shrikant Chauhan of Kotak Securities is now with us for a technical question. Shrikant, what's your view of the last 2 hours left for trade to close?
Yeah, good afternoon, Rima. Good afternoon, Vivek. I think, this market is going up gradually. No doubt that there is a lot of strain because number of sectors, they are participating and they are supporting to the market. But at the same time, the overall pace is quite cautious, which is actually good for the market. Broadly, I am of the view that the way the market is comfortably holding above the levels of 25,000, it is very clear that we are now heading for the next psychological level, which is around 25,500. In between, we could see the some selling pressure around 25,250. But broadly, I am of the view that markets are heading higher. And even at these levels, instead of taking more bets on indices, it is better to be more and more stock specific.
Shrikant, which are top picks for the day? Any stocks that you're looking at?
Yeah, I think if we go through with mid-cap back, most of these stocks are crossing their important resistance levels. And now there is good amount of confidence that we are seeing in stocks like HDFC Life, on which you discussed just now. There also the stock has absorbed a lot of selling pressure. In fact, HDFC Life, ICICI Prudential, MFSL, all are showing equal amount of strength. That means that something is going to happen in this particular sector. But HDFC Life is showing a lot of strength. I think it has absorbed its important level. So the next level to watch out for would be 900 or 950 in next few weeks or months. It will take time. But at this level also, it's a buy with a stop loss close to 700 on a closing basis. The other stock on which we are bullish is Tata Technologies. Based on its technical formation, you can see the volume, the way it is gaining on a day-to-day basis. It is 10, 12 times higher than the average volumes that we saw in the past. So there also, I am of the view that it is the stock has started its pullback rally. It was around some 1400 levels after IPO. From there, all the way it fall to 900. Now it is into pullback mode. So maybe we could see the levels of 1200 or 1250. That's the overall view on Tata Technology. And finally, I would like to go with HCL Technologies. And there also, the stock has managed to surpass its previous high confidently. So the next level for HCL Technologies is between 2000, 2050, which is decent 15-20% higher based on technical formation. So here also we have a buy view with a stop loss close to 1650.
HCL Tech is now flattened out. It started trade with a gain of 1% on the back of the company extending partnership with Xerox. They've been in partnership with Xerox since 2009, and now they've extended it to continue to help Xerox with their digital transformation. But the stock has given up gains as the day has progressed. Shrikant, thank you for joining in. Get into a break. Up next, we'll get you an exclusive conversation that we had with Girija Subramaniam, Chairman and MD of New India Assurance. Stay tuned.
I think post the festive season and before March, Certainly there will be more Chetaks in the marketplace, and I could reiterate what I shared with you the last time, that not only will there be more Chetaks in the market of the current platform, hopefully very sharply positioned, but there will also be a new Chetak platform. As we head into the festive season, in the months of September, October, November, we are very likely to cross a monthly sales production and sales rate of over 100,000 clean energy two-wheelers and three-wheelers. But I would hazard that definitely over 25% of our current revenue is already coming from or about to come from clean energy vehicles, which is quite remarkable.
Investing.
Welcome back. Now, despite strong growth witnessed by general insurance industry, New India Assurance is one company which has largely missed that growth train. Speaking exclusively to CNBC TV18, Girija Subramaniam, CMD at New India Assurance, spells out the reason for the underperformance and explains how the company plans to get back on its growth path.
We did a conscious effort in degrowing on bad business from the health sector. That is on the group health side. We did grew out of many group health accounts which were not doing well, and in that way I think we cleaned up quite a bit of health portfolio. Now, beginning this year, I think with this restructuring of the organization, having settled down, people getting used to this new way of working, we are now able to refocus our entire energy on growth with profitability, which was the agenda last year also. But this year possibly we'll be able to see more traction because our regional offices will be focusing more hard on retail business, going more aggressive across all lines of business. We will continue our work on health group health business, wherein we are bleeding on certain accounts, and we will be pricing them better and trying to retain clients at the right price. Okay. So I think with these multi-pronged strategies, we would be able to show growth on a much better footing this year.
The industry is growing its total premium at about 15 to 18%. For you, it's been about 2 to 4% so far. Now that you're saying that the focus will come back on growing premium, what could be the right amount of growth that you could see in terms of the premium that New India could do for this year?
Actually, last year we started this process of degrowing on GMC. We gave up more than 900 crores of GMC business. This year, right from the beginning, I mean from more than 2 months now, we are focusing on increasing the premium for bad business. In the process, we are losing some accounts also because competition is there to pick up such accounts. But wherever we are able to hold on to the accounts, we are pricing them higher and taking on the business. So I can't say that at any point of time the entire bad business is done away with. There will be something because business renews at various points of time through the year. So the process is still on, the effort is still on, and I think it will be on throughout the year. As far as the premium growth is concerned, I agree that we were at 3 point something in the first quarter, and since now we are continuously motivating our retail offices and our agency and other marketing forces to go very strong on retail. We are increasing our product profile and concentration on retail lines. I think in the remaining 8 months of the year, we would be able to show more traction, and we could be showing somewhere, we hope to show a growth figure of around 12% this year.
On both health as total, retail and individual and group, and motor, TP and OD, what could be the growth in these two individual segments for the year?
Health and motor comprise 75% of our book, and therefore the growth will definitely be there. When I say 12%, we expect minimum 12% in these two lines. Otherwise, we won't be able to achieve that 12% on an overall basis.
Correct.
But then maybe that 12% will be more retail based than it was completely on the corporate base. Like in the health side, we have around 70% of our business coming from group health business. Only 30% is from retail. So maybe we will try to have a better balance over there. Maybe more tilted towards retail than towards group, and the growth coming out of that. Okay. So maybe that would be better management, and the profitability also is expected to go up once this balance tilts in favor of retail, and therefore the concerted effort towards this retail business. In motor, there has been a issue with regards to third-party premium not being increased for the last 2 years, and because of that, the business is becoming unsustainable.
By the end of FY25, by the end of current financial year, where do you see the combined ratio moving from the 160 at the end of quarter 1, and what is the larger target in terms of the next 2 to 3 years to bring down the combined ratio to?
Actually, quarter by quarter, the combined ratio keeps changing because a lot of businesses renew at various points during the year. Last year, we ended the financial year at 120.57. So this year, the first quarter has ended at 116, which is a little higher than what it was last year. So basically, as we go and with our increased focus on on improving the premium that we write on not so good business, and also increasing our the business that we write on the retail side, which is largely profitable, we aim to bring down the combined ratio significantly, and in the next year possibly we are aiming at a combined ratio of sub 110%. Maybe 18-19% is what we would feel is possible, and which is ideal in this year.
That is in this year, FY25 itself. Okay. On the underwriting side, this particular quarter, your underwriting loss increased by about 10%. Motor also saw the underwriting loss increasing. Health also saw the underwriting loss increasing in the first quarter. If you could help us understand through the year FY25, how could the underwriting loss, move through the year at the end of FY25 over FY24? What kind of improvement do you see in underwriting loss, as in it reducing? By what extent do you see that happening?
Actually, when we are aiming for a combined ratio of coming down from 120 to 110, surely the underwriting loss would also expect it to come down every quarter.
Very interesting conversation there with New India Assurance, stock higher by over 3% today. But let's now slip into a short break. We'll get you more on the markets and stock specific action on the other side. Stay tuned.
not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Welcome back to Mid-Cap Radar. Markets continue to hold quite steady with the mid-cap and broader cap indices doing very well. But one stock in focus, CDSL. The stock falls in trade after ICICI Securities downgrades the stock to a reduced weighting from hold. Vamakshi joins in with more details.
Well, absolutely, Vivek. CDSL down and out in trade today after the downgrade that came in from ICICI Securities. They've downgraded the stock to reduce from hold. However, they've increased the target price to 1,320 per share. They say that the company is an attractive play in the bull market as seen in the past trends that is between FY20 to 22. But the upcycle multiples that are seen now are not looking sustainable in the consolidation period. They believe that the company is now trading at 59 times 1 year forward core EPS and 53 times 1 year forward EPS on FY26 basis, and this is double as compared to what the company has traded in the past. The price cuts that were seen as on the first quarter indicate there is that the company is possibly passing its operating leverage to the customers, and this in turn limits the upside as far as margins is concerned. The possibility of increase in cash volumes mainly on account of restriction in options is more likely in the intraday market as compared to the delivery. So therefore CDSL, which benefits only on more volumes in delivery segment, it would not be beneficial for this company. Delivery as a percentage of total cash trades has also been trending downwards from 26% in FY18 to 21% in FY24. They also highlight that the risk reward in the company is not looking quite favorable with peak cycle multiples as well as possibility of lower than expected earnings growth on a high base. So overall, it's a downgrade coming in from ICICI Securities on CDSL, and as a result, the stock is declining in the trading session today.
Thank you very much for that, but it's up 23% in the last 1 month. Datamatics is on fire today. This is after the company has partnered with Microsoft, where they will be building custom AI solutions using Microsoft's Copilot for Datamatics customers. So this is an enhanced offering that Datamatics will be able to give its enterprises. This will be custom built, so depending, they will tweak it based on the requirements of each of their clients. So the street is clearly excited. The stock is up 20%, but we'll have to wait by to see the impact, the financial impact of this particular development. But it's a small company which ties up with a very large company like Microsoft, so the street is excited. And also bear in mind that Q1 numbers were very muted for the company. So the company's revenues had declined quarter on quarter, and on a year-on-year basis revenues were flat, and the company said it was slowness in US and European client, and they'd seen flat growth in their existing business. So the street will want to see a pickup in their base business also, and then the upside from this Microsoft partnership. Well, absolutely right. Very, very, thank you so much for, highlighting that. The entire mid-cap basket, right? If you're talking about the IT space, look at names like Persistent, Tata Elxsi, especially if you see 1 week, last 15, 20 days, these stocks have done really, really well. But another sector of the market that we are focusing on is actually the power space. Have a look at a name like NLC India. NLC India
Today, there was a note coming in from Elara Securities. They've initiated coverage on the stock. They see almost a 30% upside. Remember, the company largely in the regulated equity business, so their returns are regulated. But despite that, given that the company has gone ahead and guided for significant capacity addition, Elara feels that there is significant upside in from current levels. Even a name like IEX, this particular stock too has done very, very well. Despite the overhang of market coupling, the company has seen strong volume growth, in the almost 8 to 10 quarters as far as the short-term market is concerned. So that's another stock that continues to do quite well in the last few trading sessions. But that's all the time we have on this edition of Midcap Radar Mutual Fund Corner. When we return.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Way to celebrate our own 25th year with new milestones being achieved on Dalal Street.
21 years of the Nifty from 1,000 to 10,000 today. Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV18, embarking on a quarter-century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18, weeknights at 7 p.m.
Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio, and all of us make that contribution to employee provident fund. Sometimes it is within the limits that are prescribed by the law, and sometimes it is more than that as well. So should you continue doing that, or should you actually invest that extra cash into something else, something like an NPS, a mutual fund as well? What is the correct way to go about it? So let's try and understand this with greater analysis and more examples as well. We have today joining us Mrin Agrawal, financial educator and a director at FinSave India Private Limited. Mrin, thank you so much for joining, and it's always a pleasure speaking with you. So, let's understand the most basic aspect first when it comes to employee provident fund. What are the current norms when it comes to EPF contribution for employees? How much do the employer and employee contribute individually?
Hello, Sonal. It's always a pleasure to be on your show.
Yeah, so off late I've been getting a lot of these inquiries about whether we should contribute, on the full amount or on the statutory amount. So the basic rule is as follows: that on your basic, 12% of it is mandatorily deducted from the employee's basic and contributed towards the employee provident fund. Now, the employer also makes a matching contribution, right? But the 12% that the employer contributes is divided as 8.33% into the employee pension scheme and 3.67% to the EPF, right? So, of late, as I was mentioning, there have been a couple of queries on whether to contribute on the entire basic or on the wage ceiling limit of 15,000. So what happens is that if you're going to be contributing on a lower amount, let's say on the 15,000, then that means that you're going to have more cash at hand and you're going to have a higher amount that's going to be coming into your bank account. But it also means that a lower amount is going to go towards your retirement fund.
Okay, that makes sense. That's the basic. So we have understood that. But let's go to the next case. In cases, Mrin, where EPF deduction is allowed on statutory amount, that is 15,000 rupees, it results in employees having more cash at hand, as you just explained. What are the financial implications in both the cases in that case?
So I have taken an example of a 23-year-old person earning a 10 lakh income. And we're assuming that the basic is growing by 3% every year. Also assuming EPF return is 8.25% per annum, and the person is following the new regime and is taking into account 75,000 rupees of standard deduction, right? So now, if the person contributes 12% of basic to the EPF, at the end of 37 years, or when the person is 60 years of age, the value of the EPF is going to be 3 crores. But if the person is contributing 1,800 rupees per month, which is the on the 15,000 statutory limit, then the EPS accumulated is going to be around 71.5 lakhs. However, the person is going to have another around 52,000 rupees per year extra that they will have for investing in other avenues. So really the choice now remains that, do I want this fixed return coming in without doing anything, let it just quietly come and quietly compound, or can I actually handle my investments better and generate a return better than the 8.25%?
That's a big question, right? EPF or no EPF, at least for the extra money that you have in hand when it comes to your salary and employment. So, Mrin, in that case, what are the key things employees should keep in mind while making this decision?
So, firstly, do you have the ability to look at or choose investments which are giving you more than that 8.25% return? And you have the ability to remain invested in these instruments, because 8.25% tax-free, risk-free return is very difficult to beat. And obviously, to beat it, you will need to be investing in instruments where there's going to be a higher amount of volatility. So with volatility, of course, it really means that you actually have the ability to manage this particular volatility or not. So that's where the decision point is, again, that do you want things to just continue the way they are, or are you able to look at investments? And right now with the markets doing well for the last couple of years, everybody feels it's very easy. I'll just go and put my money in equities and it'll just grow like really fast. But the point is that you should remember that there are going to be ups and downs, and the key is that how are you going to manage during these downs especially. So that's really the key point.
That's right. So a lot of things to be considered while you make that decision. Now, let's talk about those who are looking to contribute on the statutory limit. What are the investment options available here, if you can explain that in detail?
So there is obviously equities that is available. You also have within equities, of course, there's NPS and there's gold. So when we look at data from March 1980, and I got this from one of the handbooks. So when you look at the data from 1980 to 2024, on an average, you see that equity has grown by 16% and gold has grown by about 10.5%. So looking at the various investments that we have that can, first of all, beat this return and also beat inflation at the same time, you basically have only two instruments. One is one, and that too, which can be held for the long term. You only have two instruments. One is equities, and the other that you have is really gold. So these are the two choices that you have. Within equities, of course, there are a whole lot of instruments that are available. For example, you can buy stocks, you can buy stock baskets, but I wouldn't recommend these because what we've seen again with stocks and stock baskets is that people tend to chase recently performing stocks, and most people really do not have the ability to hold on these investments for a 30-year period. And again, investors are not able to keep up with the changing trends. So if you're going to buy a few stocks, and of course, the cycles keep changing, so people are really not able to keep up with trends. And hence, I always believe that a better way to invest is through managed equity investments. Like, for example, you have mutual funds. Of course, you also have NPS. It is a instrument which is meant for retirement. You can have a good amount of equity exposure over there. It's locked in till the age of 60, which means that you're really leaving that money over there for it to compound, and that's what actually really works for that particular instrument. So within the equity space, I would highly recommend either the equity mutual fund or NPS. And of course, you also have gold, which is available as an investment, though in the financial form.
That makes sense, of course. We'll discuss all of this in greater detail. It has been so helpful so far to discuss something else other than what we discuss usually, right? But we have to get into a quick commercial break. On the other side, we'll continue our discussion with Mrin Agrawal to understand how can you actually replace your excessive EPF contributions with other asset classes. Stay tuned for that. Welcome back. You're still tuned into MF Corner. We still have with us Mrin Agrawal, who's the financial educator and director at FinSave India. Mrin, we've discussed a lot about the different categories that would work. Equities was one that you spoke about in detail as well. So within equity funds, there are so many types of funds, including retirement funds, right? How does one navigate the entire equity fund space in this case when you have the excess cash to invest here?
So when you look at the retirement funds from mutual funds, First and foremost, there are different types of funds available within this category. So there are some funds which are more focused on investing in bonds, and then you have some funds which are managed like balance funds. So they invest primarily in equities, but they also have a good amount of bonds in that particular portfolio. So first and foremost, if you are looking at the retirement mutual fund category, then please do go into detail in terms of what is the allocation between debt and equity, when you're comparing the different funds. Of course, when I looked at the performance of the retirement funds versus a simple aggressive hybrid fund category, which is like comparing it with a balanced fund category, what I saw was that the aggressive hybrid fund category has been performing consistently better than the retirement category, but that could also be because, when you look at it at a category average, you're also adding those funds which have a higher amount of debt holding, right? So, but what I found is that the aggressive hybrid category has done better. And then, of course, if you just look at the broad-based categories like a large cap fund or a mid cap fund, there's been a significant amount of outperformance over there as well. So again, given the fact that most people still have a high amount of debt holding through other instruments in their portfolio, and given the fact that even if you are contributing a lower amount to the EPF, your retirement corpus is not going to reduce, and typically most people need to have a retirement corpus between 6 to 8 crores. So if you need to reach that number, you need to have a higher allocation to equity for this particular goal. And I think most people can also do it if they are young and if they have more than 10 years left for retirement. Certainly they need to be looking at higher equity allocation. So I would actually suggest that if you're looking at deploying this money in mutual funds, over looking at the retirement solution schemes or over looking at balance funds, please consider the broad-based equities categories like, for example, large cap or mid cap or flexi cap category. A combination of these three categories would be a good way to start. And again, as I've said on the show earlier, that for those who are a little confused about which fund to choose, just starting off with a simple Nifty 50 index fund itself is a good idea.
Oh, that's always start with the basics. It would work for you, right? Further, Min, since you suggested NPS, where one can choose equities and bonds, and generally people tend to go with the default option. Can you share more about the implication of investment options chosen here?
So in NPS, you have option to go for the auto choice or the active choice. Now, when you look at the active choice, it's the choice where you can decide how much you want to put in equities and how much you want to put in bonds. So you have the equity option, you have option where you can put a higher amount in government bonds, and then you have an option where you can put a higher amount in corporate bonds, right? Now, there's nothing wrong with the debt category, but again, given that for most people, the retirement goal is a very long-term goal and you have time to let your money compound, it does make sense to choose the active equity option over looking at the debt options. And also when one looks at returns on a longer term basis also, of course, the active equity options have performed much better than the debt option. So I would say that if you are doing NPS, and I think NPS is a great investment, especially for the salaried, because remember, now you can contribute up to 14% of your basic and it's completely tax deductible, and that's in both old regime as well as the new regime as well. So even if you're not contributing the full amount to EPF, I would certainly say put some amount in the NPS, since you're getting an additional tax deduction, as I said, applicable in both the regimes. And of course, look at the active equity. Now, many people tend to do the default option, which is going in for the auto moderate choice. So essentially, for those who find it difficult to figure out which option to go for, you have the auto choice where the funds are allocated between equities and bonds based upon your age in a predetermined manner. The issue with the auto choice is that the allocation to equity drops considerably. And if you see, for example, at the age of 50, there is only 20% allocation to equity. So again, just to reiterate, you still do need to build a large corpus, and to build that large corpus, you need to have a good equity allocation. And hence, as far as NPS is concerned, please look at the option where you can have the highest amount of equity, and that is the active equity choice.
Okay, all right, we take that point. It's so well explained there, Mrin. But you also mentioned gold ETF, and now with its taxation becoming favorable, how good this as an alternate to EPF?
It is a good option, but I think Indians already have a very high exposure to gold in their portfolio. And in any case, we only recommend a 15% exposure. So, and again, when you look at household level, most people have less than 10% in equity. So I think they can certainly add equities to their portfolio over gold.
Okay, all right, take that point. So let's finish this off. We have around 3 minutes, so you can explain it with the example that we were talking about. What are your final thoughts on how to decide whether to contribute lesser to EPF or vice versa?
So again, if we take the same example of the 23-year-old earning 10 lakhs gross income and following the new tax regime. So now we had talked about having roughly about 52,000 per year extra to invest. And let's say now you invest this money in an equity fund. It could be equities or NPS, and I've assumed a return of 12% in both the cases. So yes, you do end up with a good number, around 3 crores. And then on gold, I've assumed a more reasonable return of 9%. So you end up, of course, with a lesser amount out there versus continuing to contribute to the EPF at 12% of the basic. So there you're going to end up with a 2 crores number. But you know what, Sonal, it's not about this number, because these number calculations are easy for us to do on Excel. The point still remains that are you going to be able to manage these investments? And actually, even before managing the investments, are you going to be able to choose the right investments? Because as we are seeing right now, a lot of people are into trading. And of course, the regulator report has also come, which shows that more than 70% of people actually make losses. So again, with all the trend chasing that continues, and of course, whenever markets fall, the first question that people have is that, should I stop my SIP? Should I exit my investment? So I think there's a bigger behavioral aspect out here versus the instrument, because the ability to first of all go in for a simple low cost mutual fund or NPS, most people are looking at exciting instruments, but what you need is the simple boring stuff. And the other bit is to really remain invested through the volatility. And mind you, right now a lot of investors have only seen the good times in the last few years. They haven't seen the bad times. So how will they be able to will they be able to remain invested? Will they be able to adapt to this volatility or not? Remains to be seen. And as I said, this arbitrage, one feels that there's a huge arbitrage that I'm only getting 8.25% here, but I have the option to get maybe 10 to 12% out here. But that arbitrage will work out only in one case, which is choosing the right instrument and remaining invested.
Totally take that point, because last 4 years have been very different. Everyone's seen elevated returns, which could not be the reality always, right? So it's always best, as you said, stick to boring. It could work for you in the longer term. Mrin, thank you so much for joining us today. It's always great speaking with you and to discuss something new every time. Okay, all right. With that, we'll take your leave on MF Corner today, but stay tuned for Closing Bell to take you through the last hour of trade.
both Hang Seng and Taiwan, which were the outperformers of yesterday's trading session, are leading the losses today. More than 100 ballistic missiles and over 100 drones were launched by Russia.
The high is 25,078. We left off at 25,000. And 10-11 yesterday.
The acquisition will take Medi Assist to have a total market share in the group segment to 36.6%.
We are at about 25-21, 25-15.
We are seeing good growth in demand for most of the products.
The cyclicality of the beast will reassert itself at some point of time.
The demand which we are seeing in India and in the US market, it's very strong.
But it's good to see the Nifty still hold on to the 25,000 mark.
So Citi estimates operating profit growth for Cholamandalam to be at 40% YOY in FY25.
ULI platform will be able to tap multiple sources to draw information about the borrower.
Almost flirting with the lifetime high levels, and the broader markets too doing very well in the session.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good afternoon. Well, that's been the day so far, and it seems the bulls are perhaps just waiting right at the edge to see if that all-time high is going to happen or not. We came very, very close to it, basically just about 6 or 7 points shy, but then there was a bit of a slip-off. This, of course, is Closing Bell. We are here with the last hour action. It's still not too far, but yes, we've slipped from that level. 11:30, it seemed that it was, a done deal. But then there's been a cool-off come through. Watch for the financials. That's where the action is. Banks and non-banks. We'll tell you more about it as we go along. But first, let me say hi to my co-host, Nigel D'Souza. Hey, Nigel. So what do you think?
Well, Surbi, a few points away from those levels. But I'll tell you what, besides the banking names, there's a lot of action actually in the broader markets, particularly the NBFCs. You look at Chola Finance. That stock has moved to the high point of the day. So big move is what we're seeing out there. REC as well as PFC, both of them, big spike is what we're seeing. So the NBFCs as well, I think one part of the puzzle could be that, in fact, for REC and PFC, we'll address that in just a bit. There seems to be a specific issue that's playing out in that favor. But otherwise, for NBFCs, if you're going to see rate cuts, then their cost of borrowing as well will go down. Some of them do have a particular part of their mix that is from the banking space. So rate cuts will actually be positive. Look at Piramal Enterprises at the high point of the day. Chola Investments as well at the high point of the day. Some of these gold finances are doing well as well. Manappuram Finance is moving up as we speak. So good up move is what we're seeing on that name as well. But Surbi, what else are you tracking today?
Well, I'm, actually, before we talk more about local markets, let's keep an eye out on the globe as well. Because what's happened is that while Asia had started off on this cautious note, European markets have actually picked up steam and momentum. Most of them are trading with gains of about 0.5%. So it seems that for the time being, at least, markets are willing to put all the geopolitics and all that, talk aside. Though, of course, crude does remain a watch point. So keep that in focus as well. Right now, global screens are looking quite okay as far as how Europe is trading. But the broader market action, again, the index is up about 0.4%. Yeah, that's the European picture. It's looking not too bad. The mid-cap index is up about 0.4%, but it's all about individual names. And, some of them are sort of screaming all over the place. An example would be Tata Elxsi. Remember yesterday, around the same time, we highlighted the stock, the up move started 8-9% higher. Now it's capping that with a 14% sort of a rise today. Rima will tell us in a bit, what could be perhaps some of the latest momentum factors that could be, triggering this kind of a move. Tata Investments is up 20%. Block deals happened earlier. Then there are other stocks. CESC from the RP Sanjeev Goenka group, 9% higher. Dilip Buildcon is up about 7%. So Medi Assist, obviously, on that acquisition has been up 9-10% right from the morning. So at an individual stock level, JSW Infra right now, at an individual stock level, there's plenty of action. Though, of course, otherwise, the broader markets, it's a bit of an even-steven position. And we need to see if we can get a sudden reversal, a sudden flourish in this last 1 hour, because right now the bulls have pulled back from the near all-time high levels. Rima, hi.
Hi, interesting news coming in on the ticker. Z has entered into a settlement agreement with Sony India. Remember, this is after the failed merger talk. So we'll try and get contours of it. So some settlement agreement has been arrived at with Sony India. The stock is reacting positively. It's a gain of close to about 6%. So that's a stock you should keep on your radar. But you know, in the Tata Group stocks, we're seeing divergent trends. So frontline Tata Group names, so whether it's a Trend, it's a Titan, Tata Motors, all of them are under pressure. Stocks are down between 1 to 2%, but mid-cap stocks in the Tata universe are higher in trade. Surbhi spoke about Tata Elxsi. Tata Tech is another big mover. So it's a vibrant mid-cap looking screen. The advanced decline ratio is positive. We've got firmly skewed in favor of the gaining side. But let's find out how you should position yourself in the last hour of trade. Mitesh is now with us for a few closing strategies. Mitesh, afternoon, the waiting game continues. Your thoughts on the day so far, the trends that you've picked up, and the stock calls.
But I think, it's a decent market given the fact that the sectoral indices are coming into positive and nothing negative has happened. So it remains a buy and dips, I think, because we've not crossed the earlier highs decisively. I'm not buying aggressively, but on the stock side, remains a long market. So that's how we are positioned. And I have a buy on HDFC Life with a stop at about 728. Look for targets of around 760, maybe even higher levels on the upside. That is the first target. And the other stock call which I have is a buy on Axis Bank. That's a buy with a stop below levels of 1170. And a trading target of 1200 can be looked at. And 1200 is also the level where a lot of call option open interest is there. So I think that will be a significant first supply point.
Okay, just want to go back and focus. Thanks, Mitesh, so much for that. We'll come back for some more ideas in a bit. Just want to go back and focus on the Z news. Now, this is what's happened. It's basically, I mean, when you read the fine print, the litigation overhang and the whole arbitration proceedings that were, going to be perhaps long drawn in the Singapore courts, that the companies have decided that they'll no longer sort of, be entangled in that kind of a spat. And I'm reading out from the statement. So Z has entered into a settlement with CMEPL and BEPL. These are, of course, the Sony entities, to settle all disputes in relation to arising out of the connection with the transaction documents entered into by the company. And they mutually terminate all such transaction documents, withdraw all applications, claims or counterclaims before the Singapore International Arbitration Center, and relinquish all rights to file claims or counterclaims against each other in relation to any of these transaction documents. And this will include the termination, the claim of $90 million, which was the termination fee claim that was sort of made by Sony on Z. So this is a huge respite for Z. They don't have to slug it out in the arbitration, Singapore Arbitration Tribunal. And this, it seems that this $90 million overhang, that has also been settled with this. So this includes all damages, litigation, other costs incurred, and all other claims for costs of disposition, hive off, of liquidation of the businesses or any of the other assets. So basically, from the looks of it, the first page and the detail that I have sort of read into as of now, it seems like there is a overhang of all the okay, we've got Karan actually, joining in. Karan, hi, thanks for joining in. I don't know if you got some more time to read through the rest of it. The first page gives the impression this is a relief that all the pending claims, litigation, what could have been long drawn out in the Singapore Arbitration Court, all that ends. But is there anything more to it?
No, I think this is just, mere respite that, there will not be any additional overhang in terms of costs for Z. And this will kind of, pave the way for better margin improvement. The management has already given a very strong margin improvement towards 18-20% on EBITDA. They have improved last quarter in Q1, and going ahead with the festive season coming in, you will see margin improvement. So I think all this will lead to respite in terms of valuation multiples, because I think there'll be a higher visibility of getting better margins because of this overhang going away.
Okay, all right. Karan, so, we're seeing a big spurt in the stock right now, up closer on 9%. Do you think this piece of good news is more than priced in now?
I think we have a target price of 210. I think fundamentally, the price, could move upwards of that. But it all depends in terms of margin execution and growth rates. So firstly, on the growth rate side, the festive quarter is going to be very strong this quarter in terms of ad revenue because this quarter you don't have the World Cup. Last year you had the World Cup, so a lot of spends were diverted towards cricket as a genre. And this quarter, rather during the festive season, you will see the GEC vertical coming back, and FMCG spends have also been increasing on advertising as such. So that's despite, and secondly, also the margin improvement. So, there have been constant efforts to cut costs and improve efficiencies. Losses for ZEE5 have been coming off. They've been very conservative or rather, kind of change the strategy in terms of how they want to, reach out to the market in terms of new content investments. So putting all the things into perspective, I think we do expect a very strong respite in terms of numbers as well. And as and when we see execution on numbers, you will see, further up move on the stock going ahead.
Right. So Karan, so that's the overall view with regard to the fundamentals. But on this piece of news, they've come to some agreement. If they didn't come to an agreement, was there a pending liability that they had to pay or some numbers, if we could understand that?
So I don't think any of the analysts, or rather even we had not factored in any kind of, number in terms of the liability to be paid. So I don't think there is any big negative or rather positive impact in terms of numbers as such. It's more of a multiple rating thing that this overhang, goes away completely. Now, 2-3 things to look forward would be, of course, NCLT is also being resolved. That NCLT Sony Zee merger is also resolved. If you look at this, the claims have also kind of, now turned down against them. So 2-3 things to watch out for. One is, the pleas against these, with these IDBI banks and other things which they have, which are more in terms of, part of vessel groups, the creditors that he has. I think those things need to be watched upon in terms of how those settlements are done, because that will provide more respite, in terms of overhang, for a potential margin hit. And even that contract with Disney, what they had, to buy out the TV rights, of the World Cup, which they kind of called off because the merger was called off. That is also something to watch out for. But net end, I think, these kind of news coming in will not change numbers in a big manner, but it will provide respite to valuation multiples for sure.
One more statement which says they're withdrawing all claims, including the 90 million termination fee. So they get some relief on that front, I'm guessing.
Yes, correct. So the termination fee goes away. So as I said, anyone, we had not factored in this termination fee to come, entirely on their books. So not much of a change in terms of estimates, but yes, valuation multiples will see re-rating.
Okay, so it's a relief. It's a big relief that, that 90 million claim, which would have had to be sort of, discussed and fought over in court. Now it's all mutually settled and nothing remains pending. All right, Karan, got it. Thank you so much for joining in on short notice. That's helpful. Zee Entertainment hitting the headlines this afternoon on some good news. But speaking of news, let's focus on a CNBC TV18 exclusive. Sources are telling us that LIC has reached out to IRDAI seeking a review of the surrender value regulations. Yash is joining in with the details. Yash, this is that proverbial ghost. It always rises. Well, so what's the latest?
We keep challenging us that the surrender value regulations will finally settle for themselves or not. And these regulations and the changes here keep challenging us in return with the multiple changes that they've gone through. The latest, of course, with just about 1 month, which is remaining for these regulations to finally get implemented. LIC, the largest life insurance company, has reached out to the insurance regulator seeking a review, not an extension to the deadline, but a review of the regulations altogether itself. Now, of course, the regulator in June came out with a final regulation saying that the surrender value, which currently stands at about 30% of the premium, could be increased to 70 to 75%. That is to be implemented for 1st October. And now LIC has flagged off 2 important parts of the regulation where they are seeking significant changes. The first one is with respect to the spread or the cushion margin which IRDAI has provided. Now, just to help our viewers understand, in the calculation of surrender value, one big element which comes into use is the 10-year GSEC yield, which, assuming trades at 7%, IRDAI had given an additional cushion or a spread of 50 basis points, which made it 7.5% for the calculation of surrender value. LIC's first task is to increase this number higher from that 50 basis points rather, which has been provided by the regulator. That's the first task. Of course, if that 50 basis points increases, the surrender value which the insurance companies have to provide to their policyholders also reduces in that situation. The second ask by LIC to the insurance regulator is to not hardwire the 10-year GSEC yield into the regulations, into the calculation of surrender value. What LIC is saying is that why to hardwire this 10-year GSEC yield, rather have a plan-based benchmarking of that interest rate when it comes to different plans and the investments made by those different plans and different instruments. This is, of course, if it happens, will be a big positive, because 70% of the investments made by life insurance companies in government securities happens in 30-year papers, where the GSEC yield is about 7.1% as compared to 10-year, where it's 6.86%. So if it goes higher, the interest rate for the calculation of surrender value, ultimately the surrender value paid by these life insurance companies will come down. These are two important asks by the largest life insurance company. We'll have to see how the regulator considers them, and if any changes does come through before these regulations actually get implemented in about a month's time.
Okay, thank you very much for that. Dipan Mehta, Director at Elixir Equities, is with us. Insurance is clearly the sector of the day, Dipan. But before that, wanted your comments on Zee Entertainment and the news which has just come out.
Yeah, Rima, good afternoon, and thank you for having me on your show. I think it's one uncertainty out of the way for Zee Entertainment, because this could have meant additional cost for the company. But at least now that we don't have to deal with that. And also, I think it was a trigger for some sort of up move in Zee, considering that the June quarter numbers were very impressive, where they managed to increase the operating profit margins, and from a loss situation, they went into solid into profit. So I think investors are reconciled to the fact that Zee will remain as a standalone independent media company, and it should be valued accordingly. And considering the kind of high valuations the entire market is trading at, this is one stock which is available at reasonable valuations. And look, media industry can easily grow at mid to high single digit. And from that point of view, there is a little bit of compounding of earnings. And gradually, I think in Zee Entertainment, if they maintain the kind of numbers and the profitability and the growth targets, then it could get a higher and higher P re-rating as well. But a lot of uncertainties now over in Zee, and you're going to value and assess the business based on its present form.
Okay. Deepan, hi, good afternoon. I don't know if you could pick up details, if you could hear Yash with the story on LIC now seeking some changes in the surrender value regulations, right? Even before they can be formally operationalized. What is your view on, we don't know what comes out. We don't know ultimately. The last change was that these regulations had become less onerous for life insurance companies, right? And then we saw the big rally play out. Now we don't know what's the final format. But as of now, what is your view on the insurers, given the run-up?
Yeah, good afternoon, Surbi. See, I don't think it's quantified as well. And maybe it only get quantified and assessed once the final rule is out as far as IRDA is concerned from IRDA. So I wouldn't want to comment on what financial impact it will have. But on the whole, I think insurance companies are on a roll. Last 2-3 monthly figures which have come are very impressive. LIC in particular has been able to maintain or increase its market share over time. And of course, with the insurance companies and LIC in particular, this boom which we are seeing in the capital market, that certainly is going to help their adjusted enterprise value. And that'll only get disclosed at the time of the quarterly earnings. So that could be a big positive surprise for the insurance industry and LIC in particular, considering LIC is the largest investor in the capital markets. So from that point of view, very positive on the insurance sector and LIC in particular. Disclosure, we and our clients are invested in it. And it's a nice secular growth industry. And with all this financialization of savings, increased awareness, and maybe even some new opportunities like getting into medical insurance, which LIC is considering, those are all, I think, great options for insurance companies to consider. So investors should have some amount of exposure to insurance stocks. As I said, my favorite remains LIC.
All right, Deepan, when we have you, we can't not ask you about IT, and the mid-cap IT stocks that take your attention today are Tata Elxsi and Tata Tech. Well, we don't know the reason which explains this kind of an explosive up move in these stocks, but just want to highlight some data points. One, Tata Tech and Tata Elxsi have underperformed their closest competitor, KPIT Tech, in terms of a stock price performance and even actually in terms of growth rates. So this is the performance. While KPIT Tech has stolen a march over peers with a 60% return in the last 1 year, Tata Tech has been flat, no return. Tata Elxsi has given a muted 20% return in comparison. So stocks have been underperformers. For Tata Tech in particular, there have been 2 block deals. One took place today of about 1.2 million shares, but there was one even a few days back. And what we've learned from sources is that one of the large holders has cleaned out. They've sold their stake entirely, so that PE overhang could be out of the way. The third reason is that the competitor which they have underperformed, that's KPIT Tech, today has seen a downgrade from HSBC, because HSBC's view is that companies like KPIT Tech, which are fully exposed to automotive, may see slower growth because the R&D spend by large car companies globally is coming down. And therefore, it's better to play diversified engineering R&D players. Their top pick is L&T Technology, but I guess that logic applies, and therefore diversified ER&D players could perform a little better. And particularly for Tata Elxsi, remember, when they came out with their Q1 guidance, they had said that FY25 will be better than FY24 in terms of growth rates. Dipan, come in on Tata Tech and Tata Elxsi. Do you like any of them? Because stocks have underperformed compared to KPIT Tech.
Yeah, that's true, Reema. But when you put up that chart about the stock price returns, you should add the actual earnings per share growth. And if you see, KPIT's earnings growth has been phenomenal. I think it's the best in class, the best ever for a mid-cap company. And of course, I think it's focused on auto industry, where the tech spends remain very strong, and they have really, become a major leader in that particular vertical. So that explains the outperformance of KPIT. Also, the most expensive software company as well. And I'm perplexed, why one would try to switch out from KPIT into some of the underperformers like a Tata Elxsi or Tata Technologies. And actually, we have investment in Tata Elxsi as a measure of disclosure. But there could be something in Tata Elxsi. Look, it's a mid-cap company. 1 or 2 large contracts can certainly swing the growth rate significantly higher, has a fabulous track record. And in a way, all these 3 companies, Tata Technologies, Tata Elxsi, and KPIT, I still feel are in the right place at the right time, because the kind of upheaval and disruption taking place in the transportation sector, that we're nowhere close to the end over there. And the tech spending in that particular vertical still remains very strong as per our assessment.
All right, Dipan, I wanted to ask you about REC and PFC. There appears there is a news report that's giving them a bit of a fillip, with regard to infra funding. What's your view on both these 2 names? I mean, they're up 6 times, I think, in under 2 years. Any view on the stock?
No, Nigel, I think, they are attractively valued, but look at the earnings, there's a lot of volatility in their earnings. Compare them to some of the other private sector NBFC like a Bajaj Finance or a Chola, and you will see that why Street is paying higher for private sector NBFCs. But look, there's a re-rating story over there, and PFC, REC also can certainly benefit from higher government spending because most of their lenders and customers are also government organizations or PSUs. And there's a high degree of safety when it comes to NPAs over there. But I never could understand why there's so much of volatility in the earnings of these companies. Having said that, I think if you're an investor in these 2 companies, I remain invested. There still could be a space for these stocks to move up. Do keep in mind these counters have very low floating stock as well. So that also adds to their volatility and upswing. So I would remain invested, but from a fresh investment perspective, I think there are lots of choices in banks and NBFCs, and some of them are at extremely low valuations.
Okay. All right, got that. Dipan, I guess, the buzz today is whether there will be some sort of not a rethink, but maybe a go slow or a slightly different, more lenient perhaps approach on the project financing norms. Remember, higher provisioning for project financing across the board, lenders, banks, NBFCs, all of them. Maybe, some reports suggest that there could be a bit of a go slow approach over there. All right, with that, let's move on. The next stock on our radar is actually Granules. And here the story is that the sources are telling us that a surprise US FDA inspection is actually underway at one of Granules' facilities. Stock's down about 2%. Vivek got us those exclusive details. Vivek, what's the latest that you're picking up?
Well, that's right. According to our sources, what we understand is that yesterday there was a surprise inspection that started at Granules, the main facility, the top facility. This particular facility, the Gagilapur facility, which is in Hyderabad. And, today is day 2 of this particular inspection from the US FDA. Why are we discussing this particular development? This facility is quite important as far as Granules is concerned. It's a formulations as well as an PFI business facility and contributed over 70% of the company's revenue as far as Q1 was concerned. PFI is actually the pharmaceutical formulations intermediates business for the company. Remember, out of the total 16 ANDAs that the company has filed and is pending for approval from the US FDA, 11 have been filed from this particular facility itself. Remember, the company already has, the current number of NDAs that have been given approval from the US FDA and the company supplying products is almost 36. We reached out to the management of Granules. We are yet to receive a response from them, but it's an important development at this point of time. There's not too much to read into it, but it'll be an important development to track. If there are any observations, what are the kind of observations in case any do come out at the end of this particular inspection.
All right, Deepan, thanks a lot for that, Vivek. Deepan, the stock's down 2%. Any view on Granules?
No, I think maybe the street is expecting some adverse outcome from the surprise inspection, but I must say that on the whole, the pharmaceutical industry compliance with US FDA has improved. So let's see what comes out of this particular inspection. But it's a sector and a company worth watching. I think after several years of stagnation, I thought that numbers were looking up for Granules India. And there are positive changes, incremental changes, improvements taking place in the US generics market, where competitive intensity and price erosion has reduced. And look, Granules is a massive, it's got massive capacities, completely vertically integrated. And from that point of view, it's a cost leader. So subject to, no adverse outcome of the inspection, I think that there's scope for Granules India to move up also, maybe a trading rally. And a long-term investor could look at it positively for the next 2-3 years or so, with a lot of capacities coming on stream and overall improvement in global sales.
Okay. All right, Deepan, we will leave it on that note for today. Thank you very much. Good to have you with us this afternoon. You have a good rest of the day, and we will connect again soon. Time for a break. We continue the market conversation and views. On the other side, joining us is Nilesh Shah, Managing Director at Kotak Mahindra AMC. We get a perspective from Nilesh on, of course, the market setup and the way ahead.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
Well, the Unified Pension Scheme, or the UPS, is the government's latest response to the backlash against the National Pension Scheme, primarily due to its lack of fixed pension and the uncertainty tied to the market-linked investments. So how does the new UPS compare to the old pension scheme and the NPS, and what does it mean for the government employees? Here's a quick breakdown. The UPS guarantees a pension similar to the OPS. If you have served at least 25 years, you will receive 50% of your average basic pay from the last 12 months before your retirement. Even with just 10 years of service, you are assured a minimum pension of 10,000 rupees per month. This is a significant improvement over the NPS, which didn't offer any fixed pension and was subject to market risks as well.
One key difference between the OPS and the UPS is that the latter still retains the contributory nature of the NPS, but with added security. Employees contribute 10% of their salary, while the government adds 18.5%, which is higher than the 14% contribution made by the government in the National Pension Scheme. This means while you contribute, your returns are more substantial here. The UPS also includes an inflation protection through the All India Consumer Price Index for industrial workers, ensuring your pension keeps up with the cost of living, a feature totally missing in NPS and managed via a dearness allowance or DA in OPS. For your family, the UPS offers a better support. If a government employee passes away, their family...
Well, it's a bit of a slippery slide now on the street because the Nifty is actually turned into the red from being just about 6 points shy of the all-time high mark of 25,078. Now profit-taking has taken over, and we are looking at some red on the screen. Tata Steel, Titan, JSW Steel, HUL, Tata Motors, NTPC. These are some of the names on the downside as we're looking at this afternoon trade. There we go. So, yeah, that's Titan. Let's pull up the Nifty intraday as well. Choppy day, and finally it seems the profit-taking is taking over. That's the Nifty. There you go. Rare to see a sell the rally kind of a move, but that's what we've got this afternoon. Nilesh Shah, Managing Director at Kotak Mahindra AMC, is with us. Nilesh, great to have you on. So, interesting times, just when you think the market will keep marching on and the all-time high is a given, there's some volatility. And maybe that's not too bad because, you've been making the point that investors shouldn't get used to just one-way returns, right? But tell us, on balance, this month has thrown up a lot, from fears of a US recession to sudden talk about, rate cuts from the Fed to the yen carry trade issues, and of course, corporate earnings back home. There's a lot that's gone on in August. All things put together, how does it look and where do we stand?
So, Surbhi, if you are a trader, lots of things to worry about. If you are an investor who can take some correction on stride, no need to worry. The India growth story continues to march on. Albeit, one will have to moderate return expectation. Normally, in the past, we were getting hammered because we delivered negative return. My fear this time is that we'll get hammered because we delivered below expected returns. Investors are believing 20, 30, 40% return is their birthright. I doubt if market will be able to deliver that kind of return. So this time, please moderate your return expectation. Go for quality stocks over momentum stocks. Go for high floating stock market discovered prices rather than concentrated holding and low floating stock. And go for reasonable valuation over sky high expensive valuations.
But Nilesh, is a return disappointment a reason that we could see some sort of a market correction? Because this India long-term equity growth story has been sold so well, and rightfully so, that perhaps investors will take into their stride that maybe we'll have 1 or 2 years of moderate returns, not the 30 to 40% that they're expecting. Is this something that, a miss on expectation, seeing a lower return compared to the past, a reason that we will see a correction in the market, according to you?
So, Rima, there could be multiple reasons why corrections could come. There are enough reasons globally, from US soft landing or recession to Bangladesh to yen carry unwinding. And today I learned that there could be yuan carry unwinding as per Bloomberg. About $2 trillion worth of Chinese corporate investments are lying in dollar assets. And as US interest rate comes down, that money may come back to China. So there will be enough reasons available for correction. But we believe, based on our fundamentals, liquidity and sentiment, corrections are unlikely to be deeper like we saw during COVID time. They are more likely to be what we saw during October 21 to June 22 period, a minor correction, combination of time and price correction. And hopefully, those will be a great opportunity to invest.
Hi Nilesh, good afternoon. What about the SME space? Is that a cause of bother for you? You know, there's the social media is going viral about this 12 crore issue that garnered bids worth 2,700 crores odd. Is there a pocket that you'll be considerably worried about?
So, Nigel, there are few things which you don't understand in life, like your wife and like SME.
I agree.
Just give up. There's no way you can ever decipher that. SME Exchange IPO is the world's best performing equity indices. 66% compounded return for last 10 years. It started 3 decades after Sensex and it has crossed already 1 lakh mark. Sensex is still poor cousin after 4 decades struggling at 80,000. The kind of issues, Nigel, you have mentioned, I could never imagine in my life that they will be able to get so much of money. Undoubtedly, we have seen power of money in the early 90s, mid 2000s. But we have also seen that once money power goes, fundamentals prevail. In fact, Nigel, in my first job at ICICI, I was involved with OTCI of India, over-the-counter exchange of India. Forget the companies listed in OTCI, the exchange itself went bankrupt. So my recommendation to investors, traders, SME Exchange is the best performing indices of the world. But I don't think so they have the best performing fundamentals to justify current prices or valuation. There's momentum going on. There will be few companies who will be good, but majority at this valuation are unlikely to meet investors' expectation.
Nilesh, well said, but I guess, you know, as long as people know their risk appetite, they ask themselves the right question, who's to say? But perhaps the market itself has to be the best teacher. But coming back to the here and now, you said that we're unlikely to see a big correction, and perhaps dips will be a good opportunity to buy. And I think that's something that investors are struggling with. And you tell us, I mean, you folks, the asset managers of India are getting this wall of liquidity, 30,000 crores, 40,000 crores on a monthly basis. So this question of what to buy, I think this is what's really staring us in the face. And I don't know if there are clear answers. So help us with this.
So Surbhi, we have been following exactly what I said. Quality over momentum, high floating stock over low floating stock, and reasonable valuation over expensive valuation. We have taken some profit out of defense stocks, capital goods sector, infrastructure sector, and we have gone into technology, especially those companies which are leveraging artificial intelligence and machine learning better than their peers. One technology company CEO told us that one person which they are recruiting and enabling him or her with AI is today able to deliver 10 people's work. So obviously the winners will be one which are using AI to deliver better, cheaper, faster solutions to their customers, and valuations there are reasonable. The second sector where we have gone aggressive into buying is consumer FMCG. Election, budget, monsoon, all should be in favor of consumption. And we believe the coming festival season from Durga Puja, Onam, Ganesh festival, all the way to Dasera, Diwali and Christmas should see people coming out to buy, both in urban and rural India. Consumer stock valuations are high, undoubtedly, but they are relatively lower compared to their historical average, and their ROEs are likely to be better. The third sector where we are keeping a watch is chemical sector. They have been going through downturn for some period of time. Unlikely, there was no indication in this quarterly result that that downturn is coming to an end easily. But companies have cut cost. They have increased their plant capacity by re-engineering. And today they are able to compete, albeit without profit, with Chinese dumping. Assuming at some point of time China dumping gets over, then this space could be interesting. And finally, there is banking sector, especially private sector banks. This is one of the rare period where partly due to FPI selling and partly due to valuation derating, many private banks' stock market returns are lower than what fixed deposit return they are offering. I think at some point of time, valuations there will bottom out. There are certain concerns in terms of liquidity coverage ratio guideline, which can impact this private sector bank's profitability. But once those guidelines are settled, I think there will be an opportunity in private bank. So we are exactly doing what I've said, moving from momentum to quality, moving from low floating stock counters to high floating stock counters, and moving from expensive valuation to reasonable valuation.
So, you make very interesting points. We've been noting down all the sectors that you speak about, Nilesh. I want to go back and actually quote to you what a guest told us earlier this morning. And you might actually, know the guest, Manish Dangi, who was managing the fixed income strategy at one of your peer firms, Aditya Birla Sun Life Mutual Fund, right? Now, of course, he's doing his own thing. So he's followed the bond markets for a long time. And he made a very interesting argument to us in the morning, saying that, the world over, the expectation is that interest rates will start falling. And typically interest rates fall and bond yields fall when there is a fear of a growth deceleration. But at the same time, the equity market is penciling in at least 13, 14, 15% kind of earnings growth in the US and here in India. So his point was both can't be right. One has to be right, one has to be wrong. So I ask you, Nilesh, what looks like the bigger probability? A deceleration in earnings? Or perhaps there's just excessive fear about a slowdown, which the bond market and the rate cut expectations are talking about right now?
So if Jeremy Powell is as good as Alan Greenspan, he will ensure that bond market continues to believe interest rates are coming down because inflation is coming down. And equity markets will continue to believe that earnings growth will continue to grow because growth is coming. Over the decades, we have seen central bankers communicating this contradictory message to the investors. And Mr. Alan Greenspan was fairly successful at that. Manish's point is absolutely valid. But if you take the time horizon, in some sense, debt markets are backward looking. They will look at what has happened from a growth and inflation point of view. And then they'll try to factor in future probability. I think today US debt market is believing that inflation can come down without growth turning negative. And equity market in turn is believing, which is more forward looking, that growth will continue to be supported by falling interest rates and elevated level of liquidity. So in some sense, both markets can come right if Jeremy Powell can do that fine balancing. I think US Fed chairman has done a fantastic job in ensuring that inflation comes down without US going into recession. He'll achieve a soft landing, which will satisfy equity market, and he will cut rates, which will satisfy debt market.
Explained and put, Nilesh, so that's the ultimate balancing act, right? And you've laid it out that for Mr. J. Powell, the standard is Alan Greenspan. We're going to remember this. So, Nigel, what is it that, you men talk about, the balancing act between the women and home and work? I mean, look at this. That's the real balancing act that Nilesh is also talking about.
No, I'm a little worried because first Nilesh went about that. You may not understand a couple of things that I'm sure my wife is watching this and she's going to message Nilesh later on that the SIPs are done through her account. So I'm a little worried on that front. So let's keep that aside because I think we're in minority. Well, Nilesh, in the last 48 hours, my team has been calling you up and saying, Nilesh, we're going to hit all-time highs. Please join at that point of time. And now you're finally come. I think in the next, maybe either in the next half an hour from here on or tomorrow morning we'll hit it. I guess the markets are waiting for this conversation. Final question though, before we let you go, Nilesh. This SIP flows, we're thumping the table. 23,000 crores of inflows. And there is some, some kind of slicing and dicing that's going on. The net number is not that much. Wanted your comment on that because on the face of it, it looks very, very strong. But then there is some kind of redemptions that are taking place as well.
So, Nigel, my answer does not apply to you. Your SIP should continue.
My SIP is, it's only going to increase from here on. I've given you that commitment a few years ago, and I'm sure, when the kids grow up, they'll say, Nilesh bhai, thank you very much. Papa did well. But tell us, what is your analysis?
So the net amount credited into mutual funds bank account across all scheme is roughly about 22,000 crore a month, which is the gross SIP number. But in the past, Nigel bhai, we have sold SIP and investors have made money. And that amount is roughly about 13 to 14 lakh crore of AUM. Now people do redeem. Everyone is not like Nigel who will stay invested. The net redemption is roughly about 13 to 14,000 crore a month. And hence, gross SIP inflow received 21,000 crore minus SIP old AUM redeemed. The net number is probably 7,000-8,000 crore. Obviously, people save so that they can spend, and which is why at some point of time, net SIP numbers will or may become negative also.
I think the point of debate here, and Amphi did a call to help the media understand this as well. I was on it as well. I think the point that everyone was grappling with is that while redemptions is one part of it, while the SIP continues, you're redeeming something else, maybe from a different scheme, a different fund. That point is well taken. I think the question that still sort of remains a little hazy is what happens when you start an SIP of say 5,000 rupees every month, but next month, either due to low balance in your account, the money simply doesn't go. So, well, at a gross level, you're saying 23,000 crores. Is that money coming in systematically every single month? And I think that's what the confusion was.
No, Surbhi. 23,000 crore is the cash received in the bank account. A person who started 5,000 rupee SIP and didn't give the clearance, didn't have the money, that amount is not counted at all in SIP. So gross SIP is money credited into bank accounts of all mutual fund schemes. Net SIP is gross SIP minus of that 13-14 lakh crore SIP AUM, whatever redemption we have received.
So one word answer, which is a better indicator, gross SIP or net SIP?
So Rima, just don't count redemption on both sides. If you are taking redemptions of mutual funds collectively, which includes SIP as well as some lump sum redemptions, then count them together. If you are doing double counting, then it will be wrong. Total redemptions plus SIP redemptions, no. The total redemption also includes SIP redemption.
Fair point. So need to keep that math in focus. Many thanks. Great conversation as always, Nilesh. And as Nigel says, now that we've had the conversation, eventually we'll get there. Yeah. These milestones are just a matter of time. And I think investors have learned that. Thank you so much for joining in today. Pleasure having you on the show. All right, well, with that, the markets actually managed a little bit of green again, 15 points up on the Nifty. There's one more stock that's in focus today, and that is CDSL. Now, CDSL turned a bit volatile. ICICI Securities downgraded the stock to a reduce from a hold. So first it fell, and now there's a sudden sort of surge back that you're seeing. Plenty of volatility on this counter today. Let's go across to Vamakshi to figure out what exactly ISEC is saying. Vamakshi, tell us more.
Well, absolutely. ICICI Securities, like you rightly mentioned, has downgraded their rating on this counter to reduce from hold. However, they've increased their target price from 1,118 per share to 1,320 per share. They say that CDSL is an attractive play in the bull market, as we've seen in the past from FY20 to 22. But the upcycle multiples that are being seen now are not expected to sustain during the consolidation period. CDSL is now trading at 59 times 1 year forward core EPS and 53 times 1 year forward EPS on FY26 basis, and this is in fact double as compared to what we've seen in the past. The price cuts as seen in Q1 indicate that there is a possibility that the company is passing on the benefits received as a part of their operating leverage, and this in turn could limit margins for the company. Increase in cash volumes due to restriction on options would be more likely in intraday and delivery. Now keep in mind that CDSL benefits only on more volumes in the delivery segment. segment, and in fact the delivery as a percentage of total cash trades has been trending downwards from 26% in FY21 to 21 FY18 to 21% in FY24. They also highlight that the risk reward in this counter seems rather unfavorable, and that is mainly on account of peak cycle multiples as well as possibility of lower than expected earnings given a high base for CDSL. So given those factors, we have ICICI Securities downgrading its rating, but they've upped their target price.
Got it. Thanks for that, Vamakshi. For the time being, we'll slip into a short break. More related market news on the other side. Stay with us.
But we do see pockets of opportunity. For example, I think let's look at the domestic consumption, a sector which has not done much. But within that, we see opportunity in sectors like telecom. We see opportunity in sectors like two-wheelers, tractors. Also, we see opportunity in real estate ancillary kind of industries. With the specter of rates coming down and hopefully liquidity improving, we also see opportunities in banks, large banks which suffered due to liquidity in the past. We also see opportunity in the smaller banks or the non-banks. So we are looking at the segments like the pipes, the cables, the switch gears, the lighting and all those segments, because all those segments we believe the organized sector has a definite edge and they can do better.
Welcome back. Mitesh Thakkar is back with us. Mitesh, what are the buy or sell calls you have for us for a reverse trade in the next few days?
Nigel, About India is trading near the day's high. So that's a BTST with a stop below 29,500 for targets of 30,300. And HAL, surprisingly, isn't showing signs of the correction being over as yet. And I would take a STVT here. Keep a stop at about levels of 47.50. Look for targets of 46.60.
Okay, there's one stock which is flying today, that's Datamatics. Now, this is after the company entered into a partnership with Microsoft, where they will be building AI solutions using Microsoft's Copilot. So this will help the company build customized solutions, AI solutions for their customers. So the street is excited because Datamatics is a smaller company which is partnering with the giant Microsoft. We can't estimate the extent of the financial benefit, but the stock is now locked in an upper circuit of close to about 20%. But just to recap, I think the street would also want to see a pickup in the base business because Q1 was subdued for the company. Their revenues had fallen 4.5% quarter on quarter. On a year-on-year basis, their revenues were flat. And the company had spoken about slowness in the US and the European market, a flat growth in their existing business. So while we try and assess from the company what the benefit of this Microsoft partnership is, even a pickup in the base business is something that the street would await. The stock, though, is very, very excited, up close to about 20%.
Okay, all right. Well, I think we're getting some news coming in from Money Control as well, and we'll try to verify that. The government is evaluating Vodafone Idea's request for a potential waiver of some bank guarantees. So we'll try to get you more details on that front as well. Vodafone Idea is a stock that should come up for you on the screen. The government is evaluating request for waiver of bank guarantees on the upcoming 24,000 crore rupees of dues. So we'll keep an eye out on the stock. For the time being, it's perked up a little bit as we speak. Well, let's get in Jay Bala of cashthekiosk.com, who joins us on the show. Hi, Jay. Good afternoon and good to see you in. What's the view on the index? You know, you keep throwing anything negative to it, but it's just punching back and moving higher. Where are we headed on the Nifty, and what about the Nifty Bank?
Yeah, good to be here, Nigel. We are getting into the end game of the medium to long-term move here, Nigel. The markets are bullish, like I pointed out last time. It's challenging the all-time highs, but be ready for stomach-churning volatility going forward in the short term and in the next 12 to 18 months also. The markets are going to transpire in some fashion that's like 5% above from here, and 18 to 30% drop in the medium term, and then come back to fresh all-time highs. So that's the kind of trajectory I have in the short term and the medium term. Even in the very short term, I won't be surprised if the markets were to drop to something like 23,820 and then come back to fresh record highs about 25,600. But the very short term, doesn't have to do it, but the markets are still bullish. The broad point and the broad takeaway from that is that learn to bank your profits. If you don't do that, they'll disappear quickly.
Okay, stay on, Jay. We've got more questions for you, but for now, we need to slip into a very short break with the news that it's absolutely unchanged for the Nifty and the Sensex. Nifty up 3 points, Sensex up 20 points. We'll come back with more. Welcome back. Sources to Money Control suggest that the government is evaluating Vodafone Idea's request for a potential waiver of bank guarantees. The bank guarantees amount to close to 25,000 crore rupees. So this will come in as a relief. It's not a cash flow impact, but it's a waiver on bank guarantees. And perhaps if that's waived off, then it paves the way for the company to go ahead and raise some more debt, which it wants to do. They've managed to complete the equity fundraise, via the FPO, which was very, very successful. But the company also plans to additionally support its, bank balance with a debt fundraising. And now it appears, what sources to Money Control have picked up is that maybe Vodafone Idea has made a request for a potential waiver of the bank guarantees amounting to 25,000 crore rupees. And the government, which is a majority shareholder in Vodafone Idea, is currently evaluating and considering this request. The stock is up about 1.7%, moved up a bit. But the other stock on our radar is MediAssist. This is after the company acquired Paramount Health Services for an enterprise value of 312 crores. Yash is here with the details. Yash.
Well, Rima, it's quite an interesting transaction which MediAssist has entered into, quite strategic for the company. MediAssist has announced acquisition of about 100% stake in another TPA company, that is Paramount TPA. The deal is done as an enterprise value of about 312 crore rupees. When you look at the equity value, it is upwards of 400 crore rupees. Now, just to compare this particular acquisition, that is of Paramount TPA, to the other acquisitions that the company's made recently, Paramount TPA is 3 times the size of Raksha TPA, the last transaction or the acquisition which MediAssist made. It is 7 times the size of MedAdvantage, which is another transaction made recently by MediAssist. Paramount TPA deal is valued at 2.5 times sales versus Raksha TPA that happened at 1.7 times sales, and MedAdvantage which happened at about 1 time sales. Of course, the company is much larger and the valuations are a little more than what the 2 transactions happened at. MediAssist itself trades at 5.2 times sales and 47 times enterprise value. So that way, the valuation at which Paramount TPA has been acquired is quite favorable to MediAssist as well. What does Paramount TPA bring on table for MediAssist? First one, Paramount TPA is the second largest TPA in the group segment as on FY24. It adds significant amount of market share to the current market share of MediAssist, adding about 6% market share in the group segment, taking it to 36.6%, and adding 4% market share in the health insurance segment, taking it to about 23.6%. So, of course, significant addition to market share, attractive valuation at which the transaction happens, and fits well in what the company intends to do in the group insurance space.
Okay, all right. Yash, thanks a lot for that. We're still in conversation with Jay Bala. Jay, before we continue talking about the equity calls, what about crude? That's moved up again to around $81 per barrel, and that's the fear, right, with that geopolitical tension in the offing. What's your take?
Yeah, the Brent is setting up for its medium-term drop towards 55 and probably below 55. But in the very short term, we could see a further bump up close to 82.5. Maybe yesterday's high was the counter trend bounce, peak, maybe there's one more high coming to about 82.5. But as soon as the 76 important support on Brent is taken out, it confirms the medium-term opinion that I've been having, that it's dropping towards 55. But so, expect slight bump up in the very near term, but, it's set up very well for a sharp decline towards 55.
Any interesting stocks which catch your attention, Jay?
Yeah, I've gone this time outside the mainline indices, and there are 2 stocks from the mid and small cap space. One is Autoline Industries. This is breaking out of a inverse head and shoulders pattern on the monthly time scale. So placing a stop at about 120 and a price subject close to 240 is possible. And the other stock is again Kaitan Chemicals and Fertilizers. This is consolidating after a sharp decline for the last 1 year, and it's breaking out of a pattern, what looks like a cup and handle pattern. And if it is getting back to where it's heading, I think it's heading for something like 160. So a stop loss at about 78, 72 will make a lot of sense. But these 2 are quite thinly traded, so position size yourself accordingly.
Jay, just quickly, NASDAQ, next levels you're watching?
Yeah, I'm watching the all-time highs at about 20,100 and change. But what is significant is that the semiconductors within the techs have started to underperform, while the blue chips have come up to record highs. So watch out for it. You have NVIDIA results coming up day after tomorrow. So you might want to be a bit cautious on frontline techs. But I think higher highs are due. But it's all with a bit of caution.
Okay, all right. Jay, appreciate you stopping by and giving us your view on the indices, commodities, as well as on a couple of stocks as well. Wishing you a good evening ahead. Well, before we wind up, just want to focus on a few stocks. We have Hindustan Copper, Manappuram, and GNFC. I think these will go back into the F&O band going by my calculation. So keep an eye out on all these three: Hindustan Copper, Manappuram, as well as GNFC. And the possible exits from the band, well, we could have ABFRL, IEX, and Aarti Industries. So keep an eye out on all these three stocks. Three could go in and three potentially could come out as well. But it's that sort of a session. Well, we thought we were almost there. Unfortunately, the market slipped a little bit. So we have to wait a little bit longer. But all good things, test your patience. Stocks that didn't do well from the Nifty pack today. JSW still came in for profit breaking. That was down close to 2%. A couple of these notable higher value stocks like HUL and Titan. Great business model, but valuations a little bit elevated. Both those two were down close to 2%. Coal India as well did come in for some profit taking. What did well then? Some of those financial names, Bajaj Finserv, SBI Life, HDFC Life, Shriram Finance, all of them were up between 1.5% to around 2.5%. So that held one end up. The positive today was the mid-cap index was an outperformer, up close to around 0.5% or thereabouts. The Bank Nifty yet again went all the way to 51,350 and did a bit of a U-turn from those levels.
Okay, well, let's look at what worked in mid-caps, because that's where the outperformance really was. NIIT, another 13% on the upside. MediAssist, the acquisition that they announced, well received by the market, 8% up over there. Dilip Bilkon had announced a small contract win, a small award, 7.5% up on that stock. And by the way, today, a lot of the pain stocks have actually done well, despite the acceleration in crude oil prices. Look at Akzo Nobel. 7% up on that one stock. Even Berger is up about 2%. Kansai is up about 1% as well. So not much sort of worry on the crude up move, so to speak. Let's look at what else worked for the market. The gainers tally included names like Tata Elxsi, 16-17% now as the bell goes. Tata Investments, 20%. CESC, 10%. Tejas Networks, 6%. K-Fintech, almost 14%. Such a long list of winners, really. I could just go on and on. Kaplan Point, 6% on the higher side. So big list of winners. Subros, 8%. So even though the market was very range-bound, the action was choppy at the headline index level. Some of these movers shakers managed plenty of gain. Office, the recent listing, has been cooling off. Of course, it's had a great run. The stock was a sort of doubler recently. But after doubling, it started correcting, and that continued today, about 3% on the lower side over there as well. And some red, a little bit of red on the oil marketing firms, BPCL, HPCL, IOC, with the rise in crude oil prices. So the bell has gone, the day has ended, and the final tally is about a 14-point drop on the Nifty. So all-time highs, well, they'll have to wait, perhaps at least not today. With that, we will wind down on this edition of Closing Bell. Thank you very much for joining in. We'll take all the action forward, markets forward, coming up next.
The large street fails to hold intraday up move. The Nifty slips after it gets within touching distance of record highs. Mid-caps outperform the blue chips, Reliance and FMCG companies were the biggest losers in today's session.
MediAssist rallies 8% after it buys the second largest group TPA Paramount Health Services. Z Entertainment soars 11% after it says it's entered into an agreement with Sony India to settle all disputes related to the failed merger. Datamatics hits an upper circuit after it announces a partnership with Microsoft.
With just a month to go for the new surrender value rules to take effect, LIC asked insurance regulator for a review. Sources say LIC wants the new formula, which raised surrender value above 75%, to be tweaked. That's an exclusive. Hello and welcome to Markets Forward, your go-to show where we get you updated with regard to today's trading action and also we set you up for tomorrow's session. I'm Rajul D'Souza and joining me today is Reema Tendulkar. Hey Reema, so close yet so far.
Oh, absolutely. But managing to hold on to that 25,000 mark, at least by the close of trade, but a very, very flat finish. But we'll get you on this show all the key developments in the Dalal Street, the big corporate voices, the events to track ahead. But first, the market action. I think you summarized it well, right? So close, yet so far, but still a positive close.
Well, that's right, Reema. You know, we're almost there. Virtually, we're at those highs. It's just a matter of a number. But today, the Nifty almost went to those all-time highs, but we ended off those levels. So we ended more or less flattish. At one point of time, we were up close to around 50 points as well. Insurance and select IT names, though, did very, very well. You're looking at the likes of SBI Life from the Nifty pack that did well. LIC was reacting to that, exclusive from CNBC TV18. And also, you had tech-related names, the Tata Group stocks, Tata Elxsi, Tata Technologies, they did well in trade today. What didn't do well was HUL and Titan, relatively higher value stocks, in terms of valuations. And both of them did come in for profit, taking down 1.5% to around 2%. The good news, though, is that the mid-cap index still outperformed today. When the Nifty ends flat and the mid-cap index ends with a gain of close to around 0.5%, with more stocks advancing than declining, your portfolio will be feeling quite good. So the uptrend is intact. But today, we just missed that number with regard to those all-time highs, Reema.
But lots of individual stock-specific action in the frontline pack. Just to take you through some of the movers on the way down, you had Titan, that was the big loser. JSW Steel corrected nearly 2%. Then some corrections set in FMCG names. So HUL, ITC on the back foot. Coal India, NTPC in the PSU pack, weak in trade. On the way up, it was a lot about insurance names. So life insurance companies like SBI Life, HDFC Life higher in trade. ICICI Bank provided support. Shriram Finance was active in trade. And then you had a Maruti Suzuki and an L&T also gaining in ground. But first, let's tell you what we have for you on our show today. In the next 20 minutes, we'll discuss the top movers and shakers of the day with Vivek. The stocks in focus are MediAssist, NIIT Limited. The sector in focus is insurance. And also, we'll get you up to date on all the big events to prepare you for tomorrow's trading session. But first, it's over to Vivek now. He's at the big wall with the top stock movers. Vivek.
Well, thank you so much for that. Another session where, especially if you're looking at the market, that's very, very strong in favor of the advances. A lot of stocks on the radar today. First on our list, MediAssist, a very interesting acquisition by the company, strategic acquisition, stock ending higher, almost 7.5%. Stock was much higher, but cooled off a little bit in the second half of the second. The second stock on the radar is CESE. Now, this particular stock, remember, we highlighted yesterday as well that the management had gone ahead and met quite a lot of sell-side analysts over the weekend. The stock today higher by 10% after the up move that we saw yesterday. Two stocks from the Tata Group stable as far as the mid-cap IT space is concerned. Tata Elxsi, almost 16% higher in this particular name. And the other stock, of course, was Tata Tech, an overhang of a strategic seller doing a clean-out trade. That is something that aided the up move as far as Tata Technologies is concerned. Now, the next stock on the radar is ABB India. Very interesting note coming in from Axis Capital. After the recent sell-off that the stock saw post the results, they did a double upgrade on the stock, ending higher by close to 1.5%. REC, again, newspaper reports are indicating that there could be some relief coming in as far as the draft financing norm firms are concerned, and the stock ended higher by almost 4.5% on the back of this particular report. Now, on the other hand, quite a few laggards. One that you mentioned earlier in the show was Titan, like you mentioned, high PE stocks as well as select consumer names today seeing a bit of selling pressure. Minda Corp, this particular stock, after a while saw a bit of selling pressure, top laggard as far as the Nifty 500 or the NSE 500 is concerned. And also Syngene, this particular stock saw witness selling pressure throughout the trading session, top laggard as far as the mid-cap index was concerned, and even within the F&O space was amongst the top laggards.
Thank you very much for that. Let's invite Jay Bala of Cash the Chaos on the show, and Mayuresh Joshi, Head of Equity Research at William O'Neill. Gentlemen, thank you very much for joining in. Jay, first question, very, very quiet. How do you expect the near term to pan out? Is there a trend that you see? Any stocks that you would want to highlight for tomorrow's trade?
Yeah, of the list from which Vivek had highlighted, REC pointed out last week as potential to scale fresh all-time highs past 690. So I like that from the list Vivek has put out. And I've been liking it since last week. And it's a little late on the clock. I would expect it to hit fresh highs. When it comes to the Nifty, I'm expecting wild gyrations to start in the short term as well as in the medium to long term too. So markets are bullish, but we need to start banking your profits quickly and leave only a small portion of it intact. But so be prepared for wild gyrations in the markets, but it's going to be bullish in the market.
Okay, got that. Jay, stay with us. So let's get you first to CNBC TV18 exclusive. LIC has asked the insurance regulator to review the new surrender value rules before they come into effect a month from now. Sources tell us that the LIC wants a new formula which raises the surrender value above 75% to be tweaked. Yash is the one that's picking up all those details. He joins us to help us out with a quick analysis on that. Well, Yash, what are the public insurers' key asks?
Well, Nigel, just about a month to go before the surrender value regulations which were announced in the month of June get implemented. And with such a short time in hand, the largest life insurance company, LIC, has reached out to the insurance regulator seeking not an extension to the timeline for the implementation, but a review of the surrender value regulations itself. Now, of course, the insurance regulator, IRDAI, had suggested regulations for surrender value regulations, which essentially increase the surrender value to about 70 to 75% of the premium paid from currently 30%. So it was a significant jump. And LIC now has reached out to the insurance regulator, IRDAI, with two important asks. The first one, when it comes to calculation of this higher surrender value as prescribed by IRDAI, the interest rate element of 10-year GSEC yield plays a very important portion in the calculation of it. The IRDAI had given a 50 basis point spread or cushion over the 10-year GSEC yield, assuming that stands at about 7%. So 50 basis point spread would have been 7.5% for the calculation of surrender value. What LIC's ask is to increase the spread upwards of 50 basis points, which has been prescribed by the regulator. Of course, if that spread goes up, that entire interest rate element goes higher, which reduces the surrender value, which LIC along with other life insurance companies have to pay to their policyholders. The second ask is not to hardwire the 10-year GSEC yield in the calculation of higher surrender value. LIC is of the view that this should be plan-based benchmarking of the interest rate, which is used in the calculation of surrender value. Now, LIC and other life insurance companies, we understand, have more than 70% of the investments in 30-year government securities, and hence they are asking that this should be plan-based, which means 30-year GSEC yield, let's say, has an interest of about 7.1%, 10-year GSEC yield has 6.9%, so the difference will essentially end up reducing the surrender value which life insurance companies have to pay to their policyholders. These are two important asks made by LIC. We'll have to wait and watch with 1 month in hand if the regulator indeed considers these requests coming from the largest life insurance company.
Thank you very much for that. Let's also get in an exclusive conversation that Yash had with Girija Subramaniam, CMD at New India Assurance, who said that they expect to see a 12% growth premium for FY25. The company also expects its health and motor segment to grow over 12% this year.
As far as the premium growth is concerned, I agree that we were at 3 point something in the first quarter, and since now we are continuously motivating our retail offices and our agency and other marketing forces to go very strong on retail. We are increasing our product profile and concentration on retail lines. I think in the remaining 8 months of the year, we would be able to show more traction. And we could be showing somewhere, we hope to show a growth figure of around 12% this year. We aim to bring down the combined ratio significantly. And in the next year, possibly we are aiming at a combined ratio of sub 110%. Maybe 18-19% is what we would feel is possible and which is ideal in this year. Health and motor comprise 75% of our book, and therefore the growth will definitely be there. When I say 12%, we expect minimum 12% in these two lines. Otherwise, we won't be able to achieve that 12% on an overall basis. Correct. But then maybe that 12% will be more retail based than it was completely on the corporate base. Like in the health side, we have around 70% of our business coming from group health business. Only 30% is from retail. So maybe we will try to have a better balance over there. Maybe more tilted towards retail than towards group, and the growth coming out of that. Okay. So maybe that would be better management, and the profitability also is expected to go up once this balance tilts in favor of retail, and therefore the concerted effort towards this retail business. In motor, there has been an issue with regards to third-party premium not being increased for the last 2 years, and because of that, the business is becoming unsustainable.
Okay, all right. Let's get in Mayuresh Joshi as well into the conversation. Mayuresh, insurance was practically the sector of the day. A lot of news bites. You had that interview as well that played out. What do you like from the space?
Afternoon, Nigel. So within the life insurance players, I think what stacks right at the top remains SBI Life. Obviously, if you start dissecting in terms of how the product mix is for all life insurance players, HDFC, ICICI have tweaked their product mix to a large extent. But with the tweaking in their product pipeline, what has also happened is that the commission and the marketing payouts have also increased significantly. SBI Life also has introduced new products, but the commission and the overall outlay that probably goes in terms of an expense ratio still remains in a higher single digit, which is comparatively lesser to its peers at this juncture. Obviously, the bank assurance with SBI as a network augurs well in terms of the premium growth and the VNB margin. So I think the return on embedded value should remain very, very consistent. EPS RS ratings looks extremely strong. So SBI Life remains top of the pack from the life insurance players. Similarly, on the non-life part, ICICI Lombard, I think the numbers continue growing steadily. Expectation is again laid out that the numbers should be a steady state over the next few quarters and years as well, making strides in terms of market share gains as well in the respective outlets or the advances that they probably cater to as well. So SBI Life in the life, ICICI Lombard in non-life.
There's one more stock in the insurance-related space that we want to highlight, and that's MediAssist, which rallied 8.5% after the company announced its plans to acquire Paramount Health Services and TPA for about a little more than 300 crore rupees. This will further cement its position in the market. Yash is still with us. He's been waiting by. Yash, more details about this acquisition, and we also chatted with the management.
Well, it's a strategic transaction as far as MediAssist is concerned, a large one for the company in the insurance third-party administrator space. MediAssist announcing acquisition of 100% stake in Paramount TPA at an enterprise value of about 312 crore rupees. If you look at the equity value, that goes upwards of about 400 crore rupees. Now, it is very important to just view Paramount TPA's acquisition as compared to the previous two acquisitions, Raksha TPA as well as Medvantage, which were made by MediAssist. Paramount TPA is 3 times the size of Raksha TPA and 7 times the size of Medvantage. The deal of Paramount TPA happens as 2.5 times sales versus Raksha TPA of 1.7 times and Medvantage of 1 time sales. Now consider this as against the valuation that MediAssist trades at 5.2 times sales and 47 times enterprise value. For a company which is trading at 5.2 times sales, the transaction has happened at about 2 times sales, which is quite attractive as far as the valuation counterpart is concerned. Now, what does Paramount TPA bring on table for MediAssist? It is the third largest TPA as far as the group segment as on FY24 is concerned. It brings significant amount of addition as far as market share is concerned. Acquisition of Paramount TPA takes Mediasis market share in group segment higher by 6% to 36.6%, and in the health insurance segment by 4% to 23.6%. So, of course, three important factors: the valuation being considerably attractive for a large transaction like Paramount TPA. The second one is significant addition to the market share for Mediasis through Paramount TPA. And the third one, of course, it aligns very well with what Mediasis wants to do in the group insurance segment, and it will help them actually make inroads into a new customer base.
Perfect, Yash. Thanks a lot for that. When you trade at a particular valuation and in fact you acquire a company that's at a lower valuation, that's good news. And incremental gains on market share, the street loved it. Mayuresh, your comment on this one?
No, I think it's absolutely makes sense. I think, and you're absolutely right, Nigel. I think the acquisition actually fits their profile completely, both in terms of the group segments as well as the health insurance segments. Now, Paramount actually does around 3,800, 3,900 crores in terms of premiums. Mediasis does around 19,000. So on a combined basis, they'll actually be around 23,000 crores in terms of net premium. They will be gaining market share, as Yash said, on the group segment around 37%, health insurance around 27%. But the best part will come in terms of the tech-enabled infrastructure. So as they transition corporates to the Mediasis platforms from all the acquisitions that they've probably done, they will have view at scale, and therefore the operating metrics, both in terms of margins, which they reported last year at 8.7%, should improve, and the leveraging in terms of the group infrastructure with all their acquirer companies as well should also assist earnings. So yeah, I think positive for Mediasis in terms of forward-looking earnings.
Jay, anything in the insurance space that you like?
I've always been liking SBI Life, and the private banking space I've liked, private insurance space I've liked ICICI Pru. And SBI Life have been bullish since June, and it continues to scale fresh 52-week highs. And further highs are due, but it's a bit late in the day. So start lightening up. I think this is the final leg of the move, and probably it might be wise to start liquidating stocks like LIC Life Insurance. It might have one final high to come through, but once again, there too, it might be end of the move.
In fact, the other pocket where we saw a lot of activity was mid-cap IT. So one of them is NIIT, not really an IT services company, but more a learning solutions company. Now, NIIT Limited is a stock which has gained nearly 50%, 45-50% in a span of 3 days. On last Thursday, the promoters, that's the Thadani family, bought 35 lakh shares, increasing their stake from 34.6 to 37.2. So a fairly substantial stake increase. This was followed by, veteran investor Ramesh Damani acquiring 8 lakh shares on Friday. So since then, the stock has been fairly active. And just want to highlight the other notable shareholders in NIIT Limited. You've got MIT, Hornbill, Orchid India amongst the FIIs. DII investors include Nippon Small Cap Mutual Fund and Marathon Edge. The other, stock which was almost locked in an upper circuit of 20% was Datamatics, and here the company has entered into a partnership with Microsoft, which will use Copilot to help build custom AI solutions for their customers. So it seems like a big deal for Datamatics because the stock was locked in an upper circuit of about 20%. But outside of that, so many other names, right? You had a Tata Elxsi which saw a double-digit surge. You had Tata Tech where the overhang of PE selling may be out of the way because there was this another block deal which took place. There was a downgrade on KPIT Tech. So lots of mid-cap IT stocks were in the news flow. Mayuresh, first on ER&D and then on this Datamatics or NIIT, if you've had a look at these two stocks.
No, I think ER&D as a space, I think the investments will remain accelerated over the next few quarters and years. Obviously, I think you're seeing some element in terms of a slowdown sort of a dynamic getting played out in the European market as we speak. But the outlay will continue. And therefore, I think KPIT with the kind of client wins that it probably has, Tata Elxsi had largely underperformed KPIT and the ER&D peers in general. Should probably also reflect better numbers as we head into the next few years. But valuations, again, Rima, tad bit more expensive. So I think we are being very, very selective here. I think we continue holding stocks like Emphasis as an example in our global portfolios. For NIT, I think the corporate learning solutions is expected to continue doing well. I think one of the triggers that I was hearing in terms of chatter on the street was with the government announcement in terms of upskilling that is expected to take place for a lot of the youth of this country, expectations of more internships coming in. I think IT training will be something which will be paramount. And therefore, I think these corporate learning solution-based companies like NIT might probably remain in focus.
Okay, all right. Well, thanks a lot, gentlemen, for joining in and helping us with the view on the markets as well as individual stocks. But before we wind up with this discussion, Jay, I wanted to wish you a very, very happy birthday. I believe that you've got a bat in your hand and you're raising the bat because it's half a century, I believe. So wishing you a good remainder of the day ahead and a cracker in terms of market performance as well, Jay. Appreciated you joining in today as well.
Have a magical day, a very special year, and good health, prosperity for the other half century that's lined up in front of you.
Lift up the bat, Jay. We're waiting for that. All right. Have a good one. Thanks for that. Well, on that note, though, we'll slip into a short break. You come back. We'll continue to focus on markets. In fact, we'll get you all the top corporate voices that joined us earlier today, and we'll gear you up for tomorrow's session.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
Well, the Unified Pension Scheme, or the UPS, is the government's latest response to the backlash against the National Pension Scheme, primarily due to its lack of fixed pension and the uncertainty tied to the market-linked investments. So how does the new UPS compare to the old pension scheme and the NPS, and what does it mean for the government employees? Here's a quick breakdown.
Investing.
Welcome back. You're watching Markets Forward, and it's time now to get you the top corporate voices of the day. Now, CSB Bank fell 0.5% after the bank said its first quarter was weak due to regulatory reasons. For FY25, the bank has guided for an 18 to 20% loan growth, with net interest margins at 4.5% to 4.8%. The management added that there were no concerns on asset quality.
Well, meanwhile, Vinati Organics gained nearly 1% after the management stuck to its top-line growth guidance of 20% with EBITDA margins of around 26 to 27% for the coming fiscal. The management also added that the firm had a robust order book for ATBS and expected its facility to be fully utilized in the next 2 to 3 years.
And Bansal Wires gained 3% after Investec bet big on the company. The management indicated they're on course to match the brokerage firm's assumptions, added they would double volumes as well as EBITDA per ton on the stainless steel wire business.
Well, and before we wrap up, let's get you all the key events we need to track for tomorrow's session. Vamakshi is joining us to help us out with that list. Vamakshi, take it away.
Well, absolutely.